at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie, John.
Laura Wright, thank you. Up next, SAP tumbling in pre-market trading after cutting its outlook. The CFO joining this program next. Alongside Anne-Marie Hordern, I'm Jonathan Ferro. Equity futures lower, 20 minutes away from the opening bell. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
18 minutes away from the opening bell, equity futures are not looking pretty this Monday morning. Good morning to you all. Down about 1% on FTSE futures, off by 1.9% on the DAX. Let's keep it in Germany, where SAP has cut its full-year revenue forecast. The software maker saying it expects the coronavirus pandemic to hurt demand through at least the first half of 2021 as a fresh wave of lockdowns hits businesses globally. Danny Berger joins us now for more. Hey, Danny.
Hi, John. Well, let's be clear how the market thus far has reacted to those numbers. On TradeGate pre-market, SAP shares down 13%. If I could be more specific about the numbers SAP gave us after the close on Friday, for their adjusted full-year revenue at the high end, they now see $27.8 billion. Previously, that high end of their target was $32.9 billion. But that previous estimate there assumed that we would start to get economies reopening. But according to SAP, they say that a lot of their business customers have had to freeze various spending, and that is hurting this software maker's revenue for the full year. The CEO on the earnings call just an hour ago also citing their Concur cloud business travel, saying that they have limited visibility. Obviously, people traveling less means that any sort of business travel programs surely will come under pressure. Now, Bloomberg Intelligence, to them, though, the big surprise to them was the sharp deceleration in cloud backlog numbers. According to our strategists, they say that to them shows that SAP is losing market share in the cloud software business. John, Anne-Marie?
Danny, thank you. A really important conversation this morning, and I'm pleased to say we're joined now by SAP CFO Luka Mucic. Luka, great to have you with us on the program, sir. About a month into Q4, are these trends getting better or worse?
Now, first of all, thanks for having me. And let me start by saying that we are actually not unhappy about our Q3 results, at least in as far as we can influence them. We saw in Q3 quite a significant currency headwind, both on our top line as well as on the profit side by 4 to 5 percentage points. And the fact that we were still able to increase our operating profit at constant currencies by 4% is actually quite pleasing. Secondly, you have cited just before the challenges that we are facing in our Concur travel and expense management cloud business, which is significantly down. But backing that out, our SaaS business in the cloud is actually up by 26%. So we feel comfortable with the trajectory that we're on, in particular as we're exiting the crisis. Now, Q4, from our perspective, will certainly not look a lot different. Our outlook that we had adjusted in April assumed that over the course of the second half year, we would see a gradual improvement in the demand environment due to lockdowns easing. Unfortunately, the opposite is starting to happen since the end of the summer, and therefore our expectations for Q4 are actually quite similar to what we have seen in Q3.
Luca, your language, your words, not mine. You're not unhappy, you feel comfortable. I imagine investors don't feel that way this morning with where this stock is set to open over in Germany. What's your message to them?
Look, our key message is that we are building this company for sustainable long-term growth. We see an excellent opportunity actually to double down and expand our addressable market in the cloud significantly. We're investing into this both due to new innovation categories that we are having our R&D department busy on, like industry cloud, business networks. We also see a great opportunity as customers become more and more open to also move their core ERP workloads to the cloud to accelerate into this movement, take our customers by the hand and transform them to the cloud to drive faster digital transformation. That's why we have just updated our midterm ambition, and over the course of the next 5 years, want to actually reach 22 billion euros in cloud revenues, which is close to triple the size of the cloud business that we're enjoying now. So we clearly see long-term opportunities for outsized growth, for an increasing CAGR in our cloud business, as well as also for returning to double-digit operating profit growth in 2023 and beyond.
Luca, your previous outlook, though, assumed economies reopened. It's a very different picture, especially if you're waking up in Europe today. Are you confident enough to say the worst is behind SAP?
No, to be very clear, we assume that we will continue to face a challenging demand environment probably until mid next year. Of course, there is substantial uncertainty out there on when the COVID impacts will ultimately start to dissipate, when a vaccine will become available, when travel restrictions can be ultimately lifted. But our best guess is that this should be the case in the second half of 2021. And from there on, we, of course, see great opportunities to further expand our market share, in particular in the cloud, because solutions like Concur will actually be able to consolidate the market. They are already by far the market-leading solution in travel and expense, and the end of the crisis will actually be an opportunity for them to further increase their share. And then we have all of the new opportunities out there that I've been citing, in particular the migration of our established installed base in on-premise core ERP to the cloud. And that is an opportunity that does not exist elsewhere in the market and certainly will propel our growth in the future.
But right now, no one is really traveling, so Concur is clearly under some pressure. Your internal conversations, where do you see business travel coming back online? We just had our airlines reporter on talking about what the Times is saying, that they want to potentially lessen these quarantine periods, these self-isolation periods for potentially bankers and hedge funds. Your internal conversations, where do you see that coming back?
Yeah, look, we are very cautious ourselves when it comes to business travel. To be quite open, we are going to save at SAP the lion's share of our discretionary spend reductions, which are going to amount to around about 1 billion by the end of the year. The majority of this will come from reduced business travel. And we frankly believe that also in the first half year, we should see significantly curtailed levels of travel compared to a pre-COVID situation and scenario. But certainly this cannot go on forever. We are also preparing at SAP to be able to allow for business travel again when the situation is safe and secure. In the meantime, we have set 28,000 customers year to date live on SAP solutions. So our remote implementation and customer support capabilities certainly were put to the test and actually have succeeded quite well. But mid-year point is our internal assumption when business travel should start to normalize again.
Luca, just a final question from me, just to step outside of your role and just more broadly as a member of a C-suite of a large company, an important company. What's your advice for the policymakers right now? I assume the cost of capital is not a problem for a company like SAP. It's not monetary policy. What would you like to see from policymakers in Europe and beyond that you're not seeing right now?
Well, double down on innovation and digitalization. I think the public sector has a great opportunity now to lead the digital transformation of our national and European economies. They need to lead by example in many states, including Germany. I would say they are rather laggards than leaders in terms of adoption of digital scenarios. That is the first thing, to lead by example. The second thing is certainly also investment stimulus. It is quite understandable, and I would say policymakers have responded remarkably fast and well across Europe in terms of providing immediate fiscal relief to companies that are challenged. Certainly SAP continues to be in a very solid position, but in other industries that was important. But now is the time to translate those immediate safeguarding measures into sustainable investment. So what we are doing in Germany and in Europe, for example, around establishing the Gaia X cloud infrastructure, and from a governmental perspective, fostering the build-up of trans-European industry use cases for a European cloud. This is exactly the type of focus areas and investment areas that I would love everyone across Europe to double down, because this is what will determine our long-term competitiveness in the global market.
Luca, great to catch you up this morning. Appreciate your time, sir. Thank you. Good luck for the rest of the day. Luka Mucic there, the CFO of SAP. He is not unhappy. He is comfortable. I imagine if you're long that stock going into this open, you're neither of those two things right now. Let's get you the Bloomberg Business Flash, your top stories with Laura Wright.
Thanks, John. Airbnb is splitting its privately held shares ahead of a planned public offering. Bloomberg has seen an email from the company to some of its shareholders. The board approved a 2-for-1 split, also announcing the share value has climbed over 10% since its last compensation report to the IRS. Airbnb is hoping to raise as much as $3 billion in an IPO this year. Coca-Cola European Partners has agreed to buy Australian bottler Coca-Cola Amatil. It creates a global producer of many of the world's most popular drinks. The deal values the Sydney-based firm at $6.6 billion, a 19% premium to last week's trade. The purchase gives the European bottling company an even larger international footprint. That's your Bloomberg Business Flash. Anne-Marie, John.
All right, London, thank you very much. Now, we're minutes away from the open. Eurostoxx 50 this morning down 1 4/10%. Up next, your stocks to watch, including Lufthansa. The German airline maps out more flight cuts. That's coming up next. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Seeing advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
6 minutes away from the opening ballot. It is not a pretty start to the week. Equity futures down 0.8% on the FTSE, down almost 2 on the DAX. More restrictions across Europe and a stalemate over in DC on fiscal stimulus plans. With your stocks to watch ahead of the opening bell, it's Danny Berger.
John, we could see airlines, specifically Lufthansa, under pressure, already falling 6% pre-market on Tradegate. Handelsblatt reporting that, according to an internal memo sent out, the airline is cutting more flights, and it's also closing large parts of its administration operations, really due to weak demand. More coronavirus cases, more restrictions means that Lufthansa under pressure. AstraZeneca, though, called higher this morning. Its collaboration with Oxford over its vaccine. The FT reporting that it had a robust immune response from elderly patients. Within those patients, they saw antibodies, T cells, all those sort of protective responses you want to see in a vaccine. Now, finally, Siemens. This one's a Bloomberg scoop. People familiar telling us that Carlyle, the buyout giant, is going to be buying their gears and transmissions unit for about $2.4 billion. John, Anne-Marie?
Danny Berger, thank you. John, I think traders are going to be happy they had that extra hour of sleep this weekend. DAX futures this morning down more than 2%. It's looking like it's going to be definitely a risk-off decisively this Monday morning.
They're going to need that extra rest. A busy week ahead, a week and a day away from an election in the United States of America. Futures lower, the open around the corner. This is Bloomberg. 60 seconds away from the cash open in Europe. Here in the City of London, good morning. Your headlines: curfew on the continent, Spain and Italy imposing the harshest restrictions since May. Getting defensive, China sanctions Boeing and Lockheed Martin. Beijing frowns upon Washington's $1.8 billion weapons deal from Taiwan. And deadlock in DC, stimulus talks stalling out a week and a day before the election. They're the headlines. Here's the price action going into the cash open. Equity futures shaping up as follows. On a FTSE, down and down hard, off by 1%. DAX futures near session lows going into the cash open. Euro Stoxx 50 futures off by 1.7%. Bid into the bond market. Anne-Marie, this has been a tough morning to wake up to so far for the equity bulls. Two big stories: more restrictions on the continent, and in the United States, the inevitable, those DC talks breaking down.
Yeah, DC talks breaking down, and COVID once again, John, becoming front and center with the White House, with key staff members close to Mike Pence getting coronavirus, and we're just days away from the U.S. election.
The FTSE down by about 0.25% in early trading. We'll get the equity benchmarks across Europe open in just a moment. I think the story of the morning is what's happening through the bond market in Europe. And what is fascinating is to see the BTP, the Italian 10-year, with a bid. Yields coming down 8 basis points. Some real sovereign-like behaviour on a really tough morning. There's the move over in Spain, off by 1.44%. Down, as I say, on a FTSE, off by 1.3%. Bid coming in to the bond market, real risk aversion. You see it at the long end of the German curve, a 30-year yield that comes down another 2 basis points to about negative 18 basis points on the session. Anne-Marie, that bid is back in the bond market for very good reason. In places like Germany, places like Switzerland, places like the United States, there is real concern about this second wave across the continent and what that means potentially for a second dip in this economy.
Yeah, certainly is. We're seeing fresh curfews as well. And in Italy, the strongest virus restrictions since they had a lockdown in May. And they had some of those draconian lockdown measures we saw, Jonathan, following the breakout in the spring.
So if you're just tuning in about a minute into the session here in Europe, this is what things look like right now. Waking up to some risk aversion Monday morning, sending the equity benchmarks across the continent lower. The FTSE MIB in Italy down 1.7%. The IBEX in Spain off by 1.4%. The FTSE here in London down by 1.2%. In the FX market, you see this reflected in a stronger dollar story. Euro dollar off by 1/3%. Cable off by 1/4. Much more pain going into the Aussie. And as I've talked about it repeatedly through the morning, it's the move in the bond market that gets your attention. 30-year yields over in Germany down another 2 basis points. In Switzerland down another 2 basis points on a 10-year. And even Italy getting a bid on some real risk aversion across Europe. That's the picture of European markets. Pressure on the ECB meeting this Thursday. Policymakers in Frankfurt likely to discuss the impact that the spike in virus cases could have on Europe's recovery and whether more stimulus is already needed. We start the conversation this morning with Paul Brain, Head of Fixed Income at Newton Investment Management. Paul, let's start right there. The pressure on Christine Lagarde this Thursday, I'm not expecting them to do something, I don't know if you are, but just walk me through how much pressure is building on this central bank again.
Yeah, I think I agree with you. I don't think there's much going to happen at this one because I suppose the rise in cases is a little bit too soon to change the direction of the ECB so quickly. But essentially, yes, you're right. If we're going back to more severe lockdowns across Europe, Europe is going to require more stimulus. But I think the stimulus is more focused on the government. So it's more like the government's doing the fiscal stimulus, providing support, than it is the central bank. The central bank has done an awful lot of work, a lot of heavy lifting in providing liquidity. There's not much more they can do. They can make sure that the wheels of the system are still working, but essentially the cash has to come from governments now directly into economies if we go into a more serious lockdown that threatens economic growth.
Good morning, Paul. Is there any doubt which program the ECB will favor? Because, of course, under the new pandemic relief program, there's a lot more flexibility on that bond buying.
Yeah, it's a good question. I think they've got enough tools to make sure that the bond market is working. And as you mentioned this morning, it is working. Italian yields are falling rather than rising. So they don't need to do too much to make sure that the very low aggressive negative yield strategy is working across all countries, across all markets. And perhaps they can do more on the corporate side. They've got various programs that enable them to buy corporate bonds. We may see more of that if we feel that companies or if they feel that companies require the cash, require the money, if they've got any problem with companies borrowing. And essentially, I think the wheels are working fairly well within Europe, within the system. Of course, they started their SURE program issuance last week. They've got a lot more to do there. That money has to be actually get out into the economy as well. So that program's going to take a while to get up to levels where it's stimulating the economy. But it's there and it's up and running, it's working. I think we're going to see more issuance coming there, obviously, and we're going to see more money flowing into the economies. But I think I'm quite encouraged that actually we are seeing broad falls in yields across the whole European sovereign spectrum.
Hey, Paul, stick with us. I just want to run through the price action just quickly. The DAX opening up down by 2.7% about 5 minutes into this session. The FTSE off by 1.1%. The pain you see, though, for the equity longs at least, is really across the European indices on the continent. The CAC 40 in Paris, France off by 1.3%. Equities really rolling over and rolling over hard, though, as Paul points out, I think it's really, really constructive on a morning like this morning, seeing this price action in equities, to still see the periphery firmer. This is about the recovery of Europe. It's not about the breakup of Europe, and that's an important distinction to make this morning. And Marie, nevertheless, to see the DAX shaving about 337 off the benchmark over in Frankfurt, Germany, it's a tough morning.
Yeah, it's a tough morning for those companies trading on the DAX. John, take a look at some of these movers right out of the gate as the DAX opens up. SAP, and we spoke to the CFO, that stock is down some 20% this morning. There you have it, a little bit over 19%. And this, of course, comes as S&P cuts their 2020 outlook. CFO Luca Mucci, though, said to us he's quite comfortable at the moment where they are. Bayer this morning down 0.9%. They're inking a deal, a biotech company out of the United States for about $4 billion. And then finally, we do have AstraZeneca getting a little bit higher, up 0.5%. Some good news on the vaccine front. Their University of Oxford vaccine, in collaboration, they've produced a robust immune response in elderly people. Yeah. And of course, this is according to the Financial Times. And we're going to be looking at, well, as Johnson & Johnson. They may be rebooting as well, Jonathan.
Let's hope we get more good news there, Anne-Marie. But to see SAP down 20% on a morning where 20 minutes ago the CFO's on this programme saying we're not unhappy with the numbers, we're comfortable with where we are. If you're an investor in this stock this morning, I don't think you're comfortable seeing it down 20% in early trading. Paul, we talked a little bit about Europe. There's a huge distinction to make between a recovery that's breaking down and the potential breakup of Europe. Now, for the places like Italy, Spain, Greece and elsewhere, as you look at the periphery, Paul, are you confident that we have made that pivot away from sovereign debt in Italy, Spain and across the periphery behaving like a credit and now starting to perform like sovereigns?
Well, I think the important distinction is that this is a European problem, not just a southern peripheral European problem, that, as it were, was after the crisis, the Eurozone crisis. And it's affecting those countries in greater numbers, of course, but I think it is something that is seen as being a pan-European problem. And the other thing, of course, is the response is pan-European. We're actually seeing joint issuance of bonds now. So I think that's a sea change, and a regime change, if you like, that was put in place in the summer to support the European bond market. And I think that's the bit that's keeping that sovereign bias to the broad European bond markets rather than just by Germany and South Italy trade, which was in the Eurozone crisis. So I think there's a clear distinction now that they're in it together. There's a crisis they're fighting together, and they're doing the ECB support, and also the fiscal support is a little bit more joined up now than perhaps it was before.
You're concerned about the supply and demand dynamics changing at the second quarter of next year. Higher inflation, higher bond yields. Why do you think it's 2Q of next year?
Yeah, it doesn't feel quite like that right now, does it? Of course, we're going into another wave of lockdowns.
Exactly.
And so clearly it's all about, how do we actually protect capital for the next few weeks and maybe a few months. But I think after that, I think once we get through this wave, if the hospitalizations don't rise to the same sort of levels, if deaths don't rise to the same sort of levels, I think we have to, we'll get more waves like this coming through. But I think the economies gradually reopen and get back to normal. It's inevitable that if you're a politician, you're not going to lock down economies unless you have to, but you probably have to just in case the statistics are wrong, etc. So I think we have to go through this phase, and then after that, we're looking at a broader economic recovery that is fed by that monetary stimulus, which is immense, and also fed by the fiscal stimulus, which is building and is still quite supportive. Will be well into next year. And it's that mix of monetary and fiscal stimulus that I think leads to the potential for a modest increase in inflation expectations. When I say modest, I think in Europe you're looking at 2%, maybe plus 2% at best, but a more consistent plus 2% rather than a 0 or negative to 2% level that we've had obviously through this crisis and the one before. So I think that's the change, that's the issue. And of course we've got a lot of supply to work through. If we've got stronger economies with higher inflation expectations and more government supply, inevitably you're going to get higher bond yields, higher government bond yields. But that can only happen if we are recovering. It won't happen this week, probably won't happen between this side and the end of the year, but it will happen as we move into a broader economic recovery next year.
We hope it will. Paul, you're going to stick with us. Paul Brain from Newton Investment Management. Thank you, sir. About 10 minutes into this session, it is a tough start for the equity market. Every single sector on a stock 600 in negative territory. Tech stocks down by almost 6%. The DAX off by 2.5%. The FTSE trimming its losses. 10 minutes in, down about 0.5%. Big week for European earnings still ahead. Big names in banking, pharma and energy report in the coming days. Up next, we discuss the earnings outlook for the continent. From London, good morning to you all. Equities lower. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you in interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
Throughout the advanced countries, the pace of economic recovery is slowing, and I can't think of any exception to that general statement.
Queen's College President of Cambridge, Mohammed Al-Arian there, weighing in on this market and on this economy. Looking at this price action this morning, it is a tough start this Monday morning. Good morning to you all. We're down 2.5% on the DAX in Frankfurt, Germany, off by about 0.5% on the FTSE. No doubt a weaker sterling helping things out, a stronger dollar through all of G10. Bit into the bond market, treasuries firmer across the continent. Big rally, Germany, Switzerland, even Italy catching a bid this morning. Risk aversion to start things off this Monday with your stock movers. Back with us, here's Danny. Hey, Danny.
Hey, John. Well, a big turnaround compared to what Lufthansa did last week when it reported narrow losses for earnings. Those shares had gained 12% last week. Today, we're looking at big declines in Lufthansa's share price, down nearly 3% after a report from Handelsblatt saying that they're cutting more flights. They're going to temporarily close some of their administration operations because of weaker demand. That all from an internal letter sent to employees. So shares continuing to lose. But look, the big mover today, by far the biggest loser for the stock 600, is SAP. The CFO telling you, John and Anne-Marie, that he's not unhappy with the numbers that they reported. Well, Oppo analysts saying it's difficult to find positive news in this release, perhaps save for free cash flow. Their cloud services business, according to Bloomberg Intelligence, it looks like they're losing some of their market share. Their Concor business travel segment, limited visibility there with continuing rises in coronavirus cases. So SAP, if it keeps up this declines, it will be its biggest intraday decline since 1996. But it's not just SAP. SAP also taking down other cloud company businesses with it, including Capgem, the France-listed business, falling more than 3.5%. This will be its biggest drop in 6 months. Now, Capgem, of course, as I said, is involved in the cloud services space. It also has a partnership with SAP as well. So bad news for SAP is also bad news for Capgem. Anne-Marie, John?
Danny Berger, thank you so much. Now, we want to discuss the earnings outlook with Europe with our guests. It's a busy week in Europe. Numbers due from a number of sectors, banks, big pharma, energy as well. Paul Bryan, head of fixed income at Newton Investment Management, still with Jonathan and myself. Paul, earlier, many were thinking that companies were sounding far less negative. SAP, though, their last outlook, they assumed economies would be reopened. It's not even November, and we have fresh emergency restrictions around Europe, record daily cases coming out of the United States. Do companies now need to start reconsidering that this is going to be painful on the economic side and on the data side in terms of the high-frequency data about what consumers can actually do and have to recalibrate their earnings outlook?
Yeah, and I think I'm probably a little bit surprised, like you are, at the reaction from companies going into this quarter. I think most of us have been talking about the possibility of a second wave. Most of us have been worrying what would happen if there was a further lockdowns, renewed lockdowns. But clearly companies probably had focused a little bit more on the recovery opportunities. And I think generally, we've all been debating V-shaped and U-shaped recoveries. I think we're looking at a U-shape or a gradual recovery that has the occasional 2 steps forward, 1 step back, and this is clearly a 1 step back. And I think companies probably maybe need to get a bit more realistic. I think the other concern is that it's just the length of this crisis, the length of this, let's say, hit to business. The longer it goes on, the greater the chance that companies won't make it, will effectively have to resort to cost-cutting, laying off staff, et cetera, and we're seeing that coming through already. And I think that's probably what companies hadn't necessarily planned for, because obviously it's too negative a scenario, and most companies don't want to do that. But we need to do that. I think that this is going to be a tough winter for the economies and therefore the companies that are involved in that. And I think as we get through into summer of next year, it's going to be better, but we've got to get through this one,
So, Paul, let's talk about how you want to allocate to a lot of these issues right now, where in the capital structure you'd like to sit, whether you want to allocate to equity versus credit. I caught up with PGIM in the last couple of weeks, and they're calling this the golden era for credit, that the C-suite will have to manage the balance sheet for debt investors and not for equity investors. Paul, what's your take on that kind of conversation? Because I'm sure you've come across it many times in the last several months. What's your view?
Yeah, I mean, just broadly speaking, I think you're better off in credit than you are in equity at this level, only because the companies that want to survive have got to pay the interest rate, got to pay the creditors, and they can cut dividends, they can pause forecasts, growth forecasts, and so on. So I think the equity share price or share price of companies is going to be a lot more volatile than credit. The investment grade credit market we find is offering less value, less opportunity than it used to, and also it's what that classic market where if we do get an economic recovery, you're going to lose money because government yields rise and you get a very high duration interest rate risk. And of course, if we do get into a much more serious economic decline, then we will see downgrades and you'll see those fallen angels, a number of fallen angels rise. So we prefer, when it comes to credit, we prefer the high yield space. So So our policy has been to build gradually exposure to the high yield market, but we have paused that because of the current mood in the market, let's say the current concern about the second wave, and also just other risks such as Brexit and the election.
Just in terms of where in high yield, Paul, the sweet spot for many people has been that double B pocket, just below that line in the sand between IG and high yield. Is that where you want to be too?
Well, more actually, I would say we'd be slipping into single B territory, and double B is what we've owned for a while because it's a safer high yield. But it's probably one that is a little bit more threatened if you do get fallen angels. It's one that has to reprice to the new supply coming into that sector. And I think it's a single B area where you've got to do your credit analysis really well because not every company is going to make it. But that's where perhaps the value is. That's the sweet spot.
Hey, Paul, great to catch up. Appreciate your time this morning. Paul Brain there, Head of Fixed Income Investment at Newton Asset Management. This price action shaping up as follows. Equities down hard, off by 0.25% on the FTSE on the continent. The DAX off the lows, but still down by more than 2%. Bit into the bond market, stronger dollar. That's how we start things off this Monday morning. Coming up on the programme, moving the goalposts. UK banks tightening lending standards for mortgages as buyers look to beat the stamp duty holiday. Up next, we discuss British banking. Right here from London, this is Bloomberg.
Home.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
Global investors tend to be very Western-centric in how they view the world. The East is nothing like that. And not just China, but a number of countries in the East have done a much better job of managing the virus without ballooning their fiscal deficits and without printing money.
That was Bob Prince, the co-CIO of Bridgewater Associates, warning of severely limited growth post-COVID outside of Asia. Here in Europe and the UK, banks are turning away mortgage applications. The Financial Times reporting that in a reversal of the cutthroat competition of recent years, British lenders are putting up rates to deter potential borrowers. Here to comment on the banks, Jonathan Tice, Bloomberg Intelligence Senior Banks Analyst. Jonathan, always great to catch up with you, sir. It's the first piece of tension between the banks and policymakers, fiscal authorities and monetary policymakers as well, Jonathan. What's going on here?
Well, I mean, the UK mortgage space has been a very interesting one because if you go to the very beginning of this year, you actually had the Bank of England telling the lenders, look, 95% loan to value, we think you guys are lending too much. And then obviously the virus struck. But because of all the pent-up demand, house prices have shot up since then. And so the lenders have already pulled back from 95%, 90%, and they're now pulling back on 75% loan to value mortgages. That all makes sense because they're looking at values and saying, no, we don't trust this market. I think the other problem is you've got a huge bottleneck in the people who are trying to take advantage of the stamp duty holiday. Basically, if you haven't got your deal done and your mortgage in place now, you're not going to make the March deadline. So not really surprising. It's something we've written a lot about over the past 6 months. So I would almost say the FT a little bit late to the party here because we've seen rates going up and up and up across the different loan-to-value buckets over the last 6 to 8 weeks.
John, we've seen rates go up, and we've seen rates go up before, and we've still seen housing bubbles carry on expanding. Not for me to say that this is one. I just wonder, John, from your perspective, looking at the financials at the moment, is there a financial stability risk building up a little bit here going into spring next year?
Well, we've absolutely got asset bubbles, and housing it was always one. Look at Sweden, look at the UK. But I think if you think about it from the bank's perspective, the bigger banks have managed to set aside a fairly hefty chunk, particularly look at Barclays last week. Bumper FIC is funded, like in the US, funded a lot of comfort and provisions. For a lot of the banks, take the Irish, take some of the smaller Spanish, we still don't know actually whether their confidence in the first half provisions they've taken will be enough because unfortunately their P&Ls are so small relative to the size of their balance sheet that even if they get it a little bit wrong, it's going to be pretty ugly. So all we're going to see is a sort of further divide between the strong banks, the Nordics, some of the larger Europeans, but not even the Santanders and BBVAs. Even there you've got an awful lot of credit risk. And the smaller, weaker banks. So there's certainly an issue for the regulator here because things like restarting dividends, you can't really tell some of the big, strong banks you can't pay anything, but equally you do not want some of the smaller banks to start paying.
Jonathan Tice of Bloomberg Intelligence, thank you for joining us. We'll have more from you throughout the week. We have HSBC as well as Deutsche Bank on tap this week for earnings outlook. John?
Anne-Marie, let's get to that price action. 26 minutes into this session, equities down. They are off on the S&P 500. Futures are lower as well as we inch towards the US Open. But here's the European session. The DAX down by 2.25%. The FTSE off by 0.4%. And in the bond market, a bid across Europe in bunds, on the periphery, in BTPs and in the FX market. Guess what? Stronger dollar story through the whole of G10. Coming up on this programme, the latest trade talks between Britain and the EU extended into the middle of this week. Up next, we speak to a member of the European Parliament's Brexit steering group, Philip Lambert. That's next from the City of London this morning. Good morning. Alongside Anne-Marie Horder and I'm Jonathan Ferro. This is Bloomberg.
to think about all the other offsets to tax. And so we're looking at it. I think we're going to be prepared. And, you know, we're modeling out a whole bunch of different scenarios. I think we're going to be well positioned no matter what the outcome is.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
"30 minutes into the open in the City of London this morning. Good morning to you all. Here's the price action. We head lower on the FTSE, on the equity benchmark in Frankfurt, Germany, on the DAX, and on the Stock 600, we're down by 0.9%. Earlier in the session, every single sector trading in negative territory. On the FTSE, it's the miners, it's the energy players. Shell off by more than 2%. Rio off by 1.3%. BHP off by 1.8%. Anglo down 1.9%. You get the picture. Risk aversion bleeding through the equity market into the bond market. Government bonds bid into the FX market, the euro softer, the dollar firmer through much of G10. That's the price action. Here's your first word news with Laura Wright.
Thanks, John. On that note of risk aversion, Italy is introducing its strongest virus restrictions since the end of the national lockdown in May. It will limit the opening hours for bars and restaurants and shut entertainment, casinos and gyms. Spain is imposing a curfew from 11 p.m. until 6 a.m. The World Health Organization is warning of a dangerous moment for many countries in the Northern Hemisphere. The deadlock over stimulus on Capitol Hill seems to be continuing. Both House Speaker Nancy Pelosi and the White House are blaming the other for moving the goalposts in talks. Pelosi says the chamber may pass a pandemic relief plan this week, but the Republican-led Senate may not act before the election. BTPs are rallying this morning after the S&P upgraded Italy's outlook. The agency left the rating unchanged but boosted it to stable. That makes a downgrade to junk less likely, giving the country some respite. Italy is one of the region's most indebted countries, with a debt-to-GDP ratio of close to 160%. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. John and Marie.
Laura, thank you very much. Those BTPs are certainly rallying, down 7 basis points on the yield. Now it's time for your Brussels edition. It's your need-to-know guide to the week ahead in European politics. The latest trade talks between Britain and the EU have been extended into the middle of this week. EU chief negotiator Michel Barnier now set to stay in London until Wednesday. Let's head to Brussels and Bloomberg's Maria Tadeo, who has an interview for us. Maria, good morning.
Exactly, Maria. Good morning to you. Extended until October 28th. And the idea here is that by mid-November, that is a new target. That is a move-in deadline. We could have something on paper that could provide the basis for a deal. And to talk about this, we are joined by Philippe Lambert, who is a member of the European Parliament, but most crucially, he sits on the Brexit steering group here in Brussels. And Mr. Lambert, just this idea that Michel Barnier has decided to stay for longer now in London, how should we look at that? How do we interpret this?
Well, that we have entered the final stretch of the negotiation. I think that indeed the British government ultimately wants a deal. So we are going to do our utmost to have one. I have limited hopes as to what that might entail, but at least now the perspective is that we might have a deal after all.
Right. You say the UK government now wants a deal, but how about Europe? Do you want a deal? And most crucially, when do we get it? Do you think mid-October? Is that realistic?
Well, there's never been doubt as to whether the European Union wanted a deal. We do want a deal, not under any conditions, but we want one. But there were doubts as to who would win in the entourage of Boris Johnson, the hardliners who actually want to cut all ties with the European Union, or those who want a more cautious approach respecting geography, in that the European Union is the closest neighbor to the United Kingdom. Now, both parties, I think, want a deal. Can we have one by mid-November? Yes, we can. The question is how deep will be this deal, and there I would have limited ambitions. I mean, this won't be as good as the membership of the European Union. In other terms, even if you have a no tariff, no quota agreement, there will still be checks at the borders, regulatory checks between the United Kingdom and the European Union, and that will indeed create friction in trade between the two.
What would you say is now the main sticking point? I wonder, because we've heard a lot about fish, and we know the French have taken a very strong, tough position on that. So what is the major sticking point that's preventing the deal at this stage?
Well, it's not fish. Fish is of course symbolically big, but economically small. The real thing is about level playing field and the way you enforce this. So it's the governance aspect linked with the level playing field provisions. And these are major sticking points because, of course, the United Kingdom doesn't want to be forced to align to EU legislation. But on the other hand, if it wants to keep access to the single market, it has, in a way or another, follow EU legislation. So how do you do that without the hard Brexiteers losing face? Well, that's the whole question.
And you talk about fair competition. So I do wonder, in a world where there's a trade deal and the UK has fully left the European Union, how much do you fear the UK as a competitor to the EU?
Well, I don't fear it. I mean, the United Kingdom is part of the single market at the moment, and we have nothing to complain about. Of course, we don't like a number of provisions of the UK labor law, but in environmental terms, for instance, well, we might see the United Kingdom being more proactive than some member states like Germany. So I'm not too much afraid of that, especially as we are talking about trade in goods, not trade in services.
And when you talk to officials here in Brussels, the more hawkish voices do say that ultimately the Prime Minister does need a deal more than the Europeans do, that this is going to hurt the UK economy more than it will hurt the EU. And this is happening while coronavirus is happening, so he has no other option but to get a deal. Is that a fair interpretation, would you say, of the Prime Minister thinking at this point?
Well, I'm not in Boris Johnson's head. I think that the predicament of the United Kingdom is dire at the moment. Obviously, and it's true that no deal would hurt proportionately more the United Kingdom than the European Union. But I think that language, to the extent that the United Kingdom is cornered and has to make all the concessions, is not conducive to a deal. So I would refrain from using that kind of language because I think it's in both parties' mutual interest to have a deal.
Mm. And I have to ask you about the calendar because here it really does matter. The transition period will end by the end of the year. So if we assume best case scenario that we do get a deal by November, when does it get put to a vote in the European Parliament and how easy will that vote be approved or be pushed through?
Well, it really depends on the quality of the deal. Personally, I have a lot of trust in our negotiating team led by Michel Barnier. So far, we have had no surprises from his side. And since he consults with the European Parliament more than weekly basis, there will be no surprises. And so I guess that the deal will be approved by European Parliament, unless, of course, we have surprises in terms of concessions made by the EU negotiators that would be unpalatable for the European Parliament. But I don't think that this scenario is very likely.
Okay, so when is the actual deadline? I mean, when's the real deadline here?
Well, actually, we really need that in the first half of November because, well, there's a due process to be observed. I mean, the Parliament is not an instance that is just a rubber stamping document. So we have to have at least 4 weeks to process this correctly. And by the way, don't forget that the British Parliament has to process the treaty as well.
Which was my next question, by the way. How problematic could that be? We know it was very problematic in the past. Do you think it can get approved easily? Is that something that worries you at this point or not?
No, I'm not worried about that. Boris Johnson enjoys a big majority, and despite all the infighting, I think that should be no problem for his majority.
And Mr. Lambert, just a very final question. If you look at financial markets, they have completely almost ruled out that we don't get a deal. They believe a deal one way or another is gonna come. They're pretty certain about that. Would you say they're wrong?
Well, again, a week ago, I thought that the no deal scenario was the most likely, and I've been thinking that for months. But then we had this late turnaround of the British government where actually they used a speech by Michel Barnier to backtrack from earlier statements. And that speech actually didn't say anything new, except that they wanted to portray it as a sea change in the EU's attitude, which was not. But that told me that actually the British government, after all, wants a deal. So I would say that the realos have won the ear of the prime minister, and therefore they are seeking a deal, which now leads me to believe that ultimately we're going to have one. Not a very ambitious one, but at least one that will avoid the UK crashing out of the transition period on January 1st.
Well, Philippe Lambert, thank you so much for joining us on Bloomberg Television. It's always interesting to see the disconnect between what you hear from the politicians and what the market is actually pricing in. Anne-Marie, John.
Maria, thank you. Great work, as always. Beyond tedious following all of this for all of us, including you, I'm sure, who's got to cover this every single day. And we have a new headline, a new deadline. The first part of November. I can hardly wait to see what happens with those Brexit discussions. Here's the price action, 40 minutes into the session in the City of London. Good morning to you all. We break down on the FTSE. We are negative on the Stock 600. We're down 0.9%. S&P 500 futures. Remember, 4-hour time gap this week between London and New York. On futures, we're down 34, down almost 1%. Bid into the bond market, risk aversion, down 4 basis points on 10s, just about holding above 80 basis points on a 10-year. And elsewhere in the FX market, the US dollar stronger against the bulk of G10. The Bloomberg dollar index up 1/3%. Coming up on this programme, we'll hear from our interview with outgoing UBS CEO Sergio Ermotti and his legacy at the bank. That's next from London. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
What would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated the dramatic impact of this outbreak.
.43 minutes into the session, equities lower this Monday morning. Here's a picture of things for you. Down 0.5% on the FTSE 100, no doubt helped out by a weaker pound sterling this morning in foreign exchange. And G10 dollar stronger on the DAX, off by 2.4%. It is not looking good across the continent right now. The CAC 40 off by 1% in Paris, France. We're down by 52 points there. Over in Switzerland, after 9 years at the helm of UBS, it's Sergio Ermotti's last week at the world's largest wealth manager. He's one of the longest-serving bank CEOs in Europe. During his tenure, one of the key questions has been whether European lenders can ever catch up to Wall Street.
Look, as you said, it's very difficult to predict, but what we see and what clients are telling us for Wall. I mean, you're going to see changes. You're going to see asset allocation shifts. You're going to see new policies being implemented. Even if the current administration is confirmed, probably they will need to make changes.
Do you think that could level? You always kept saying to me in quarterly interviews, "Oh, Manus, it's an uneven playing field. I'm comparing the wrong things." So could that be a constructive thing, where maybe the playing field gets a bit more level for Europe versus the US?
We'll see. No, I think that Europe, is it Europe improving, or is the US basically losing ground? We'll see. I think that it's difficult to see how Europe can gain grounds from where it is today without, estimated, because it's always been able to come out somehow stronger from any changes in administrations or politics. So but of course, maybe at the beginning you may see some dislocations when changes come through.
9 years, long tenancy. What did you enjoy the most in the past 9 years on the job, Sergio?
Well, I would say that I enjoyed most of the days, and the fact that it was always something new. I think that the early days was managing, the aftermath of yet another crisis for UBS, and then starting to reposition the strategy and working on the execution and getting tractions with employees and clients was the first focus. But then, over time things have changed a lot. I have to say that I'm not so sure I enjoyed that a lot, but I spent a lot of time in resolving legacy matters, so that was probably less of an interesting part, but still, at the end of the day, a necessary part of my job.
Well, if we look back at the strategy, I mean, you're probably going to be remembered most for downsizing the IB. I look at your trading background in your career. Did that give you additional insight when it came to downsizing the IB?
I think so. Not necessarily the trading background, but the fact that I've been working for many years for a very large investment bank, and also later on I was still involved in doing investment bank and investment banking businesses before joining UBS, reinforced my belief that you will need to be a one-stop shop in order to be successful in the investment banking world. And in that sense, I knew that UBS had excellent capabilities in equities, in FX, in equity capital markets, in M&A, and strong franchises in Europe and in Asia, and they were good and enough to sustain a business model that would serve well clients and shareholders.
UBS CEO Sergio Ermotti, he'll say goodbye to UBS this weekend, and that's when you can also watch the full interview then, conversation between Sergio Ermotti and Manus Cranny. And Manus has been following Sergio basically his entire helm at the bank. Now let's take a look at your week ahead. Later today, the WTO holds a dispute settlement meeting. It's expected to grant the EU legal authority to impose retaliatory tariffs on $4 billion of U.S. exports. Then tomorrow, HSBC, they had up a long list of banks reporting this week. We're going to be watching also for earnings from Santander and Mediobanca. And then on Wednesday, the CEOs of Facebook, Twitter, Alphabet, all expected to testify before a Senate hearing on hate speech, misinformation, and privacy on their platform. And then, of course, what Jonathan and I have been talking about all morning, Thursday, the big one, the ECB rate decision. It's the comments. We want to hear from President Christine Lagarde, who's about to celebrate her first anniversary at the helm. And then on Friday, another slew of bank earnings. BBVA, CaixaBank, NatWest Group, Banco Sabadell, they're all reporting. So a very busy week in terms of central bank and earnings. And joining us now is Richard Jones, Bloomberg's MLive FX and rate strategist. Richard, let's first start with the price action today. Lower equities, lower yields. You say this is the blueprint for what's to come. Explain.
Yeah, good morning, Anne-Marie. Yeah, I think what we're seeing today in stocks and in the drop in U.S. Treasury and German bond yields today, I think it could be a blueprint for the price action that we're going to see in the coming weeks and months. I mean, I think what's happening specifically today is I think there's disappointment that it looks like we're not going to get near-term fiscal stimulus in the U.S. I think there's finally the market has given up hope on that. But also, I think you combine that with just the sheer scope of the pandemic surge in the U.S. and Europe. It's starting to become really evident to markets. I think every day goes by, we get record daily infection numbers on both sides of the Atlantic. You've got governments unable to sort of stem the spread of the virus, and I think all of this is starting to sink in with markets. And so, I think there's still optimism out there that perhaps if we do get this blue wave that a lot of people are talking about, that fiscal stimulus will be coming in the U.S. But it's not going to be a near-term thing. I think we probably realistically only see a robust fiscal stimulus in the U.S. in the early spring. So that means a long winter ahead of us. I think that markets are...
I think we just lost the line there with Richard Jones, our Bloomberg MLive reporter. Richard Jones there on the markets. Rich, great to catch up with you, sir. At least I didn't get to talk to you. Though, Anne-Marie, I think the key story for me at the moment is not what's happening in equities we break down. It's what's happening in the euro, or rather, what isn't happening. It's pretty clear right now that the euro and the European economy is facing some real challenges. Euro-dollar still north of 118. We've got a second wave, potentially a second dip, and we have a resilient euro in the middle of that over the last several weeks.
Yeah, certainly, 118.21. It's only a little bit softer against the dollar, but it's still pretty strong. You have to think, John, what does this strong euro say to Christine Lagarde when she meets with the Governing Council on Thursday? Are they going to have to do another, coming in with verbal intervention if the euro continues to go towards that 120 level?
That's the conversation for Thursday. Up next, away from the markets, a special guest will be joining us. There's a reason I'm here and Matt Miller is not, and that's because Matt is a new father. We can do that next on this programme, and hopefully we can hear a little bit on the markets from Edna. We'll do that next right here on Bloomberg.
We explore the trends, investments and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Two really important things to do here. First of all, we start with the price action. 54 minutes into the session, equities down, off by 0.1%. In Frankfurt, Germany, the DAX off by 2.2%. In Berlin, Germany, doing his part for the demographics of Germany, our anchor of the European Open and brand new father, Matt Miller, joins us right now. Matt, congratulations, sir.
Good morning. Good morning. Thanks so much, John. Really pleasure to be on my show with you, and of course the probably greatest pleasure of my life so far to see this little packet of joy born on Friday night. Really an overpowering moment, and puts a lot of things into perspective.
Matt, she's so adorable, and I remember, oh, look at her there. Oh, Matt, it's very, very cute. And I remember actually when you and Maru met. I was there that evening, so it's kind of nice to see it come full circle. Matt, since you are in Germany, what's the latest on the COVID restrictions? Jonathan and I have been talking about what's going on in Italy and Spain and the UK, but what's the latest out of Berlin?
Well, before I get to that, I'll just point out, Maru and I met probably in the most markets way possible. She was touring the floor of the New York Stock Exchange, and I was working down there. 8 years later, we give birth to a 7-pound, 6-ounce baby in Charité Hospital in Berlin. In terms of what's going on here with the coronavirus, of course, just like the rest of Europe, it's getting worse and worse. And because my world now fully rotates around babies, my immediate thought was, I wonder if more people are going to have babies, as we go back into lockdown. But I saw a really interesting study a couple of days ago that fewer people are going to be, or that people will be having fewer babies because they're going to wait longer to get married.
Matt Miller, we've got to let you go, sir. There's still a hard break, but it's fantastic to catch up. Congratulations. I remember some of the nights out we've had, and here we are, Matt Miller, a new father, and getting me to fill in as well. I'll be filling in all week with Anne-Marie Hordern. Looking forward to doing that for you through the rest of this week. Thank you for choosing Bloomberg. Coming up next, much more still to come on Bloomberg Surveillance with Francine Lacqua and Tom Keene, with equities down hard as we kick off trading this week. Equities lower off the back of more restrictions in Europe and a fiscal stalemate in the United States. 8 days to go until that election wraps up. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Viral surge in the West. Spain declares a state of emergency and a national curfew. Italy and France post record infections. U.S. cases hit a record for the second day. Vaccine hopes. AstraZeneca's candidate produces an immune response in the elderly. J&J says its first batch may be available by January. And blame game. Nancy Pelosi and Mark Meadows accuse each other of moving the goalposts on stimulus. The House Speaker says the chamber could pass a pandemic relief plan this week. Well, good morning, everyone, and happy Friday. The clocks have changed in Europe. They have not changed yet in the U.S.
Right.
Tom Keane in New York, Francine Lacqua here in London. Tom, there's a lot to talk about. So I was looking at our top stories today. We do need to mention Brexit just because they're still negotiating. We need to look at European stocks because of SAP. But really, it's 8 days until November 3rd. And we all know what happens on November 3rd.
Beatles 6, 8 days a week. That's what it is. It's truly an 8-day week in the United States. No question about that. On a Monday over to that first Tuesday of November. The news flow is still extraordinary, but I've really got to go to the markets, Francine. The risk-off feel here is tangible. You saw what SAP did in Germany. That was ugly. What if you bought shares Friday? Ooh.
Yeah, and actually, we understand that it could probably infect or at least touch a lot of the other European stocks. And then we have that IFO, October German business confidence, 92.7, pretty much in line with estimates. Now, we'll have a look at the markets shortly, but now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom. House Speaker Nancy Pelosi says the chamber could pass a pandemic relief package this week. Still, a deal with the White House remains elusive, and the Republican-led Senate may not act before the election. Both sides accuse each other of, quote, moving the goalposts on the legislation. President Trump's chief of staff, Mark Meadows, says the U.S. is not going to control the pandemic. Meadows told CNN the government's response will be focused on vaccines and treatment, not containment. Meanwhile, Vice President Mike Pence's chief of staff and 2 other staff members have tested positive. Pence's latest test came back negative. In the Senate, a final vote is set for today on Amy Coney Barrett's nomination to the Supreme Court. Confirmation is all but assured. Senate Democratic leader Chuck Schumer accused Republicans of using raw political power to get Barrett confirmed before Election Day. And the British government is indicating it's optimistic about a trade deal with the European Union. The latest round of talks between the UK and the EU has been extended into the middle of this week. Earlier this month, Britain temporarily walked away from negotiations for a free trade agreement. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. Let's get right to it. Bid away. There's no other way to put it. Risk-off feeling. Those are S&P futures, negative 32. Dow futures, negative 265. Let me give you those levels. 3420 mid-range in the range-bound September and October for SPX. Dow 27,927 as well. NASDAQ 100, of course, with a hit. Francine's watching the DAX. I'll let her chat up SAP. In Europe, yields come in 4 basis points. 0.80, make it 0.81%, 0.81% on the 10-year yield. Dollar strength, it's all correlated up. I would note, Francine, Turkish lira off of an incredibly difficult weekend for Mr. Erdogan, and particularly with Mr. Macron of France, blows through 8 to an 8.05. I haven't done the chart work there, but that is log convexity to a fare thee well. Francine?
Yeah, we need to spend a lot more time looking at Erdogan and, of course, his spat with the French. I'm looking at European stocks down, U.S. futures also dropping. Now, there are 2 things, Tom. First of all, coronavirus infections continue to climb. It's difficult to see how governments in Europe are, handling this and whether we'll have to go into another lockdown. Investors also doubting that D.C. lawmakers will reach an economic stimulus package anytime soon. And then look at this. German software maker SAP plunging more than 20% after cutting its revenue forecast, also saying that the pandemic will continue to hurt business, and that's filtering through to a lot of the DAX and also some of the other European stocks. Now, let's get straight to the IFO Institute. Business confidence in Germany fell in October. It's pretty much in line with estimates. If you look at that business confidence, it came in at 92.7 instead of the estimated 93. Well, joining us now is Clemens Fuest. He's the IFO Institute president. Mr. Fuest, always great to speak to you. So thank you so much for coming on. When you look at the number of infections, when you look at the number of restrictions that governments are imposing in Europe, what are the chances that we now get a double-dip recession?
Well, the risk is certainly rising. What we see is a very heterogeneous impact. I think we see a continued recovery in manufacturing. The question is, will this go on now with these rising infection numbers? But certainly a strong blow to services. So for Germany, we don't see a double dip yet, but the risk is certainly rising, no doubt.
What makes you worry about the coming weeks and months? I know we're 8 days away until the U.S. election. How does that change the fortune of German car makers and European exporters?
I think the U.S. elections are, of course, tremendously important, but the impact in the short term is limited. Of course, the medium-term outlook for car makers does depend on whether Trump is reelected or not, but the Democrats are not so much less protectionist. So this risk remains. I think what's worrying at the moment is really the rise in infections. It is unclear what could stop that, and that will have an impact on the recovery.
Clement, it's a completely unfair question, but you're such a trooper, I'm going to ask it anyways. I don't want you to play sell-side equity analyst, but the surprise of the SAP pandemic view, is there more of that to come in November?
I think it's clear that we are going to see downward revisions in many businesses. The question is how strong they are. I don't know. I'm no expert on the IT industry, but the key question is really, can the IT industry insulate itself from this shaky situation? I have to say, I doubt it. But as you say, it's very hard to make predictions here.
It's very hard to make predictions, but then across all of the landscape of Germany, forget about IT, look at the industry, look at small business as well. We have the same issue in America. Are we just grossly misjudging the revenue expectation across our nations?
I'm not sure. So there will be a strong impact of the current situation on everything that's called social consumption. But for Germany, for instance, we are talking about 6% maybe of GDP. So if that declines, the impact is limited. We've also seen that reestablishing the border crossing value chains has worked quite well in manufacturing. So I think we shouldn't be overly pessimistic, but it's clear. I mean, these partial shutdowns we're seeing at the moment don't help. Still, my hope would be that a lot of businesses have prepared and are now ready to deal with the situation and to operate under more difficult conditions.
But, Mr. Fuest, what are companies telling you would be the correct way of dealing with the virus? So the number of cases are going up. Is it partial lockdown? Is it no lockdown? Or is it full lockdown because you get out of it quicker?
I'm afraid there is no consistent answer here. My view is that we need stronger lockdown measures, but differentiated ones, and measures that enable us to do things rather than preventing us from doing. So more testing, masks are very important, face masks. We need to keep the economy going under these conditions.
But, Mr. Fuest, when you speak to manufacturing companies, do they have a different view to services companies? Where's the divide on what companies need and are asking of the government?
I think the manufacturing companies would be worried if there was another closing of borders, if they would have to stop operating. For services is different. I think many services companies are aware that some of their operations, everything related to services with high contact risk, will be affected.
What did you see on trade front? What did you see from Germany on the mood of the export juggernaut?
I mean, that's been driving the recovery. Exports, for instance, from Germany to China are above last year's level. So that's been very positive. And generally, border crossing, value chains, trade has recovered quite well. That's also because manufacturing has recovered in all countries. So that's rather positive.
Thank you so much. Clement Fuest joins us from the IFO Institute. Thrilled that he could join us today. This is an important headline and, of course, speaks to the times. You've got to believe there'll be other headlines afterwards. UBS of Switzerland set to boost fixed pay and cut bonuses in compensation revamp. I immediately went, Francine, to a number of stories vintage 2011. I recall very clearly Andrew Ross Sorkin writing this up in 2011, a lot of Bloomberg as well. Francine, this has been tried before. There's no other way to put it.
It's tried before, Tom. Now, we need to understand why they're doing this, and I need to dig a little bit deeper. But remember, it could also have something to do with some of the bankers that have left and weren't able to claw back their bonuses. So because of deferred pay, I think it's a different story to what we saw in 2008 and 2009. So something that we need to keep an eye on. But again, the rules have changed on how you pay out bonuses, Tom. So I don't know whether we can bring it back to 10 years ago and say it was a failure then and it's a failure now.
Should we do a data check?
Well, actually, there's only one story in town.
There's only one story in town,
Bloomberg,
folks. You know, technology earnings, no. You know, the election, no. You know, pandemic, state of the Queen's health. I mean, Francine, please.
I mean, how cute is she? She's Edna Miller, and she's the firstborn of our Matthew Miller, who's off this week to be a father.
See,
Matt Miller, anchor and father, Tom. I feel like, certainly our congratulations go to him and his lovely wife,
This
Mario.
is great. 7 pounds 6 ounces, and of course, named after the richest grandmother. Brilliant! This is Bloomberg. Good morning.
We don't even have the bill yet because Nancy Pelosi, and she's coming up. I know she can speak to this, but we've continued to make offer after offer after offer, and Nancy continues to move the goalpost.
We're waiting for the final.
Well, they said they would, and you're waiting to see it on paper.
They haven't yet. And also, same thing. They keep moving the goalpost. We want it the sooner the better, and that's why we're making concessions. We're making concessions too.
Mr. Tapper over on CNN with Speaker Pelosi. Buried in the headlines this weekend below the fold, Speaker Pelosi's made clear she will attempt another 2 years as Speaker of the House, assuming a Democratic majority. I believe she's 80 years old and spirited, as many of them are older than that. Joining us now, not 80 years old, but feeling 80 years of political anxiety that we've all gone through the last number of weeks. Rupert Harrison is with us, BlackRock Multi-Asset Strategies Portfolio Manager. We could spend the entire time on multi-asset portfolios, but really his political expertise, his public service to the United Kingdom is noted in this political season. Rupert, your observation of a U.S. election 8 days away, it certainly looks distinctive from 2008, from 2012, and certainly distinctive from 2016. What is the character of this election that you see?
Well, look, in terms of the likely result, we don't feel like we have an edge, but you've got to look at the polling. The polling is very, very different from 2016, and the very high probabilities attached to a Biden presidency look realistic. I think the difficult thing for investors is that it's not really just about the presidency. Almost more important is what happens to the Senate. If you're trying to look ahead for the kind of macro impulse coming out of the U.S. economy, the impact on the global economy, the difference between a Biden presidency with a Democrat Senate and a Biden presidency with a Republican Senate is absolutely at the extremes, particularly when it comes to fiscal policy. And that is absolutely the key margin for us. So if you get a blue sweep, I think that the fiscal impulse in the US could be the trigger for quite a big reflationary wave around the world. You could see assets like emerging market equities that have lagged really starting to see those flows based on those expectations. If it's a Republican Senate, you've got to assume there's going to be some pretty obstructivist fiscal policy coming out of the Senate, and that's a very, very different world.
I can't imagine the number of meetings you've been in with Mr. Osborne and the others over the special relationship. How will the special relationship change?
I don't think it will change that much. I think you always get a lot of personality-based speculation about, does Boris Johnson hope secretly that Donald Trump will win? Is he going to have a difficult relationship with Joe Biden? I think this speculation in advance almost always turns out to be wrong. People said, "Oh, well, will David Cameron find it difficult to get along with Barack Obama after he had a strong relationship with Gordon Brown during the financial crisis?" And actually, they got along extremely well. I think most of the time, a UK Prime Minister and a US President will find a way to work it out. I think the mutual interests are strong enough. So I would aim off for any predictions of a difficult relationship over the next few years.
But Rupert, the UK press, or certain people in the UK press, keep on saying that basically, number 10 is buying time with the EU, because if it's a Biden presidency, then they'll give more concessions in the EU, because it's highly likely that they'll get a better deal between the US and the UK moving forward. Do you think there's any truth in that?
I don't think so. I don't think the timing works. I think that this EU Brexit deal is going to get done in the next few weeks. And I don't think there's going to be enough smoke signals from a new president or from the re-elected President Trump to guide those negotiations. And the reality is, I think everybody in Whitehall knows, who are anywhere close to this, is that a US-UK trade deal is going to be determined largely by what Congress is going to sign up to. And that is really not going to be hugely affected by who's the president. So, I don't think that's the driving force. I think that what's determining the nature of this end game in the Brexit negotiations is all about the theatre. It's all about how you present this final deal as a great deal for the UK. I think the shape of that deal is now pretty much determined.
Rupert, what does this all mean for equities, but in general, actually, asset classes? What do you buy right now?
Yeah, so we are still broadly constructive on risk assets, particularly equities. One of the things we've been doing in portfolios over the last few months has been bringing down that bias towards growth and quality that has served a lot of investors well over the last few years, and trying to flatten up by buying cyclicals, value, even buying European banks, which have been a pretty unloved asset class. Now, that hasn't necessarily worked, particularly on the European side, the last few weeks, but we still feel like there are significant upsides here. First of all, the global macro momentum and that sort of reflationary momentum is intact. We don't think the virus is going to knock that off course this winter. And then there's also, you've got a position for some potential upside. We are going to get very, very important news in terms of the efficacy signals of these vaccines from phase 3 trials coming through in the next few weeks. And those are potentially game-changing. And I don't think you want to be caught on the wrong side of that.
So then how do you position in terms of the actual asset allocation you and others are doing, Russ Kostrich and others at BlackRock? What are you actually doing in the equity bond mix, and particularly the sector mix?
Yeah, right. I mean, I can speak to the portfolios that I manage. I think that on the equity bond mix, it's a different world. The correlation has been much lower. the volatility on bonds, government bonds, has been so much lower that I don't think you can expect government bonds to provide you the same kind of cushion in a multi-asset portfolio as they used to. So you've got to think, I think, a little bit more inventively about diversification. At the same time, we're quite happy holding treasuries and government bonds because the downside risk seems pretty low. I don't think we're going to see a big spike in yields because I think the Fed and other central banks are not happy to see, particularly on the real yield side, a big spike in yields. When it comes to within equities, as I say, I think we are looking to buy to sort of flatten up what for many investors, including us, has been an underweight to value and to a certain extent underweight to cyclicality for some time. I think that we've been buying for some time over the last few months home builders, industrials, European banks.
Right.
That's where it seems to us that the value trade could be. Now, of course, there is this big binary event coming up, the US election, and historically the evidence is that for those big risk events, there's a premium to holding assets through that event. You don't really want to de-risk ahead of these big risk events because historically that's when you get a lot of returns.
Rupert Harrison with us with BlackRock. He will continue with us. Much to talk about. We'll take a more UK tilt. Francine's threatening to talk about Brexit and fisheries off the coast of the North Sea. Rupert Harrison, expert on the fishing law of the Channel and the North Seas and the Irish Sea as well. In our next hour, really a look at this economy and the linkage into the markets. Carl Weinberg joins High-Frequency Economics. A difficult day, risk-off, futures at -30. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
This is a market that over the past few weeks has made it clear it wants to go higher.
It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg Surveillance, I'm Ritika Gupta with your Bloomberg Business Flash. China will impose unspecified sanctions on American defense contractors Lockheed Martin, Boeing and Raytheon. That's after the U.S. approved a $1.8 billion arms sale to Taiwan last week. China's foreign ministry says the sanctions are needed to, quote, uphold national interests. Carlyle Group is in talks to buy Siemens' mechanical drive business for about $2.4 billion. Bloomberg's learned that the sale of the German engineering firm's Flender unit could be announced this week. Flender makes gears and transmissions used in everything from cement production to beer making. And that's your latest Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Let's do a data check right now. 31, negative 31 on SPX with lots of correlation and 4 basis points on a 30-year bond, 3 basis points on the 10-year bond, putting that at 0.81%. Still a higher yield regime. The pullback is very much center tendency off a trading range of all of September and all of October as well. We leap into November here in a bit, and we do so flat. Dollar, a little bit of strength here. Yen, 104.87 gets my attention. And as I mentioned earlier, a very difficult day for a weaker Turkish lira. Francine?
Yeah, on to November and on to November 3rd, Tom. And, ahead of that, there's only one game in town, and that's the election. How it will change it. We look at the polls and, of course, the impact on the sectors. European stocks are dropping. A number of infections because of coronavirus continue to climb. And, of course, there's a number of new restrictions that came over the weekend. And then SAP, the German software maker, plunging 20%. We also have a great story on UBS set to boost fixed pay and cut bonuses in this compensation revamp. Coming up in the next hour, we speak about green initiatives with Paul Polman, former Unilever chief executive. This is Bloomberg.
You can get a warm burger, soba noodles, even a bowl of curry rice. In a city like Tokyo, vending machines seem to be everywhere. There are literally millions in Japan, and it's a big business, selling $44 billion of goods in 2016. With COVID-19, those sales are slowing down, which means getting rid of unprofitable machines. Vending machine sales were already falling even before COVID, with competition from convenience stores that are open 24/7 and have way more options. But there is hope for some of them. About an hour away from central Tokyo is the Retro Vending Machine Park. Here you'll find 50 or so machines side by side selling some quirky items. Turning vending machines into tourist attractions may not be a solution for bigger business, though, since it requires labor and efficient distribution. Saito says it takes 5 people a day to restock his machines, just in time for lunch.
I am David Weston, Bloomberg.
can gain grounds from where it is today without, a significant shake-up of its, system, and the U.S. is still not to be underestimated because it's always been able to come out somehow stronger from any changes in administrations or politics.
Good morning, everyone. Francine Lacroix and Tom Keene there. The gentleman exiting at UBS, Mr. Armati, a really interesting Monday. Yes, it's an 8 days a week Monday into Tuesday. There will be a special talking about Mr. Armati and, of course, his tenure at UBS. Look for that this weekend. Also with that, a headline. Guess you see that given the challenges out there. They had a great chart up in Francine's earlier hour of the decline in the bank index in Europe. 39%, I believe, is the statistic year to date. And with UBS, you see it shift to fixed pay off of bonuses, or at least that's the hope and prayer of management. Usually that doesn't work out so well. Francine, futures, negative 31.
Yeah, and that's partly to do with the number of cases, of course, increasing around the world in terms of COVID, and it's partly to do with the fact that markets are just not expecting a stimulus package out of the U.S. Let's get back to Rupert Harrison of BlackRock, who's still with us. We touched on Brexit, and we talked a bit about the U.S. election. But Rupert, when it comes to Brexit, first of all, I'm looking at the latest report saying that COVID has dragged 2 million more UK adults into financial troubles. The government is dealing with Brexit, and it's dealing with COVID. I mean, what would be the elegant way to deal with Brexit to make sure that, then COVID doesn't put too many people in distress?
No, I think the overwhelming incentives for both sides in these Brexit negotiations is still to get a deal. And I think that is what we're going to see in the next few weeks. So, as you say, COVID provides a backdrop that there was some speculation earlier in the year that said, well, the impact on the economy from COVID is so bad that therefore the additional impact from a disruptive no deal on these trade negotiations would be hidden in the mix, and therefore they can get away with it. I don't think that's how they're thinking. I think that they don't want to have that distraction. And also, when you look at the details of how close the two sides are now, I mean, the remaining issues around fisheries, around the details on state aid and enforcement, these are relatively small differences. And there is so much that has been agreed. All of the incentives on both sides, I think, are now heading towards a deal.
What does it mean for how the government then steers this economy afterwards? Are we going to see tax hikes, tax cuts? I mean, they basically need to rebrand the UK.
Yeah, so there's a huge attempt going on at that. So we've just seen a trade deal signed with Japan, mostly replacing what was in place from the EU, but with some tweaks. I think there will be a huge amount of focus on technology and investment in technology and infrastructure in the UK. I think the government in the UK is going to remain very committed to this levelling up agenda, which is a very politically salient agenda in the UK about trying to bring up regions of the country that have been left behind. But the most important thing in terms of the short term is that the Chancellor, Rishi Sunak, is continuing to keep the taps open. And I think we saw that, just last week, he had to come back and tweak his part-time work support scheme in the face of worsening virus problems, in the face of increased restrictions in parts of the economy. We still have a very, very generous, as a result, a very generous fiscal situation in the UK supporting incomes. And actually right across Europe, that is the crucial issue, that even if we get weakening in parts of the service sector over this winter period, the fact that governments are supporting the incomes of people in those sectors and supporting businesses in those sectors should limit the knock-on impact on the broader macroeconomy. And that is really the most important thing.
Rupert, to me it is so important that the great bargain here, down the road from Brexit, down the road from this horrific natural disaster as well, is the idea of a greater Great Britain, of a Great Britain capturing Pax Britannica, capturing the global reach that it used to have, versus the fear of a little Britain. How is that bet going?
Yeah, I still think that the instincts of most British politicians and the institutions that run the British state are internationalist. I think that we are going to, and I certainly think those are the instincts of Boris Johnson. So I think that we are going to see a sort of continued emphasis on Britain in the world. I think we're going to see an assertive foreign policy as the UK works very hard to demonstrate that it's not taking a step back from the world. I think we're going to see a big focus on trade deals to the extent that those can be done. It's not a great global environment for trade deals, to be honest. And obviously, we wait to see what happens out of the US election. So I think that is going to be the focus. I think that there is a domestic political agenda around reassuring the public around immigration and migration that will continue to be a focus. But I think that they will work very hard to try and ensure that doesn't distract from a broader message that the UK is open for business.
As a foreigner, can the new Labour Party do that? Can the new Labour Party maintain a Labour heritage domestically and a global reach?
That's a very interesting question. I think that would certainly be the ambition of Keir Starmer. Look, I think the answer was totally different under Jeremy Corbyn. Right? Jeremy Corbyn would have had a foreign policy that would have put the UK totally out of line with the entire Western world, particularly when it came to Russia, when it came to Israel, when it came to the US. I don't think that is true at all. I think Keir Starmer is fighting to pull the Labour Party back into something that looks like the centre ground. I think that sort of foreign policy risk has gone away. I think that the Labour Party now is just more of a traditional left-wing party. It wants more spending, it wants redistribution, higher taxes. I don't think you'd see a big change internationally, apart from a greater emphasis possibly on human rights as part of foreign policy.
Rupert, I'm looking at some of our top headlines, and there's so much news coming at from very different sides. But China is always at the forefront of some of the big changes, be it debt concerns, debt relief, or actually with the new growth plans, it could become a bigger economy than the U.S. in the next decade. How do you play China?
Yeah, it's a very tricky one, and it's a very tricky one, particularly coming up with this U.S. election, because of course we've got a pretty binary outcome here when it comes to the presidency. And I think if we stick with the most likely outcome at this stage, which is a Biden win, I think you do get, in the short term at least, a big relaxation of some of those tensions. You're not going to see some of the tactics, at least, that we associate with the Trump presidency when it comes to US-China relations, even if the underlying pressure within the US political system coming out of Congress is for a pretty tough stance on things like human rights, technology, intellectual property, and so on. So I think in the short term, you could see quite a big relief rally from some of the assets that have been particularly affected by some of these short-term tensions. And that's something that we're certainly looking to position for. I think that more broadly, Chinese bonds continue to be something that is potentially an attractive ballast in portfolios, particularly when yields elsewhere are still so low. And we still see the broad macro situation in China is relatively benign. Again, looking around the world for growth, there's certainly sources of growth in China.
And Rupert, finally, lira weakening past 8 per dollar. Is there any incentive for investors to go back into Turkey?
Well, not at this stage from the long side. I mean, I still see this as a bit of a slow motion car crash. The Turkish government continues to take an approach that I don't think is going to resolve this easily. I think we could end up with a pretty difficult situation for the Turkish government and potentially the involvement of the IMF down the line. As an investor, it is very expensive to try and play this from the short side, and so it's a very, very difficult market to play. But at the same time, it doesn't feel like this is going to end well.
Rupert, thank you so much. Rupert Harrison, their BlackRock Multi-Asset Strategies Portfolio Manager. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. House Speaker Nancy Pelosi and the White House accuse each other of doing the same thing when it comes to a pandemic relief plan. That is, quote, moving the goalpost when it comes to what's in the actual legislation. Pelosi says the House could pass a bill this week. Still, an agreement with the White House isn't certain, and the Republican-led Senate may not act before the election. Coronavirus cases are surging again in the two countries at the center of the initial wave of the pandemic in Europe. Italy is introducing its strongest restrictions since the end of a national lockdown in May. Meanwhile, Spain also will impose new measures, including a curfew.
Por tanto, aprobamos de nuevo el estado de alarma.
We declare, once again, a state of emergency because it is the most effective way to slow down the contagion curve and keep the virus away.
Germany will consider its next steps at a meeting today. Joe Biden calls Republican questions about his son Hunter's business deals a smear campaign. The Democratic presidential candidate also told CBS News that the release of documents allegedly belonging to his son may have been part of a Russian disinformation campaign. Biden's claim has not been substantiated. And more deliberate blackouts in Northern California. The state's largest utility, PG&E, cut power to 1.1 million people to prevent live wires from falling into dry brush and starting wildfires. Winds as high as 50 miles an hour swept through an area north of San Francisco. The blackouts may last until tomorrow. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. A lot on American politics coming up as well. Martin Schenker will join us. A lot of other good guests to begin that 8 days to the election as well. On a pandemic and a really, really challenging weekend for news there. Ireland in lockdown. Andrea Emin will join us from the European Center of Disease and Control, the director. The timely conversation, to say the least. Stay with us with futures at -32, Dow futures -256. This is Bloomberg.
나주르 주르 포나주르 수분 충전 포나주르 톡톡 찹찹 포나주르 피부 좋아 포나주르 너도 나도 포나주르 보라 포나주르 주르 포나주르.
I think what we want to do is take a consumer-first approach. We really want the consumer to guide us on how they want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Tom Keene in New York. Tom, we know the virus is continuing to ravage the West. Spain has declared a state of emergency and launched a national curfew, while Italy has implemented the tightest curbs since May. Now, global infections are over 43 million. Joining us now is Andrea Ammon, European Center for Disease Prevention and Control Director. Thank you so much for joining us today. There are many questions that people have. The first one, is this a second wave? Is it the continuation of the first wave, but is it less deadly than what we saw back in March and April?
Okay, I think there are different philosophies how to call it, but in any case, it's an upsurge of cases. Whether it's second wave, first wave, third wave, it doesn't matter. What we are seeing is that due to the expansion of testing, the majority of new cases is among adults or people younger than 50 who have less risk of severe disease. So the reason why the hospitalization rates and intensive care unit rates are still not as high as they were in spring is due to the fact that it's now a different population that gets actually tested and is diagnosed positive. However, we see in several countries now that the rate in elderly is rising, that the hospitalization admissions are rising, and also that the mortality is increasing. So it is a serious increase in transmission in the countries.
Andrew Ammon, do we have any sense of how much of the population has already had the virus and can't catch it again? And does that dictate how we should be dealing with these restrictions and lockdowns in Europe?
I mean, from a lot of questions around the immunity are still not answered. But from what we know from the studies that have been done, the assumption is that overall it's about 15% of the European population that has been exposed to the virus.
Dr. Ammon, Tom Keene in New York, good morning to you. We just assume the Germans get it right. There's something about German engineering, whether it's automobiles or medicine, and you know it's a lot of hard work and organization. What is your single message to continental Europe and to a United States embarrassed on how to get organized to get this contained?
A very difficult question, because I don't know exactly how the colleagues in the US are approaching this. I only can say that in the EU that countries have followed after the loosening or easing of measures in May, June, have followed the expansion of testing and contact tracing. However, apparently some of the easing of the measures was a bit too enthusiastic. So we're dealing now with an increase in cases.
Part of your original research was on the chronic condition of the liver. Tell me about the chronic condition of people who are younger and the belief of many in America that they are discrete and separate from old people with this virus. If there's a lot of young people getting sick, what does that mean for the older people that are still alive?
Well, in general, the people below 50 have a lower risk of having a severe disease, getting admitted to hospital or die. That doesn't mean that they cannot get severe disease, go to hospital or die. So I think we have to be very, very careful here to say that someone who is below 50 and gets sick is automatically safe. We have also among younger adults cases who have no underlying disease and who died.
Thank you so much for, of course, the grim update. Andrea Ammon, their European Centre for Disease Prevention and Control Director. Now, coming up in the next hour, Tom, we continue tracking COVID-19 with Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. That's at 6:30 a.m. in New York, 10:30 a.m. in London, as we still try and figure out exactly when the vaccination would come, and we try and figure out really to what extent this, will affect some of the younger population as well. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg survey. Analyst Francine Lacroix in London. I'm Tom Keene in New York. Of course, the distractions of an American election. We digress for a moment, as we should much more in normal times, to the collapse of Turkey, with Turkish lira at 8.03, the litmus paper of a system under stress. Onur Ant drives forward our Istanbul coverage. We're thrilled he could join us briefly here this morning. Onur, what I see so much is Mr. Erdogan playing to the domestic politics, including his meeting with the Armenian Patriarch a few days ago. Explain to our international audience the domestic pressure Mr. Erdogan is under to play to his core audience, his core constituency.
I think the pressures that he's under is very much similar to the kind of pressures facing politicians around the world. He is facing the impact of coronavirus on the economy, which was already not doing great, to say the least, before March. And his effort to jumpstart the economy has somewhat resulted in a backlash in terms of investors, also Turkish residents, selling off the lira, which, as I said, is now trading at record lows against the dollar. So he's at a tough place. He wants to revive the economy. Of course, that's important for his core electorate. Also, people that vote against him. But at the same time, he needs to treat a careful line because the lira is not behaving well, and it has implications for the entire 83 million population in terms of living expenses and people's ability to repay debt, especially affects that of companies.
Onur, when you look at what the central bank can do, what are their options right now?
The central bank was very much expected to continue what appeared to be its return to orthodoxy last week, but it seems to have disappointed markets deeply when it went for another sort of backdoor channel whereby it can continue to tighten its policy without really resorting to an outright hike to its benchmark policy rate. So we know that it's keeping a close eye on the lira, and it's very much uncomfortable with the current levels. But whether or not it's ready to do what it did in September in terms of tightening, it remains to be seen. We're going to see that in about 4 weeks.
Onur, a very unfair question, but I'll take a stab at it. Do we have an understanding of the degrees of freedom Mr. Erdogan and his central bank have? Do we understand what's in the piggy bank in crisis, or their ability to reach out to, say, the International Monetary Fund?
Well, we've heard many times from both Erdogan and his allies that Turkey doesn't feel the need to go for the IMF. And to be fair, they've lasted a lot longer without an IMF help than what people thought they could do without an IMF help. Mm-hmm. But in terms of the freedom of choice of what the central bank has to do, it's a tough question. We know a lot of people question the central bank's ability to act, but it did at one of the most unexpected times. Yet it didn't act just last week when everybody was expecting it to act. So really difficult. We know that there's a credibility gap, which is cited by the IMF and others. When it comes to central bank, it remains a very unpredictable bank in terms of what it's going to do next.
Unreal. Onur Ant, thank you so much. Greatly appreciated. Istanbul Bureau Chief. We could go on forever here, but we won't. Turkish lira, I just did a big fancy study, Francine, of lira depreciation back 7 years, and it is shockingly on trend of just a persistent depreciation from under 2 lira per dollar to 8 lira per dollar.
Yeah, Tom, what's interesting is really if you put if you juxtapose what's happening with the economy, what's happening with the currency, and the fact that it does seem that the president, Erdogan, is just becoming much more belligerent, picking a fight with France, also going after Greece. It's something that could really be at the crossroads between foreign policy and things getting ugly between Europe and Turkey, and then the impact as a way of looking like the strong man back home, Tom.
And again, Turkey, a NATO member. We make note of that. Futures have deteriorated over the hour. Negative 30 has become negative 34 on SPX futures. The VIX right out to 30 right now, 29.95. So let's call that a 30 level on VIX. Over 2 big figure move there. Risk off, bid slip away. In the bond market, yields come in 0.81%. In our next hour, 8 days to the election, Carl Weinberg of High Frequency Economics. Good morning.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This morning, forget second and third wave punditry, simply the opening of societies. It has not worked. Ireland in lockdown, a grim weekend for continental Europe. El Paso intensive care units, they are at full capacity. Indiana had 12 deaths on Sunday. Their vice president has 5 aides and advisors infected. On the pandemic, we are, quote, rounding the turn. Markets, well, they give way, risk off. Big tech earnings later this week, Apple and Amazon. And there are 8 days a week in this election week. Both Trump and Biden, Biden and Trump. No, it's not enough to show I care. is an election week, and it starts on Monday. Good morning, everyone. Bloomberg Surveillance, Tom Keene in New York, Francine Lacroix in Apple, in London, I should say, not too far from Apple Studios on Abbey Road as well. You know, Francine, it really is 8 days a week. We were talking about it on the break, and there's just a great tradition of this being the final week where they really recalibrate. And let us remember, Francine, 4 years ago, this is when President Trump, with a vengeance, recalibrated.
Yeah, so we look at the polls. We look at Georgia, Tom. I know I've been obsessed with Georgia for quite some time. There's some of these swing states, actually, you know, that have been for a pretty long time. Red could turn blue, so we look at the polls there. And it must be election week if you're singing to me, Tom. So I know there's, you know, that's what the markets are looking at. That's what even they say Boris Johnson is looking at, to see whether he signs or not with the EU, who becomes president in the U.S. Really, it's going to be a busy 8 days to November 3rd.
Well, voties and long lines across the nation, lots of stories and anecdotes on that. Let us get now on this Monday to our first word news in New York City. Here's Ritika Gupta.
Morning, Tom. Francine. House Speaker Nancy Pelosi says the chamber could pass a pandemic relief package this week. Still, a deal with the White House remains elusive, and the Republican-led Senate may not act before the election. Both sides accuse each other of, quote, moving the goalposts on legislation. President Trump's chief of staff, Mark Meadows, says the U.S. is not going to control the pandemic. Meadows told CNN the government's response will be focused on vaccines and treatment, not containment. Meanwhile, Vice President Mike Pence's chief of staff and 2 other staff members have tested positive. Pence's latest test came back negative. And in the Senate, a final vote is set for today on Amy Coney Barrett's nomination to the Supreme Court. Confirmation is all but assured. Senate Democratic leader Chuck Schumer accused Republicans of using war political power to get Barrett confirmed before Election Day. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Data check. Yields are lower in the United States, a worser result, if you will, here. -3 basis points lower yield in the 10-year, 0.81%. Futures -35, Dow futures -2. There it is, a 30 print on the VIX. That's a real benchmark. 3.0 on the VIX, 2.45. I'm going to leave it there. We got to get to Mr. Schenker. Francine?
Yeah, I'll be quick. Investors are seeking protection in haven assets. I'm looking at treasuries rising. If you look at, you know, yields on the 10-year, they're lower. Dollar strengthening. Gold, little changed. But then the German software maker SAP plunged 20% after cutting its revenue forecast, and that's sending European stocks lower, Tom.
Very good. We begin our coverage on these 8 days of election with, well, a look at the voices and then to our Martin Schenker. First, the president and the former vice president.
Many of our greatest companies and labs are coming out very quickly with the vaccines. They're doing great, very shortly, very quickly. It's going to be delivered fast. That will quickly end the pandemic. It's ending anyway. We're rounding the turn, but the vaccine will get it down fast.
Folks, I have an admission to make. There's so many of you here. I wish I could go to car and meet you all. I don't like the idea of all this distance, but it's necessary. I appreciate you being safe. What we don't want to do is become super spreaders.
Oh, now they're doing it again. You know, the laptop from hell. They found the laptop from hell. This is a laptop that they don't want to see. How the hell this laptop got freed up. It's amazing the way God works. The laptop from hell.
They didn't tell us about the virus. The administration gave Wall Street investors, though, a heads up. He didn't tell us. He just told his Wall Street friends, and that's why they made so much money by, quote, selling short in the market. They knew what was coming. But what happened to the rest of us?
It is part of the American fabric. I would note in Dallas, Pennsylvania, up the valley from Scranton and Wilkes-Barre, John Bon Jovi out for Vice President Biden as they both begin the dash. Our Martin Schenker out in force, somewhere lost up the Hudson River Valley in the beautitude of the weekend voting. And Marty, it was in long, long lines. That's really nationwide, isn't it?
It is nationwide, Tom. I myself voted up in Hudson, New York on yesterday, and half an hour before the polls opened, the line was around the block.
It's around the block, and it's so much the allusion to 2008 or 12 or 16. Which election does this compare to, Marty, 8 days on?
Well, I mean, for the Democrats, they're hoping it's very much like 2008. And for the Republicans, they hope it's a repetition of 2016, where polling showed Hillary Clinton ahead, but Donald Trump pulled it out.
Marty, have the polls changed? I guess, the one unknown is the shy Trump voter. Now, you speak to half the people, they say this is elusive. It just, there are very few of them. And others say that actually this is a major factor, is that people have been shamed into saying that, they vote for President Trump. What are the polls telling us?
It's amazing that the national polls have been pretty consistent for months, essentially, with Joe Biden ahead by high single digits. Some polls even had him above 10%. But it's in those battleground states and the new states that are now contentious that should give everybody pause before predicting who's going to win this race, because those are very close and within the margin of error, and anything could happen on Election Day.
I mean, do we have new swing states? And we've been trying to figure it out on surveillance for quite some time. There are these states that, that haven't voted Democrats for quite some time that are now, could be on the cusp.
That's right. I mean, you mentioned Georgia, Francine, and there's Texas as well, and Arizona. I mean, these are all now essentially battleground states. And again, they are so close. And you add in the other states like Florida, which is also very close, and it gives you pause before making predictions on what's going to happen.
Mr. Schenker, do TV commercials work anymore?
I think they work as entertainment, but so many people have decided already and even voted already. Over 60 million people have already voted. So for them, the commercials are just entertainment.
It's just entertainment, and yet we're going to dash in the amount of money that everybody agrees is sort of unseemly as well. I need something to focus on, Marty. What state are you focused on the most?
I think that actually Georgia.
Stop. Come on. Folks, this is just brilliant. Francine Lacroix across the pond is focused on Georgia as well. Marty, that's clairvoyant. What's about Georgia?
Well, Georgia, obviously, Stacey Abrams made a valiant bid for governor 2 years ago. She came up a couple of percentage points behind. The state is changing demographically. And it's also very interesting because both Senate seats are up in Georgia, and you must get 50% to become senator. And if neither candidate does, then we're not going to know where the Senate is until January.
Marty, you see, this is why, Francine, it's great to have Marty Schenker on. I did not know that. He's a font of wisdom.
Of course he is. We know that. That's why we have him on. Marty, when you look at, the infection of the people around Mike Pence, and I think it's a chief of staff and for other top aides, what does it mean for what the vice president needs to do, and how does that impact, the nomination of the Supreme Court judge?
Well, I mean, the Donald Trump holding rally after rally and Mike Pence traveling after his close aides tested positive allows the Democrats to continue the narrative that the Republicans had a very poor response to this virus, and even to this day are not trying to contain it. And I think that just feeds into the Democratic argument.
Marty Schenker, stay healthy. He is our chief content officer here on the path to the election, 8 days away. I'm sure we'll be speaking to him many more times through to really just a great compendium of all the zeitgeist that is out there. Coming up on the economy, it is good to catch up with Carl Weinberg, high-frequency economic chief economist. He's written some blistering notes on aggregate demand, and it's not there. Futures simply deteriorate, negative 30. Down to negative 35, and the VIX now out to 3030. Stay with us from London, from New York. This is Bloomberg.
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We don't even have the bill yet because Nancy Pelosi, and she's coming up. I know she can speak to this, but we've continued to make offer after offer after offer, and Nancy continues to move the goalpost.
We're waiting for the final.
Well, they
yes.
said they would, and you're waiting to see it on paper.
They haven't yet. And also, same thing. They keep moving the goalpost. We want it the sooner the better, and that's why we're making concessions. We're making concessions too.
The political moment there with Mr. Meadows and the Speaker from the House beneath the fold this weekend. Maybe you missed it. Nancy Pelosi saying she will effort again as Speaker of the House for another 2 years. Joining us right now, always efforting, is Carl Weinberg, High Frequency Economics Chief Economist. I love, Carl, the acuity of your global essay this weekend where you focus on Q4. Where is our economy October 1 on? What level do you have?
Well, you know, we don't have a level, and the reason that we don't have a level is that we don't really know what the pandemic is going to do, what's going to happen with coronavirus. What we do know is that the third quarter got a boost because in every country around the world, the GDP growth, I mean, we're looking at figures like 52% growth for Germany, 29% for Germany, 57% for the Eurozone, 63% for France. But it's an illusion because the base was so low, and that's a windfall for third quarter growth. The fourth quarter won't have that windfall, and we could see flat or worse depending on how the months work out. The indication this morning from Germany is that it's already starting to fizzle a little bit over there with the business climate index down. So it's reason to be worried about Q4.
I mean, with the political moment that we're in, usually ex-pandemic, we're worried about what's the run rate of GDP. Is it under 2%? Can you be that grim, or is it actually more constructive?
Well, in the United States, we think that there's a rebound in progress, and barring a resurgence of the virus, we would have said something around 2 or 3% is possible, which might have gotten us back to where we were before the lockdowns, maybe over the course of 3 or 4 or 5 years. But with this new third wave in the United States, second wave in Europe out there, we really can't predict what's going to happen because the virus can just shut everything down. Not because of government lockdowns, but just because people can't or won't go to work. They have to stay home for childcare. Their factory is shut because somebody else got sick. There's a number of ways in which the infection infects the economy, and that's what we're worried about right now. Not a formal lockdown as much as an unwanted, undesired shutdown of economic activity as the coronavirus spreads again.
So, Carl, are we looking, and good morning from London, are we looking now at a double-dip recession? And will the markets care, or will they just focus on what central banks and fiscal policy can do?
Well, the chart may call it a double dip, but it's all the same recession. It's all the same thing. The shock is that people can't get to work because they're sick or they're locked down or both. It's a supply shock compounded by a demand shock with income down. Just because the quarterly numbers go up and down on the basis of maths, when we look at charts of the level of things, it's pretty clear what's happening. And we have a lot of them in our weekly notes on the global economy today. We look at the levels, and the direction of the levels is down, now with a little bit of a bounce. And now on all the monthly charts, we're starting to see a little tail downward on indicators that we trust, like the IFO index out this morning, other survey data from other countries. So we're concerned that we're seeing kind of a dead cat bounce, if you will, off the bottom, and that with the new rise in infections, that things can only get worse from here.
So get worse, what does it mean for where you put your money? Do you buy gold? Do you buy havens?
Yeah, so first of all, by get worse, I mean that I think that April was the incompressible low point of the economy. And I think that we're headed back to those levels again on the back of this new wave. So where do you put your money? That's a good question because you're starting to run out of opportunities. We're going to see, I think, this week as GDP numbers start to come out for a number of countries, a burst of optimism in the stock market that's going to take it to new highs, going to bolster investor confidence. Everybody's going to say, boy, 20, 30% GDP growth, that's terrific. We got to buy stocks. But then as the fourth quarter emerges and as things start to go into crash mode again, then I think we're going to see a sharp reversal. You know, I think we don't give investment advice at High Frequency Economics, but I think the equity market is in for a very wild ride from here. I think that bond yields really are going to stay about where they are, if anything, go even a little bit lower, a little bit more negative in Europe on the basis of more negative economic information coming out there.
Carl, one of the heritages of a Carl Weinberg essay, month after month after month, is a careful study of export and import dynamics. Can you give any kind of vector up for world trade, a vector up for U.S. exports, even a vector up for better imports?
Well, you know, looking at world trade, which is more my kettle of fish than the U.S. economy, you know, world trade is being held down by commodities, by things like energy products, raw materials, and so forth, with our industrial structure anywhere from 5 to 20% lower in terms of operation levels than where it was back in February. Right? We're seeing less trade in the stuff that goes into the industrial machine, and that's dragging down world trade, particularly affecting the emerging markets and the commodity-producing countries that are largely the customers of the things that we export from the United States. So this whole process is kind of a snowballing process that starts with the economic activity slowing in the advanced countries, then reflects out to the emerging world, and then reflects back into the United States through lower export sales. So right now we're in a grim state. You know, if we started to see levels of industrial production going back to where we were before, we'd see this increase in imports of commodities, and that would be good. But that's the key thing. Don't look at the growth rates, Tom. Tell everyone to look at the levels. Right. It's the level of activity that determines the level of employment, the level of capacity utilization, and the level of commodity input.
Where is the level of our labor economy?
Very severely depressed right now. You know, you can be optimistic about a V-shaped recovery. You can talk from today until tomorrow about how growth is bouncing back, but growth isn't the object. It's not the metric by which recovery will be measured. The metric is level, and we have, 20 million people in the United States still getting some kind of unemployment benefit in one way or another, and that's X number of million more than we saw before. And we see this story repeated all around the world, except in Japan, where they don't fire anybody, and therefore we're going to see the lifetime employment system generate very, very low profits for companies in Japan, as well as reductions in average and overtime. But we're looking at a very, very soft labor market everywhere in the world right now.
Carl Weinberg, thank you so much. And folks, I can't say enough about the combined output of High Frequency Economics. We protect the copyright of all our guests. Please get that through their team at High Frequency Economics. Just extraordinary China note, a U.S. note, and of course, Dr. Weinberg's global note is must read on Wall Street. Speaking about must read, this is important. If you have a bull case, and particularly a bull case into this tech earnings week, Benjamin Laidler is someone to speak to. With Tower Hudson, he has been shockingly good on staying invested in times of fear. Ben Laidler in the 7 o'clock hour. This is Bloomberg. Good morning.
Jacinda Ardern's Labour Party holding 64 seats in the 120-seat parliament. Now, that is interesting because it's the first time since the introduction of proportional representation in 1996 that any party has won enough seats to govern on its own. Now, this is by turns rather luxurious and also slightly terrifying for the new Labour government because there are no checks and balances on power. There is no upper house. Jacinda Ardern can pretty much rule as she sees fit. So she did rule out, heading into this election, any capital gains tax, but as revenue collapses, it must be very tempting to give that policy another look. She's also contemplating going into coalition with the Greens Party, even though she doesn't actually need them to govern. Now, the Greens Party did take forward a more comprehensive package of tax reforms to this election. So were she to govern in concert with the Greens, they could do much of the heavy lifting on tax reform, which may also prove to be a little unpopular with some portions of the electorate. So it's going to be very interesting to watch this new term. There's going to be a lot of new and untested MPs in the caucus. So a second Jacinda Ardern term is going to be full of all sorts of different challenges to the ones that characterized the first.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
HHS should have done differently.
Almost all of us have underestimated the dramatic impact of this outbreak.
Seeing advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
This is Bloomberg Surveillance. I'm Rishika Gupta with your Bloomberg Business Flash. China will impose unspecified sanctions on Boeing's defense unit, Lockheed Martin and Raytheon. That's after the U.S. approved a $1.8 billion arms sale to Taiwan last week. China's foreign ministry says the sanctions are needed to, quote, uphold national interests. The parent of coffee and donuts chain Dunkin' is in talks to be acquired by private equity-backed Inspire Brands. According to the New York Times, the deal is valued at $8.8 billion and could be announced today. Shares of Dunkin' Brands have more than doubled since March. Inspire Brands owns Buffalo Wild Wings and Jimmy John's. And early on, the pandemic created shortages in everything from toilet paper to meat. Now consumers face a scarcity of larger household goods. Here's Scarlet Fu.
Shopping for a new freezer or bicycle? Join the waiting list. Buying things is easier than ever, but making and getting them to your doorstep, that's a complex choreography of global supply chains and reliable shipping. In the early days of COVID, few retailers anticipated any demand surge, while decades of just-in-time manufacturing kept inventories lean. Factories around the globe reopened from initial shutdowns, but often at limited capacity to keep workers socially distanced. The virus also gummed up trade lanes, resulting in a shortage of containers and congestion at ports. With demand climbing on the back of a booming U.S. housing market, an already stretched network is seeing even more stress. Repairing your aging appliances is just as hard, especially after the U.S. raised tariffs on Chinese-made parts. Economists say, get ready for the biggest restocking cycle on record, perhaps straining the system even more. As manufacturers rebuild inventory, GDP will get a boost over the next 2 to 3 quarters, but states that rely on logistics, manufacturing, and construction will outperform those with service-driven economies.
And that's the Bloomberg Business Flash. This is Bloomberg.
쭈르쭈르 보라주르 수분 충전 보라주르 톡톡 찹찹 보라주르 기분 좋아
나추르 너도 나도 보나추르 보라 보라 보나추르 추르 추르 보나추르
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Now, Tom, our next guest cut his teeth leading one of the world's largest consumer companies. The former Unilever chief executive, Paul Pullman, is now chairing a venture in green policy, Imagine and B-Team. He's also, received a commitment from Japan's prime minister to cut greenhouse gas emissions in the country to net zero by 2050. Now, we're delighted to be joined by Paul Pullman, a former Unilever chief executive. Paul, thank you so much for joining us. You were really one of the first people that cared about sustainability and started working on sustainability to build a better future at Unilever. We're now in 2020. We're 8 days to the U.S. election. We've seen a lot of commitment from private companies, but what do you need from the next U.S. administration to actually, bring this forward, this agenda at the forefront of what we need to care about?
Well, thanks, Francine, and thanks for the opportunity. And indeed, in the private sector, we now have about 1,300 companies with a combined market cap of about $25 trillion calling for climate action. So the private sector indeed is rallying broadly. In the US, the elections are going to be decisive to some extent, as well as towards the future of attacking this most existential threat that we have. On the one hand, we have a president that continues to call this a hoax and plays disregard to it. And on the other hand, we have someone that very much looks to Europe, the Green Deal, and the broad movement in the US, about 60-70% of the population demanding climate action to put something in place. So the outcome of the elections is going to be decisive. Not as much in the US, if I may say, as to the role that the US will play globally to move this forward. With the announcement today from Japan being net zero by 2050, China having made a commitment 2060, major regions like the EU as well as Britain, there is a clear momentum if we now also get the Americans on board.
But Paul, something's changed. So historically, it was governments that actually set guidelines or deadlines for companies, and companies did better on sustainability. If you look at the vacuum in the U.S., private companies have really taken the lead. Does that change if you have a Democratic president?
Well, we need everybody, and I don't think the issue can be solved by just relying on one party or the other. But it is very clear that the American industry right now is dealing with the costs and the inefficiencies of not acting, with a lot of political frameworks, government regulations that are not conducive. And we certainly could accelerate if there is a new government, and it would make the industry more competitive. One of the reasons that Prime Minister Suga in Japan now has announced his commitment to be net zero in 2050, i.e. stay below the 1.5 degrees warming, is that they firmly say now it will accelerate economic growth in Japan. So it took a while for politicians to break this paradigm that they had, that working on climate change would stifle economic growth. It's now proven over and over it's actually opposite. If we don't work on climate change, we will stifle economic growth. It's probably the best opportunity that we have moving forward.
Paul Pullman, Tom Keene in New York, wonderful to have you on today. I would suggest, Paul, that your work with the Unilever and with Nestle before that, and starting out as a cost analyst at Procter & Gamble a few years ago, that you've done more in big cap multinational on this theme than anyone alive. The core problem we have is the price theory of carbon, the failure of auction markets in Europe. I talked to Chair Yellen about it the other day with a group of 30 over a carbon tax, which seems to be undoable. How do we get to a pricing of carbon that allows nations to interlink to a successful outcome?
Well, thanks for the question. There are over about 40 schemes globally now on carbon pricing, and broadly where that is in place, we see these economies doing better and actually business thriving. Many of the businesses, as you know, already have an internal price on carbon. And the Task Force of Financial Disclosure, interestingly, the highest take-up being from companies in Japan, would very much not only like disclosure of carbon risk in the value chain, but also a price on carbon. It happens to be that in the US, we were not far away from a carbon pricing about 2 decades ago. And there is a proposal now in the House and Senate, which is called the Baker-Schultz proposal, from both sides of the aisle, that again would move to a carbon dividend system. So I'm not sure that we would not be able to do that. It will obviously take a little bit of work, but if we don't price in these externalities, we will not be able to move at the scale and speed needed. So I'm more optimistic than your question would suggest. And even in the US, I think some of the Republicans that are now sitting on the fence until the elections will hopefully be willing to be more cooperative after the elections.
How critical is it to have the United States on board? You mentioned to Francine Lacroix here the idea of the United States still not on board. To go back to the Paris Accord, in full disclosure, folks, Mr. Bloomberg was very actively involved in that, the founder of Bloomberg LP and his TV and radio property. But Paul, with that said, how critical is it to get the United States into multilateral agreements on climate?
Yeah, first of all, Mike has played a key role, and you're good to point that out, and we're grateful for that. Also with the America Pledge and the We're Still In movement, which is really rallying states, cities, subnational governments, and private sector behind action on climate change. And thanks to that, we're in a better position than we otherwise would have been. The U.S. role overseas is still very important, and we should not deny that. John Kerry and at that time Barack Obama played a crucial role in pulling some of the countries that were sitting on the fence, pulling them to the right side. And that is one of the reasons that we have a very good Paris Agreement. There is still some work to be done, I think, with some of the countries that America would be more successful with than any of the other major powers. But having now China, the EU, and then hopefully the US on one page will certainly help us create momentum globally.
Paul, thank you so much. Paul Pullman with us, a former Unilever chief executive officer with his effort Imagine on climate as well. Futures are negative 31, Dow futures negative 256, critically VIX back to a 30 level. Francine and I are watching Turkish lira out to new weakness, 8.05. That is a difficult number for Mr. Erdogan. Please stay with us. On the pandemic, Joshua Sharfstein of Johns Hopkins University. We'll do that next. This is Bloomberg. Good morning.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg First Word News. House Speaker Nancy Pelosi and the White House accuse each other of doing the same thing when it comes to the pandemic relief plan. That is, quote, moving the goalpost when it comes to what's in the actual legislation. Pelosi says the House could pass a bill this week. Still, an agreement with the White House isn't certain, and the Republican-led Senate may not act before the election. And coronavirus cases are surging again in the two countries at the center of the initial wave of the pandemic in Europe. Italy is introducing its strongest restrictions since the end of a national lockdown in May. And meanwhile, Spain also will impose new measures, including a curfew.
Por tanto, aprobamos de nuevo el estado de alarma.
We declare, once again, a state of emergency because it is the most effective way to slow down the contagion curve and keep the virus away.
Germany will consider its next steps at a meeting today. And Joe Biden calls Republican questions about his son Hunter's business deals a smear campaign. The Democratic presidential candidate also told CBS News that the release of documents allegedly belonging to his son may have been part of a Russian disinformation campaign. Biden's claim has not been substantiated. And more deliberate blackouts in Northern California. The state's largest utility, PG&E, cut power to 1.1 million people to prevent live wires from falling into dry bush and starting wildfires. Winds as high as 50 miles an hour swept through an area north of San Francisco. The blackouts may last until tomorrow. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Tom Francine.
Ritika, thank you so much. Greatly appreciated. And now, on the deaths, on the cases, on the hospitalizations. Joshua Sharfstein of Johns Hopkins University. Joshua, we've had a wonderful dialogue with you and your team and other experts around the world on this pandemic. We have learned so much from you, starting in, I guess, the vicinity of February and the permutations of April and May. If I discard a second wave and third wave mentality, and I simply look at the burgeoning cases, how do they fold over to an expectation of deaths to come?
Well, it is extremely concerning because it's obviously not just cases we're seeing. We're seeing a lot of people in the hospital. I was just looking at the stories about field hospitals being built in Wisconsin and other states, Texas asking for the use of military hospitals, Utah sending patients all over the country because the hospitals are full. Those are really concerning signs. Anyone who thinks that this increase is because of testing is completely wrong, because we're seeing these surges in hospitals. And with surges in hospital care, we're going to get surges in patients that need to be mechanically ventilated. And when that happens, there's going to be an increase in death. Now, the rate of death, meaning of the people who are that sick, we can take care of them better. Fewer are going to die. But that means overall, because there's so many cases, more and more people are going to die. So it's really cold comfort that there's a little bit of a less chance of in any individual dying. There are just so many more individuals. So this is a really serious time, and I think the projections that we could go from 1,000 to 2,000 a day are not unrealistic.
Do you have an extrapolation to the number of deaths out there? That's the one thing I couldn't find this weekend, except from punditry. And on a medical basis, looking at the literature, can you extrapolate out the number of deaths in the United States?
I mean, that's not something that I do, but there are people who do those kinds of models, and those are the kinds of models that some of the pundits are citing. And so, based on the anticipated spread, Tom Inglesby from the Johns Hopkins Center for Health Security was quoted over the weekend saying something which I think is true. The cases are going up, and we're not really doing that much to bring them down. So we're going to expect them to go up for a while. And when that happens, more people will get sick. And that's what's driving those projections that more and more people will be dying.
Joshua, when you look at the race to the vaccine, there are a couple of things that moved over the weekend. First of all, we understand that AstraZeneca vaccine actually makes an autoimmune response in the elderly. We also understand that J&J, Johnson & Johnson, said the first batches of its shot could be available as January. Is this much needed good news?
Yeah, I think there is some good news out there. And I think the evidence that the vaccines can create an immune response in the elderly is a good step. We don't know for sure that means people are protected. That's what we're waiting for the studies to find out. But the studies should be reporting soon. So, I think that's good. I still wish that we were learning a little bit more about what was going on with the trial from regulators around the world. But, hopefully they'll be able to find their voice as these trials come to a conclusion.
Joshua Sharfstein, thank you so much, of Johns Hopkins there. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, coming up next, we speak with Ryan Williams, the Cadre Chief Executive Officer. We talk about real estate and technology. This is Bloomberg.
바다에서 태어나 바다로부터 자유로운 리얼 앵글러를 위한 오리지널 피싱 기어 잔카.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, UBS is changing its pay structure to keep senior employees from being poached. Now, fixed salaries will be raised by as much as 20%. At the same time, bonuses will be cut. Well, let's get straight to our Sonali Bazak, Bloomberg Wall Street correspondent. Sonali, when you look at exactly the change, now this is according to people familiar with the story. Our Marianne over in Switzerland actually broke the story. But could it be a new template for pay compensation that a lot of European banks would follow?
It sure can, Francine, and one reason why is because it creates less uncertainty for the banks when it comes to their investors. It creates a lot less uncertainty for the employees at a very uncertain time, doesn't it? And remember, when you look at the U.S., there's already rules around bonuses versus fixed pay, and that has been a very big draw to employees in other areas of the world, like in the U.S., where the U.S. employees have just really liked the certainty from places like Deutsche Bank when they know what they're going to get at the end of the day.
How does it actually reduce poaching? Because I thought, Sonali, that I guess if there's a bonus and it's tied to, basically it's deferred compensation, then it disincentivizes bankers from actually leaving the company.
You have it both ways, right? If they bring the base pay up high enough to get the employees to the level that they'll be comfortable living at for however long they have that fixed pay for, you're okay. But again, if that jump is not high enough, you're absolutely right that the bonus and the fixed pay won't really make a difference for that employee. It's a competitive job market right now, and so that jump really has to be high enough, Francine.
Sonali, let's talk also about investment, especially real estate technology platform Cadre. Now, commercial real estate prices have taken a beating during the pandemic. Some investors, though, are looking for opportunities, and we're delighted to be joined by Sonali and Ryan Williams, co-founder and chief executive of Cadre, a real estate technology platform. Ryan, I mean, we're delighted, Sonali and I are delighted that you're joining us. Do you see prices good enough for you to go back in? So basically what you do is you buy some of the stuff and then you tell investors to come and invest in Cadre. Is now a good time to buy commercial companies or commercial real estate, or are we going to work from home for forever after?
Yeah, well, it's I don't think it's one or the other necessarily. And I think the important point really is to recognize that real estate has historically been the number one asset class for wealth creation. And a lot of that wealth in the past has been created coming out of periods of uncertainty, periods of dislocation, such as the current one we're in. And the key to success, just like in any other industry, is who you invest with and which kinds of assets they invest. There's going to be winners and there's going to be losers. In this environment, we at Cadre do believe that there will be some asset classes that actually perform even more strongly than they would pre-COVID. Multifamily, residential, for instance, are actually stronger today than they've ever been because people need somewhere to live in an environment where people are home more than ever. The benefits of being and owning in strong residential real estate are clear. Industrial is another asset class that we think is incredibly compelling given this whole e-commerce trend that's been accelerated and the importance of having, logistics and supply chain effectively digitized. You look at certain asset classes in life sciences office. And so at Cadre, we're focused on identifying the asset classes we think actually will perform even more strongly, staying away from asset classes like retail and hospitality, which to your point, have a lot of question marks and unknowns, staying away from, urban central business district office, which to your point, also have a lot to still to shake out.
Right.
And so it's really, there's going to be a winners and losers, and it's about being selective. It's about having the right platform to build a portfolio, because real estate, again, is a great hedge to a lot of the volatility we're seeing in the equity markets today.
Ryan, let's talk about urban spaces for a second here. When you're looking across the country, you have people who are just flying away from the cities. But you have some people, like me, frankly, who are ready to buy place in the city because you're seeing these prices start to plunge. What are you seeing? What's the real story when you look at everything all together?
Yeah, I think it's a little bit of a mixed story in many ways. To your point, there are definitely folks like myself, I'm actually in New York City still as well, that are interested in staying here for the long term, that are bullish on some of those unique dynamics that make a city like New York so vibrant, cultural opportunities here, the fact that there is a deep history, that there are so many amenities all centralized. And so I think we're in a period of a little sort of near-term and mid-term dislocation in that a lot of folks are moving outside the city for the time being, but will come back. And I think for those, to your point, who are more long-term oriented and can think beyond the next year or 2 years, I think there are some compelling investing opportunities, especially in residential and a lot of the urban cores and the urban central office. I think that's a space where there's going to be a fundamental change in how office space works, in terms of flexibility and adaptability being key. But in terms of the residential plays within urban centers, I still firmly believe that there's some just unique benefits to being in the city centers that will endure, and that for those who are willing to invest today, there can be real opportunity.
So how do you time it then? Is this the right time then to be investing in urban real estate? Or do you have to wait another couple months?
I think it's market by market, and it's based off which asset class you're focused on. So, at Cadre, we've actually identified, we call the Cadre 15, our top 15 markets. Some are what we think of as almost emerging urban markets, and those are areas where you're seeing prospects for population growth. You're seeing affordability. And those are the markets that we feel more confident in investing today versus markets where affordability is not quite in line, and you could look at a market like LA, for instance, where population growth and income growth are actually trending in the opposite direction. What we're very focused on is identifying, again, the markets where there is unique affordability, there is growth, and staying away from the markets where that's not the case. And so I think it's market by market. You've got to really select and identify where you see positive trends, where you see investment from city government and the like. And then the markets where you don't see that, you have to stay away from it. And then you need to overlay asset class as well. So residential in the urban centers cores, we like more than office because of all the changes happening. I don't think you're going to see any kind of clarity in terms of pricing across urban office or central business district office, hotel or retail for another 18 to 24 months at least. So we're staying away from those asset classes in major markets in the next 18 to 24 months. We're still focusing on residential, but we're being more selective in the urban markets versus suburban markets.
Ryan, thank you so much for joining us. Ryan Williams, our co-founder and chief executive of Cadre, and Bloomberg's Sonali Basak. Now, it's Monday. It's the last Monday, or actually it's 8 days away from November 3rd. Of course, it's all about the U.S. election, and there's a lot going on in the market. S&P here in Europe really hurting a lot of the European stocks because it's down some 20% after it said it's going to be a difficult couple of months. Coming up, Tom Keene, Jonathan Fair, and Lisa Abramovitz for more Bloomberg Surveillance.
When opportunity knocks at the door, don't say, blimey, I've still got my pyjamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
Have to think about all the other offsets to tax. And so we're looking at it. I think we're going to be prepared. And, we're modeling out a whole bunch of different scenarios. I think we're going to be well positioned no matter what the outcome is.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
We're in an environment now where there's much less leverage in the equity market.
This is a market that's thinking at some point stimulus is going to happen.
We have just huge levels of debt, and we don't want to get into a debt trap.
The Fed has a lot of upside to accelerate. I think they're going to maintain this pace.
We are having this income cliff at a time when actually the consumer is supposed to go out and spend.
COVID is the great unequalizer. The strong get stronger, the weak gets weaker.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures this Monday morning, Dow 31. We're down 0.9%. Tom Keene, a week and a day away from an election in America.
We call that 8 days a week, John. Beatles 6. Come on, get with it. Ooh, I need your love, babe. John, what's so important here is thank you, really? How it's melding together.
Happy
and whether
Monday.
John, I got up early this morning and I spent 1 hour reviewing the pandemic dynamics. And you know how bad Europe was. You were way out front on that last week. There's been a real deterioration there. Mike Allen, moments ago, publishing for Axios, and he melds the two together, John, the two stories, and he's focused on Wisconsin and Montana as being those swing states with huge pandemic issues.
And yet, where's Biden and Harris going to be this week, Tom? Biden in Georgia, Harris in Texas later this week. Who would have thought a few months ago, Tom, with a week to go until that election, they would be two of the places they would be?
Texas, I agree with you totally. Georgia's always been in the game. And this morning, John, I'd really say Georgia's been front and center. Martin Schenker of Bloomberg really talking up Georgia's key. And also our political analyst in London, Francine Lacroix, mentions that she is focused on Georgia as well.
New restrictions across the continent then, and what are we not talking about this morning? We are not talking about stimulus conversations, Lisa Abramowitz, and this market adjusting lower.
Yeah, and perhaps you can blame the fact that we haven't gotten a fiscal deal. It's worked for the past 2 months, so we could try that again. I will say this is such a huge week with 8 days to the election, with the virus spreading and big tech earnings. The data this day, pretty soft, I mean, in terms of the importance of it. I know you're going to make fun of me for this, John, but here we got to have it said. 10 a.m., we are going to be getting U.S. new home sales. Expect a deceleration in the full number based not on a lack of demand, but rather a lack of supply. People are staying in their homes, and a lot of people want to buy them. Also today, China's top leaders begin meeting to chart economic plans for the next decade to 15 years. The expectation, if China stays in the trajectory where it is right now, it will surpass the size of the U.S. economy within the next decade. So it's really important to see how they're going to get there. Also today, the Senate is going to vote to confirm Amy Coney Barrett to the Supreme Court. Mike Pence presiding over that, despite the fact that 5 of his closest advisors did test positive for COVID. He tested negative. He is not quarantining. An interesting dynamic at a time of such a rampant spread in the pandemic, John.
And then we can have some talks about talks at some point later this week. I can hardly wait. Here's the price action this Monday morning, shaping up as follows on the S&P 500. Equity futures gapping lower. Early this morning at the European Open, I was here for that. Equities lower there as well. Equities down here. I was here for that. I'll be here for this one too. Equity futures down 30, off by 8.9%. In the bond market, there's your bid. Yields back in 3 basis points. Big bid across the continent in Europe as well. European government bonds rallying. And in foreign exchange, just dollar strength more broadly, Tom, through G10.
Yeah.
The euro back down to 118.25. Some risk aversion this morning, Tom, to kick off the trading week.
Yeah, I don't want to oversell it. I don't know what Mr. Laidler's going to say here in a moment. But, John, I looked at the pullback, if you will, that we're seeing in the market, and it only gets you at worstest, like the NASDAQ 100, to a center tendency of the recent volatility. There's not a lot of gloom and doom on the tape. It's just sort of range-bound center tendency off this morning.
We know what Ben's going to say. He's going to say buy. But he's going to say buy cyclicals. Let's bring it in right now. Ben Laidler, Tower Hudson Research CEO. Ben, great to have you with us, sir. That is a change, Ben Laidler. It is not just about buying growth equities, getting into some cyclicality. Why, Ben?
Because I think the election has held people back. I think all this talk about are we going to get fiscal stimulus or not has just been a huge distraction, has held people back. We're waiting for a vaccine. We don't have that yet. I think, roll forward. Let's get the election out of the way. Let's get a bit of certainty there. And then let's look forward. And what does that look like? 2021, you're going to get 3 to 4% GDP growth. You're going to get 25% earnings growth. And you're going to get a mountain more than that of these sort of deep cyclical stocks people until very recently have basically been ignoring. And I think those are the sort of the big beneficiaries of the vaccine, which we're going to get some more fiscal stimulus. I think we're going to get something. Biden wins and it's a blue wave. We're obviously going to get a lot more than that. I think these are the sectors of the market which are cheap, which are out of favor, and have just huge operating leverage to this sort of base case scenario that I have from here. And it hasn't really moved yet because I think people have just been very distracted by by this fiscal stimulus talk in the election and everything else.
Ben, the challenge of people trying to catch up with Ben Laidler is on an absolute or relative basis. Do you shift? Do you shift away from big tech and tech completely, or do you do both together and still own both areas?
Yeah, I mean, I think you bring down those sort of quality growth, sort of big tech, healthcare a bit, but I think that we're talking different instruments here. I mean, I think the tech is just a very natural story. It's with us for a long time. It's going to continue to look very good with these balance sheets, with these structural growth outlook. But absolutely, I mean, it's where everybody is right now. There needs to be a bit of a shift. But the sectors I'm telling people to shift into, industrial, small cap, real estate. I mean, these are pretty small sectors. A little bit of money is going to go a very long way. And I think you're going to get an awful lot of bang for your buck. Just because, I mean, just look at what's going on in third quarter earnings right now, which we're all sort of ignoring because there's a lot else going on. These cyclical sectors, industrials, energy, have beaten expectations by, over 100% so far. I mean, you're just getting huge operating leverage on the upside.
There is, of course, the counter-argument that the pandemic is accelerating and worsening dramatically in Europe and in places in the United States with a record number of cases, and that we're not out of the woods. Even if we get a vaccine, the rollout's going to be complicated. The efficacy is questionable. So how long can we stay in this environment with a pandemic still very much present and pushing people away from the public realm? How long does that have to go on before you change your view?
Yeah, I mean, I think the relative surprise, and which has certainly given me, a lot of hope, has really just been the resilience of the consumer, the resilience of the economic activity. I mean, we just had a US PMI for October last week at 55. I mean, very expansionary. Savings rates sort of 14%. Retail sales are sort of back to pre-pandemic levels. I mean, we're in pretty good shape here. I mean, I'm not naive enough to think that this. This can go on forever, but I think the story so far has been one of just extreme resilience, and I certainly think that can go forward a little bit further. I mean, at some point, we do need some more fiscal stimulus, and I think we're seeing everywhere that this second wave is having less deaths and less impact on economic activity. But your point is well taken. I mean, obviously can't go on forever. I mean, I am looking for a vaccine. I am looking for some more fiscal stimulus, and I am looking for this sort of second wave to have less of an impact than the first wave did.
Equity futures, as Ben speaks, ticking higher, still negative by 0.8% on the S&P 500. Ben, just to wrap this conversation up, the correlation between cases increasing in the United States and what you think happens with consumer engagement, how loose or tight will that be?
I think, my previous point, I think that's a lot looser than it was previously. I mean, I think, we've just learned to live with this to a certain degree. Those that have jobs, which clearly is not, is not everybody, but those that do have a lot more money in their pocket than they have done historically. So again, I think the consumer is going to be pretty resilient here, certainly for the next couple of months. I mean, at some point we are going to need more stimulus. We are going to need these sort of cases to come down. But I think what we've seen so far is that we have a little bit of time here.
Ben, great to catch up, as always. Staying bullish. Ben Laidler of Tower Hudson Research. Some comments there on the United States. Here's a comment on Italy, the latest on their partial lockdown. Here are the restrictions, Tom. Bars and restaurants to shut at 6 p.m. Cinemas, theatres, gyms, swimming pools, all closing. Casinos, game rooms, all closing. Italians urged not to travel, asked not to invite guests at home. Shops can remain open if they guarantee social distancing. So it is not spring, Tom, but it's certainly not summer.
Yeah, it's not summer, and it is back on the edge of spring. Clement Fust with us earlier from EFO, and he made very clear this has been a surprise across the board to business as they read up. Look at SAP this morning. What did we know about SAP on Friday we missed today?
Downgraded their outlook. Caught up with the CFO earlier, Tom. Bizarre conversation.
You were on
earlier?
He
said he wasn't uncomfortable.
Really?
He said he wasn't uncomfortable, that he wasn't unhappy with the numbers. And I said to him, I think anyone long the stock is going to be unhappy with the numbers this morning. Are we going to see much more of that, Lisa? Cuts to guidance from corporations that didn't anticipate another wave of this.
I think that's a really important question. And people talk about fiscal support or fiscal stimulus. If it's just plugging an economic hole and not actually acting to stimulate the recovery, to accelerate the growth out of this, that's a big difference. And it has a longer deleterious effect on the economy if it's just debt to bail out an economy that's still hampered by the pandemic. And I'm not hearing a lot of projections about that going forward. And that, to me, is a big issue, John.
So we do the good news this morning. So that's the second reference to the fact that I was here a lot earlier this morning than I usually am. And I was covering the European Market Open show on Bloomberg. And that's because Mr. Miller sent me a quick text last week and said, baby's coming, and I need you to cover my show. So we have Edna Miller in our lives now. Matthew Miller, our co-anchor and good friend. He's a father, Tom. What a wonderful thing.
It is a wonderful thing, and the guy has absolutely nailed it because he's got the Kinderfreibetrag and the Kindergeld going here. Not only, you name the kid always, John, you name the kid always after the richest grandmother. I mean, that's a cardinal rule.
It's very smart.
Just, what you do. But John, what's so great about this is Lisa and I are slumming in America with no benefits. He's over there in the land of immediate child tax exemptions. And Lisa, the kid gets a child care allowance from day one. I mean, we would kill for that.
Yeah, here we have negative yields on children. They have positive yields on children, negative yields and everything else in Europe. That's what's, Well,
look
maybe
at the Kindergeld.
Try to push me out there.
Kindergeld.
I think it's fair to say, given Matt Miller's spending on all things engine related, that this child comes with a negative yield.
Hey.
Lisa, can you imagine what this child's going to be driving?
The daughter was almost named Harley.
Yes,
what do you want to
helmet.
know? I mean, he
Harley
wanted to go
Davidson.
with Harley, and Mrs. Miller went mental and said, no way.
Congratulations to Matthew and Maria Miller and their newly born daughter. Coming up on this programme, Mike Swab of Goldman Sachs, co-head of fixed income portfolio management from London and New York this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi says the chamber could pass a pandemic relief package this week. Still, a deal with the White House remains elusive, and the Republican-led Senate may not act before the election. Both sides accuse each other of, quote, moving the goalposts on the legislation. In the Senate, a final vote is set for today on Amy Coney Barrett's nomination to the Supreme Court. Confirmation is all but assured. Senate Democratic leader Chuck Schumer accused Republicans of using raw political power to get Barrett confirmed before Election Day. The British government is indicating it's optimistic about a trade deal with the European Union. The latest round of talks between the UK and the EU has been extended into the middle of this week. Earlier this month, Britain temporarily walked away from negotiations for a free trade agreement. And the parent of coffee and donuts chain Dunkin' is in talks to be acquired by private equity-backed Inspire Brands. According to the New York Times, the deal is valued at $8.8 billion and could be announced today. Shares of Dunkin' Brands have more than doubled since March. Inspire Brands owns Buffalo Wild Wings and Jimmy John's. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Retail, I think, is strong. We see a lot of people ordering online or going to the grocery store and buying and eating at home. We just don't know what restaurants are going to do this year in the state of Florida, which is the largest consumer of the crab.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
They keep moving the goalpost. We want it the sooner the better, and that's why we're making concessions. We're making concessions, too.
We don't even have the bill yet because Nancy Pelosi, and she's coming up, I know she can speak to this, but we've continued to make offer after offer after offer, and Nancy continues to move the goalpost.
Back-to-back interviews on CNN over the weekend with Speaker Pelosi and Mark Meadows, White House Chief of Staff. I think that's the blame game. And again, how many times have we done this? It's boring, isn't it? Here's the equity markets. On the S&P 500, we shape up as follows. On equity futures, we're down 29. We're negative 0.8%. Bit into the bond market. We just give up some of that. We were down 3 or 4 basis points earlier on this morning. 0.1861% is your yield on a 10-year. More broadly, through foreign exchange, through G10, it is a stronger dollar story, including against the euro. Euro dollar, 118.20. Tom Keene, shout out to our colleague Jen Jacobs down in Washington, who part-time seemingly is leading the track and trace initiative down in D.C., the latest being Mark Short of VP Pence's office. Just remarkable how some of these leaks are happening, Tom.
And more than that, more than the idea that Mr. Short, of course, so close to Vice President Pence in proximity, it's 5 people reported being ill around the Vice President as he campaigns, I believe, without quarantine and all the others. He's out there full force here in the 8-day dash. It will be extraordinary to see where we are 2 days from now and even 2 weeks from now. Kevin Cirilli joins us, our chief Washington correspondent. Kevin, I got 8 zeitgeist ways to go this morning. Let me go where Mike Allen is over at Axios. I want you to overlay these 2 big stories. Your conventional politics with a pandemic that's worsening. Mr. Allen goes to Montana and Wisconsin. How does the election change across the greater North, Middle West, and Mountain states?
It doesn't. You know, just in traveling the past couple of weeks, I think that there's a very different reality in those parts of the country outside of the coast where there's an acceptance of the virus and an acceptance of the risk that comes in terms of voting. You know, and just to note the trajectory, though, in terms of the polls and the early voting that we've seen in contrast with Democrats, you look at a state like Texas and Harris County by Houston, where Houston is, and the early voting there, the mail-in voting there has just skyrocketed. I mean, absolutely skyrocketed. I spoke with a Democratic strategist last night who said to me, the reason they're so bullish on Texas, which, you know, behind the scenes, they're trying to quiet down some of the expectations, but it's Harris County. I mean, when you look at the early returns in something like Houston, and it's why Senator Kamala Harris, the Democratic vice presidential nominee, is headed to Texas, because they're thinking, all right, well, maybe we should do that. And there's a map of the early voting per state, and it's more than 6 billion upwards of in terms of how they're shattering records in a state like Texas.
But Kevin, we're all one big walking Cook political report. Cut to the chase. What did Kevin Cirilli learn about the 47 polls out there in the last 24 hours? What is your tendency, your knowledge right now?
Well, look, I think the biggest unknown, this is really what it is that the biggest unknown is whether or not the mail-in ballots simply mean that there's blue voters. And so that's the biggest unknown. Because for as much as the president has criticized early voting, many Republicans are looking at the virus and are voting Republican, but are casting mail-in ballots for them as well. So, you know, it's hard for the pollsters and the data analysts to track whether or not early voting is going to necessarily mean Democrats. The way that they've been able to do it is by looking at traditionally Democratic-leaning parts of the states and suggesting that the early returns in those counties would mean a positive sign for Democrats.
Kevin, much has been said about the polls now and the polls back in 2016, but what we did see in the final 2 weeks of campaigning was some real momentum behind the president to close the gap right into Election Day. We don't see that right now, do we, Kevin?
Well, I think that they would say that they have it. Democrats would say that they don't. But to your point, in terms of the biggest unknown with regards to the flashback to 2016 and the Hillary Clinton emails and the letter that came out from Comey and whatnot, you know, that felt like a real a seismic jolt in the final weeks of the campaign. I will tell you that the president's campaign has seized upon some local issues such as energy policy. They are blasting that in Michigan, Wisconsin, and Pennsylvania. They feel that will be able for them to pick up votes on lost ground.
So it's not just the presidency, it's also control of the Senate very much at stake, and that's very uncertain. And actually, if you believe predicted, you could see a tightening gap there in terms of the odds that there will be this blue wave that's been increasing increasingly priced into markets. What's your sense of this theme? Republicans say they are registering more voters, more men who are white and who have not gone to college in particular, more likely to vote red down the ballot. How much is that going to change the calculus in the Senate front?
That helps them in Florida. That helps them in North Carolina. That helps them in South Carolina as well. Whether or not you have to be, it's very hard to understand whether or not the getting people to sign up to vote is the same with voter engagement of folks that have already been brought in the 2018 cycle, because the Democrats would push back on that data and say, well, they've been able to mobilize voters ever since 2016. So these numbers are so hard because both of the political parties are operating under their own metrics and their own rubrics. So it's very difficult to understand from a comparative sense whether or not they're actually actual. In terms of the down ballot and the Senate and the blue wave, here's what I would say. Look, I mean, you look at the markets and how they've priced in and how they've started to recalibrate and associate Biden with certainty. That's been quite interesting. And in terms of him being a little bit more predictable in his behavior geopolitically than President Trump, markets would view that as an asset. They would also view him much more to the center of someone like a Bernie Sanders. Beyond that, in terms of a blue wave, we just don't know. And someone like a Senator Tillis, I'm headed to Capitol Hill right after this. Someone like a Senator Tom Tillis, of course, there's the ACB confirmation hearing later this afternoon. All of those issues also playing, and quite honestly, playing in a mobilization effort from the left in many of the cities.
Kevin, you get to Capitol Hill. Great to see you, sir, this morning. Kevin Cirilli, Bloomberg Chief, Washington correspondent. Thank you, sir. Let's get to that poll just quickly from the Dallas Morning News that made so many headlines over the weekend. 46-44. Biden over Trump, a 2-point lead. And, Tom, you've mentioned Georgia all morning. The average of polls basically has them tied.
Yeah.
That's the politics this morning. Let's get to a headline that crossed the Bloomberg just moments ago. Tom, I know you've been following this story. It comes from Ant Group, Ant Financial, of course, and that much-anticipated IPO, seeking to raise up to $17.2 billion in the Shanghai leg of the IPO. Should emphasise the last part of that headline, Tom. So this is $17.2 billion in the Shanghai leg of the IPO.
This is a movable feast, and it's pieced together, folks. And what's so missing here, of course, is Western capitalism. J.P. Morgan helping out on parts of this offer. But I like what the South China Morning Post says, John. They sum it all together with over allotment at a ginormous $319 billion. I'm rounding that up. That's a little bit of a statement there, but really something here to see how this sums together, John, away from Wall Street, away from the city.
Everyone wants to know, Tom, will you reduce the cash allocation and allocate a little bit of money?
I can't. I'm looking for, I need an entry point in China.
Of course. From London and New York, this is Bloomberg.
Entry point.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
What would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated the dramatic impact of this outbreak.
From London and New York, good morning to you all. This is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio alongside Tom Keene and Elisa Bravitz. I'm Jonathan Ferro. 2 hours away from the opening bell this Monday morning. 8 days away from wrapping up voting in an election in America. Here's the price action on the S&P 500. A gap lower overnight. We stay there. We bounce back a little bit. We're down 30 on the S&P 500. Week of losses last week. A few more losses this morning, seemingly. Down 0.9% on the S&P 500. Risk appetite taking a punch. The dollar catching a bid. Euro dollar down to 118.24. Weaker euro down 1/3% against the US dollar. And in the bond market, last week a sell-off. We add 10 basis points to a 10-year yield. This morning, a rally. We come down 3 basis points on a 10-year to 0.8128%. We have to do two things. First of all, a shout out to Kathy Jones of Charles Schwab, who just dominated last week's programming. It's the only thing I remember from last week was Kathy Jones playing the piano on this program. That says more about me than anything else. Kathy Jones had this to say on the bond market, Tom. Let's take a listen to Kathy.
Playing piano, great.
We think 1% is probably the upper limit where we can go from here. I think at that point, the Fed may get somewhat concerned and we might see some yield curve control or maybe a twist to put a cap on it.
And, Tom, that was a take from many people last week off the back of that Treasury market sell-off. The question I asked repeatedly, and we all did, how self-limiting would that sell-off be? When would the buying start to come back in? When would people start to worry about higher rates? This morning, the bid is back.
You know, our pride here, folks, is not a lot of hyperbole, and John's absolutely right. John, we're range-bound, and we're up at the higher end of the range until you see legitimate breakouts. The other way I would go, John, is to go to the dollar and looking at the Bloomberg Dollar Index, which is very, very good math. It's on support, and that's all it is. It has not broken through.
Dollar stronger this morning. I keep going back to the euro, Tom. Euro dollar at 118.
Fair.
Given what Europe is going through right now, I think it's really, really interesting to see the euro still north of 118. Europe, more restrictions this morning. Italy shutting things down, not completely, but in a bigger way. A curfew in Spain, an economy that had lost momentum going into all of this, and real pressure building on the ECB again. This coming Thursday, Christine Lagarde going into that news conference, Tom. I don't think it's an easy one for her. I don't think people expect her to do anything Thursday, but I don't think this news conference is an easy one.
Yeah, well, you know, very simple. Swedish krona stronger against euro, but within the range. It's not excessive. And, John, I would go from September through this October as being range-bound. I mean, our next guest is really good at identifying when you come out of those ranges, and we haven't.
We can bring Mike Swell in now. Goldman
bring
Sachs
him in.
co-head of Global Fixed Income Portfolio Management. Mike, great to catch up with you, sir. I'm sure you heard a part of that. Can we just start with this 10-year Treasury range we've been stuck in for a number of months now, between 50 basis points and 95 at a high end in early June? Mike, do you think we've got the setup in front of us to break out of that?
Sure. First off, Jonathan, I don't think I can match last week's piano. My office is not large enough for a piano, but I could play a little kazoo
I won't ask,
Mike. If that makes your week. In terms of the range on the bond market, I think that the depth of the bond market rally has been just, that story's been written way too many times. There's still yield, there's still balance in fixed income relative to equities and other risk assets. And as long as you have investors that are long risk assets and need some level of diversification, as long as rates are zero or negative almost everywhere in the world, the 10-year Treasury at 80 basis points offers, number one, balance for your portfolio and some hedge efficacy. And secondly, there is yield in the fixed income market. And 80 basis points may not sound like a lot, but if it rallies to 30, that's a significant total return. So I think that people are writing off the bond market too early. And I think that right now with the 10-year at 80 basis points, there is value there with the Fed on hold for the foreseeable future.
Yeah, Mike, that's right where I wanted to go, is within the internals of the market. We do that in the equity market all the time. What do you see on your desks of the appetite and the bid-ask? I mean, there's a wall of money out there. I get that. But what are the internals you see in that bid, that demand for fixed income paper?
So we don't see a lot of the fixed income universe way overweight duration or way overweight treasuries. What we look at is we look at a lot of the funds that are out there and to see how much, where they stand relative to the benchmark. And you're seeing investors right now anywhere between flat and somewhat short duration. So that, from a technical standpoint, is a very positive technical for the bond market. I would say that the other very important point is kind of the volatility that we're seeing now in equity markets and that we're likely to see going into year end. It's likely to have a positive impact on the Treasury market as investors look for flight to quality. And in the near term, it may even have a positive tailwind towards the dollar as well as the flight to quality currency.
Here's what I'm struggling with, Mike. You say that there's probably going to be buying of treasuries, and yet I was reading your notes, and you're bullish on high yield. You're bullish on the riskiest credit. Isn't there a contradiction here that if people are looking for the safety of treasuries at sub 1% yields, why would they be confident that they're going to get any of their money back with a high yield bond?
Well, I would say, first off, there is a lot of merit to owning growth-related assets and things like high yield that have not benefited as much from the Fed coming in and buying everything in the investment-grade universe, buying treasuries and buying mortgages. They've kind of been left out there, and there's still a decent amount of yield in the high yield market. The benefit of treasuries paired with credit is very significant. When you go long duration paired with credit, you actually create better balance in a portfolio. So in the event that there is a risk off, actually treasuries would rally. And in the event that there's a improvement in growth and treasuries may back up, you would see credit spreads tighten very significantly. So number one, I don't think that that's an inconsistency. Secondly, I think that when you invest in things like high yield and other fixed income related assets that are not treasuries or agency mortgages that are very liquid, you think longer term. And longer term, we do believe that you're going to have improvements in care for COVID. We're going to get back to better growth next year. And so as a result, you want to stay long growth related assets. But as we look at what's setting up right now in terms of the potential for election volatility, the potential for funding issues at the end of the year as banks are not in a great capital position to be able to provide a lot of liquidity to markets, we actually want to be in a position where we have a little duration going into that, but you're also in a position where you have dry powder to take advantage of dislocation coming at the end of the year.
Oh, well, hold on a second. Let's unpack some of that. You said dislocation into the end of the year. In other words, you're expecting some of the riskier credit to potentially sell off and potentially significantly heading into year end, and then you're going to be buying. What's your entry point?
So I'm really trying to divide the fixed income universe into two. One is the credit-related assets where you're relying upon growth improving next year, earnings improving on the margin, and just getting paid back. And in trading credit, it's very hard to jump in and jump out pre-election, post-election, going into year-end. So long-term, we still very much like owning credit. In the very near term, though, we look at factors like volatility. And so we look at VIX, we look at bid-offer spreads, as Tom was talking about earlier, and we get a little concerned that there's going to be volatility going to the election, and there's likely to be volatility going to year-end from a funding standpoint. So what we've done is, instead of reducing positions in credit-related assets, which are going to be dependent upon growth and longer term, we're trying to free up balance sheet and portfolios to be in a position to take advantage of dislocation. And that may be even things as basic as cash futures basis in the Treasury market, something that blew up during the COVID crisis, blew up in previous funding crisis, where you can earn very, very attractive returns by deploying your balance sheet.
On radio and television this morning, our simulcast, Michael Swell with us with Goldman Sachs out of Brandeis and LSE a few years back. Mike Swell, right now, what Lisa and I know with John Farrow is interview after interview, everybody says they're buying China debt. All my radar's up just because everybody seems to be in the trade. What's the risk, or what's the thought you have on what could be out there in 2021-22 for the certitude of owning China debt?
Well, I think you have two factors that are a risk to owning Chinese debt. One is the risk that growth and that the Chinese economy is very insular and continues to recover at a pace very different than the rest of the global economy. In the event that that does occur, that could create a situation where the Chinese central bank provides less accommodation, and you actually see rates rise and inflation pick up in China. That's a real risk. The other risk is that from a credit standpoint, people get concerned again about China, kind of the other side. And while the central bank has the ability to lower rates, you could have a situation where there's credit concern. I think that's less of a concern. In the end, rates are attractive in China. Rates are in the 3.25 area. They're meaningfully higher than they are in the rest of the globe. We don't expect to see inflation running away in China. And so the real rate in a country like China is actually somewhat attractive. I'm not overly concerned. That doesn't feel like a crowded trade. There aren't a lot of investors that have the ability to be able to invest in China debt that you're overly concerned that it could be one of these crowded trades, but something obviously watch pretty closely.
Mike Swell, I got a question. You were a ginormous basketball player at Brandeis. Did you really cut practice once because you wanted to go see Al Gore? Did you really do that?
Oh, my God. You really did your homework. That was from 1980, the 1988 election. And actually, it was true. I actually worked on one of the presidential campaigns and was very active and involved. There were about 8 Democratic candidates at the time. And I actually did go to the coach, and the coach rolled his eyes and said, "We don't do that here. We're here for basketball." And I said, "Coach, no, I want to see Al Gore. I want to hear about that new Green Deal 35 years ago before the Green Deal was really a thing." And so actually it is true.
And John Farrow, I would say that Brandeis basketball back then was the real deal. Were they doing Final Four? No, but it was the real deal. Very competitive program.
I would love to know what David Solomon would have to say if Mike gave him a quick call and said, "I want to go see AOC and talk about the Green Deal." Mike, you won't answer that one, Mike. Don't worry.
John.
You don't have to answer that one.
You get him in trouble.
Mike Swell,
appreciate that.
Goldman Sachs. Thank you. Thank you very much. Let's get to the bond market just quickly. 2s, 10s. We talked about this chart last week. We've topped out at about 70 basis points twice now in the last 6 months, and we've done it again. Seemingly, we've almost done it again anyway, Tom. Last Friday, breaching that level, and then we roll back over again, and we keep talking about the potential limits of this sell-off on the long end, and to some degree this chart speaks to that, Tom.
Yeah, absolutely. I mean, it's just uncertainty out there. Let's be honest, and as so many people said, Marty Schenker was brilliant earlier, that, it's about the presidential election, yes. But, John, the uncertainty here about a president with a Senate on the same side or a president with a different party Senate is really the key issue.
Much more still to come on Bloomberg Surveillance. Coming up next, Lawrence Costin, Georgetown University professor from London and New York this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz. With futures down 30 points, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi and the White House accuse each other of doing the same thing when it comes to a pandemic relief plan, and that is, quote, moving the goalposts when it comes to what's in the actual legislation. Pelosi says the House could pass a bill this week. Still, an agreement with the White House isn't certain, and the Republican-led Senate may not act before the election. Joe Biden calls Republican questions about his son Hunter's business deals to prevent live wires from falling into dry bush and starting wildfires. Winds as high as 50 miles an hour swept through an area north of San Francisco. The blackouts may last until Hong Kong. Together, they would raise about $34.5 billion. That would surpass Saudi Aramco's record $29 billion share sale last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
Many of our greatest companies and labs are coming out very quickly with the vaccines. They're doing great, very shortly, very quickly. It's going to be delivered fast. That will quickly end the pandemic. It's ending anyway. We're rounding the turn, but the vaccine will get it down fast.
They didn't tell us about the virus. The administration gave Wall Street investors no heads up. He didn't tell us He just told his Wall Street friends, and that's why they made so much money by, quote, selling short in the market. They knew what was coming. But what happened to the rest of us?
President Trump and Vice President Biden holding rallies over the weekend with 8 days to go. Over the weekend, Tony Fauci speaking to the BBC, seemingly backing the president's timeline for a vaccine, Tom, saying the following: "We will know whether a vaccine is safe and effective by the end of November, the beginning of December." That's Tony Fauci there, the National Institute of Allergy and Infectious Diseases director, speaking to the BBC over the weekend, Tom.
Very good. And Mr. Fauci, of course, always controversial. Right now, to dive into this, and we could literally do a one-hour conversation, maybe split it down the middle on pandemic and also on the Affordable Care Act, is Lawrence Gostin, Georgetown University professor. His claim, folks, is real simple. Other than the great Uwe Reinhardt at Princeton, nobody owns a high ground on public health like Lawrence Gostin. Even his harshest critics always read and always listen to Professor Gostin. Thank you so much for joining us again. Sir, I want to go to the Affordable Care Act, and I heard one line from the president, I believe it was in the debate, I can't remember in the blur, but there was that classic Republican, ancient conservative line on socialized medicine. If we do this, if we do that, this will be an America of socialized medicine. Where did that train of thought come from?
You know, I just think it's political. I just think it's just it's a political talking point. It's not socialized medicine. It's far from it. It wouldn't even bring us close to what is in Europe, the National Health Service, the German system, or the Japanese system, you name it. What it does is it's still a predominantly private insurance market, overwhelmingly so, still mostly employer-sponsored health plans. But there would be a public option, which just means that if somebody wanted to, they could sign on for their public option. Same way you could sign on for Medicare or Medicaid. So it's basically one of the options in a really discombobulated American health system. But right. I think it'll drive down the uninsured rate. For sure.
I mean, if we have 85% insured, 15% uninsured as a general rule, the great fear of the core Republicans and even those in the middle is they're going to end up paying for the medicine of the 15%. Is that where we're heading in 2021?
No, I don't think so, because there's no evidence of that. There's really no evidence that there's a cross-subsidy from our private insurance system now to our public systems, whether it be Veterans Administration, Medicare, or Medicaid. No, you don't really have any kind of cross-subsidization. What you do have is a cross-subsidization through the whole market, and particularly in the private insurance market, that the young and healthy they cross-subsidize the old and the sick, and that's the way insurance is designed to be.
So, Professor Gostin, as we talk about the infrastructure of healthcare in the United States, it's important to take a look at the rollout of the vaccine. People pinning their hopes on a vaccine, and yet the more that I read about it, whether it has to do with the rollout, whether it has to do with the efficacy of said vaccine, whether it has to do with dosing and who gets what when, this is incredibly complicated. How long is this going to take before we can actually count on some sort of herd immunity or actual effect to stop the pandemic?
Yeah, you've really asked just exactly the right question, because, Tony Fauci, and Tony and I go back many, many years. He's a very close friend. He's got great judgment. Said that he was going to, we thought we would know whether we had a safe and effective vaccine by the end of the year, this year. And, we will. We probably will know. But that's just really... That's really the race, the gun that's shooting the race off. What we really need to know is when that vaccine is going to be delivered and taken by the population. I don't foresee that, and neither do my colleagues, until the second or third quarter of the year. There are monumental problems that we've got. It's going to require 2 doses. We don't know how effective it's going to be. It might be more like an influenza vaccine, which is not fully effective. So it's not going to make the COVID go away. There's no way that's going to happen. We're probably still going to need to distance and mask up for a while. So I don't see herd immunity coming, certainly not in 2021. But I think, by the end of 2021, we'll be rounding the corner. And that's what I've always predicted based upon historical evidence of other pandemics about when this pandemic is going to end. But we'll still live with COVID. I mean, it's here forever. But I think it's going to be something that we'll be able to manage, go back to normal.
Meanwhile, Professor Gostin, we are at a tipping point, a lot of people say, as the number of cases spikes upwards. Talking about the exponential factor of this disease, what's your biggest concern right now heading into the winter months?
Well, I'm worried that there's going to be an escalation. If you think about it, I've been saying, and so have many of my colleagues, that it's not too late in the United States. We can still do the right thing. We can still get our testing regime up, our contact tracing. We can still have universal masking and social distancing. We can do those things, and we can dramatically move the needle down. But it's become painfully obvious to me we're actually not going to do that. We've been saying it now for 9 months, and there's so many conflicting messages out there from the top down that, it's clear that the population isn't going to do it in the numbers that we need to in order to make a difference. And so I foresee continuing rises all winter as we're kind of moving indoors. We've got family gatherings. People are going to have pandemic fatigue, go see friends, go to the restaurants, and even the bars. And so the vaccine's going to be needed. We're going to have to wait for the cavalry. We're going to have to wait for treatments like monoclonal antibodies, which the president got to go mainstream. And sadly, it's going to be a blazing fire until the cavalry come.
Professor, appreciate your time this morning. Please come back soon. Lawrence Gostin there of Georgetown University. Thank you, sir. The confusing messaging around masking, Tom, at the outbreak of this virus, when it really started to spread through the United States through the spring, still seemingly struggling to get that message back on track. That was a mess. And I think when we look back, for whatever it's worth right now, I'm not sure it's worth much, but when we look back in years to come, I think we will look back at that moment as one of these moments. This really got messed up.
Well, messed up right now, too. That interview we did, I'm going to say 10 days ago with Dr. Murphy of Northwestern University, was heated about the mask factor in this explosion of cases and hospitalizations that we see in the northern Midwest. So, I mean, that was just one of the conversations that we had on that.
End of 2021. That's my takeaway from that conversation.
Yep.
April became May, June, July, August, then the end of 2021.
Where are we looking to now?
Coming up on this programme, Greg Peters of PGIM Fixed Income from London and New York this morning. Good morning. Futures down 1%. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We're in an environment now where there's much less leverage in the equity market.
This is a market that's thinking at some point stimulus is going to happen.
We have just huge levels of debt, and we don't want to get into a debt trap.
The Fed has a lot of upside to accelerate. I think they're going to maintain this pace.
We are having this income cliff at a time when actually the consumer is supposed to go out and spend.
COVID is the great unequalizer. The strong get stronger, the weak gets weaker.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. A simulcast on Bloomberg Radio, Bloomberg Television. In 8 days, an election. It is truly an 8-day week across this nation, and indeed those watching around the world. And John, the confluence here this morning, I mean, futures off 33, I get it, risk off, but the confluence here of really grim news worldwide in the pandemic, along with major uncertainty on the United States Senate elections, makes for an interesting Monday.
Couldn't agree more, Tom. And the complexion, the composition of Congress, all about what happens next with fiscal stimulus for market participants. Right in front of us now, though, playing out for everyone to see the increase of infections in the United States, in Europe, and the extra restrictions coming down in Italy and Spain as well at a time when this economy was already losing momentum. So this morning, what have you got? An equity market that gets hammered in Europe, and equity futures on the S&P down almost 1%.
Okay, but John, this is important, and folks, full credit. I hate to say this because John's only with us for a brief hour today on Bloomberg Television. But John, the basic idea that I have is that you were way out front on this. I guess if I'm an SAP shareholder, which I'm not, I'm a little surprised off where it was Friday at craters in Germany, and you pull that over to what Lagarde does at the European Central Bank. She's got to worry about uncertainty and declining aggregate demand.
SAP, software company, cutting its outlook. That's never good, is it? It's not even a big cyclical name, Tom. It's not even a big industrial name on the DAX. It's a software company, and it's cutting its outlook because business spend is uncertain. The outlook for this economy is uncertain. You bring up President Lagarde, the ECB chief, this coming Thursday. Look, for what it's worth, I don't think people expect her to do anything this coming Thursday. But wow, is the pressure building on policymakers in Europe to do more, to insulate this economy? I think the good news this morning, take a look at the Italian bond market. It's solid. It's resilient. And that tells you this is about concern about the European recovery, not so much about Euro breakup. And this time around, we're not conflating the two issues, and that's good news because right now, that's the last thing Europe needs.
Futures here, -3, or into 3 basis points, rather, on the 10-year yield, 0.81%. And you really don't see that in Europe with Swiss 20-year not doing what we see in the United States. Lisa Abramowitz, before we go bond talk here with Greg Peters, let me ask you, rather, about full faith and credit versus what you read over the weekend on IG and on high yield as well.
Well, people are bullish. I mean, we heard that from Mike Swell of Goldman Sachs going further into high-yield debt. My question, to John's point about the rising virus count, we have a bridge to the other side, but the other side is getting further away, possibly the end of 2021. How much bigger does that bridge have to get? How much longer? And if it doesn't, what happens to all of these companies that are having to ratchet back their profit forecast, Tom? An important question.
And I'm going to do this. This is totally idiosyncratic. This helps out Lisa with her morning drinking game, which is on Turkey and Erdogan. We've got a set of headlines coming out from Mr. Erdogan, and this follows off the argument with the French over the weekend. Turkish President Erdogan urges boycott of French goods. I mean, it's as simple as that. And lira blows out 8.08. John, this is an unraveling. I mean, John, to you in London, is this completely idiosyncratic, or does Turkey roll over into other challenges for NATO, for Europe as a NATO member?
Well, a couple of things going on here, Tom. Of course, France recalling its ambassador to Ankara over the weekend, and this has been boiling up for quite a while with the tension between Armenia and elsewhere, Tom. And in the FX market this morning, though, I would say this is not just idiosyncratic Turkey. I would say you've got a much stronger dollar. You see that against the South African rand. This is the last thing Turkey needs. The problem that Turkey's got, the biggest issue, I think, is faith in policymakers to do what market participants believe is the right thing. The right thing to do to respond in a crisis. They lost that capital a long time ago, and they've never really been able to build it back up.
And this is great. Greg from Newark, New Jersey emails in and says, Tom, talk log dollar lira. So we're going to talk log dollar lira right now, and all you need to know is we're out over 2 standard deviations weaker on that move to 8.08 on Turkish lira. Right now, to get things started, Gregory Peters joins us. He's with PGIM, with real portfolio management, money at risk, fixed income, head of multi-sector and strategy, and he's won a trophy set of awards over the years and all that as well. Greg, I love what you say. This is a market assisting bondholders and not stockholders. What do you mean by that? That policy and all of finance and capitalism's working for bondholders right now?
Yeah, so I think we're in this environment still, and we're talking about the path of the virus and rolling shutdowns and pullbacks and fiscal stimulus. I think what that really does at its core is really keep companies conservative, right? And being conservative benefits bondholders over equity holders. And so what you're continuing to see are companies worried about the path of the virus, rightfully so, and so they're retrenching. And so you're not going to see the same type of activity where bondholders are put to the side and equity holders are put forward. So I think that's the environment that we're in. I know it's perverse, but that's bond market investing.
Greg, we've seen some huge bond issuance, some huge bond supply through 2020, through this pandemic, from both investment grade and high yield. Can you draw a distinction on what that money's being used for this time around and whether that plays into the argument you're making?
That absolutely plays into the argument. So at the surface level, you see the headlines of all this issuance. It's somewhat scary. But then when you look a little deeper, what you see are that companies are actually terming out their existing debt at lower coupons and paying down their higher coupon short debt. So in effect, what they're doing is that they're putting their balance sheets in better shape, not worse shape. At the same time, they are preparing for additional liquidity measures. And so those two things put together, I think, put bondholders in a better place, not a worse place. So it's really what you're using the proceeds for. It's not like you're using the proceeds like you have in the past to buy back equity. Right. So you're not doing that. And I think that intent and that purpose really benefits being a bondholder in here.
Greg, the credit market, not a monolith. You've got investment grade corporate issuers perhaps doing what you say. On the high yield side, I've read an increasing number of articles about PIK toggle deals. Basically, if they don't want to pay their interest, they just put it on their debt balance. You see also dividend recapitalizations, basically private equity firms having their portfolio companies borrow more money to give them a payout. How does this fit into the conservativeness that you're talking about?
Yeah, so I think you're always going to see that type of transaction, but it's not really happening en masse. And so you can always pick to a certain deal that happened that's maybe pushing the limits, but it doesn't really tell you the broader story. And the broader story is the one that I just described. So I think that's the important piece of the puzzle. Don't get drawn in by these idiosyncratic kind of news stories. The broader story is one of balance sheet repair, and I think that's the driver.
Let's push the politics through this conversation as well, Greg, going forward. Sector to sector, what you're looking at the moment and the kind of permutations that you guys are all talking about at PGIM as far as the election is concerned.
Yeah, so the election obviously is at the fore. Really, it boils down to what's the new regulatory construct and the tax construct. And so, look, I mean, I think it's still worthy of kind of examination, but I just say a couple things. First and foremost is that I do think if you do have this kind of blue suite that seems to have really captivated the market in here, that does benefit the consumer as it could kind of fuel continued kind of wage growth and just economic growth. But the one area that we see differently than maybe the equity market and some other areas is the financials. So to me, it's really hard to see a situation where there could be much more regulation to damage kind of the ability for financials to operate. So my comment has been it's hard to kill the patient twice. And so I think it's really a pretty benign environment, all else equal, if there is a leadership change on the financial side. And then finally, on the energy front, this is highly controversial. Many investors are looking at energy. Obviously, it was the center of the last debate. But the truth of the matter, the energy companies haven't really benefited either equity holders or bond holders over the past several years. So some kind of change and alteration in the spending mix and maybe being less profligate isn't such a bad thing. So I'm actually pretty excited over the alpha opportunities within the energy space going forward.
Greg, the great understanding is that bonds as a hedge don't work anymore, so I got to go find something else, whether it's preferred, bank preferreds, et cetera, or 47 other intangible assets as well. Is that going to happen? I mean, a bond is a bond. A fixed income as a hedge is just what it is, a predictable stream of cash flows. Can there be an alternative?
I think there can, but it's way too early. So I agree with Mike Swell, who was on previously. I think it's way too early to call the death of the bond market. But this is really picking up steam as a story. But I mean, we're in an environment where real yields are negative, right? So the fact that you're getting 70, 80, 150 basis points, depending on where you are in the curve, matters a lot relative to that. So I still think bonds add a lot of value to the portfolio. And there's a thing called risk adjustment. So you are getting a return for a lot less risk, and I think that matters. So there's this big storyline going on around the death of the bond market and 60-40's dead. I think it's way too early for that. And bonds do what they're supposed to do. You see it today, and I'll believe you'll continue to see it. So I'm so bullish on the outlook for bonds. And in fact, I mean, I think it's going to be somewhat volatile here over the near term within a confined range, but I think the back end of the curve has actually value here. And so we're actually pretty constructive on the level of yields in the U.S. bond market.
Greg Peters, bond specialist. Bonds aren't over. Greg Peters at PGIM. Great to catch up with you, sir. As always, thank you. That's my only dig. It's a light one. Greg, great to see you, sir. This coming from Jonathan Swan of Axios, catching up with Ted Cruz after the Trump-Biden debate. Ted Cruz saying the following, Tom, very short line. I'm very worried about the debt. Now, on the surface of things, of course, we can poke a lot of holes in that statement, but it's interesting to see where this Republican Senate is going to be heading in the next few weeks, even after the election, and what Republican senators sound like when it comes to the issues of debt, Tom.
Well, there's two things. There's debt and deficit. Those are two separate things, and all we know is they're both going in the wrong direction.
From London and New York this morning, good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi says the chamber could pass a pandemic relief package this week. Still, a deal with the White House remains elusive, and the Republican-led Senate may not act before the election. Both sides accuse each other of, quote, moving the goalposts on the legislation. And President Trump's chief of staff, Mark Meadows, says the U.S. is not going to control the pandemic. Meadows told CNN the government's response will be focused on vaccines and treatment, not containment. Meanwhile, Vice President Mike Pence's chief of staff and 2 other staff members have tested positive. Pence's latest test came back negative. In the Senate, a final vote is set for today on Amy Coney Barrett's nomination to the Supreme Court. Confirmation is all but assured. Senate Democratic leader Chuck Schumer accused Republicans of using war political power to get Barrett confirmed before Election Day. And Ant Group is now on course for the biggest IPO ever. The fintech company founded by billionaire Jack Ma has set the prices for the dual share listings in Shanghai and Hong Kong. Together, they would raise about $34.5 billion. That would surpass Saudi Aramco's record $29 billion share sale last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
I think what we want to do is take a consumer-first approach. We really want the consumer to guide us on how they want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Not moving much right now. I mean, the two sides are still talking. The clock is ticking, as you know. Be very difficult. Even if you had a deal in the next few days, I don't want to predict anything. I'm just saying there's more agreement than there was a while back. There are still policy disagreements.
Larry Kudlow there, National and Economic Council Director, catching up with us to close out last week. Coming into this week, no talks about talks this Monday morning. Good morning to you all. Here's the price action on the S&P 500, a gap lower, maybe possibly off the back of the fact there are no talks about talks. That's Lisa's favourite line. Futures down 36, negative 1% on the S&P 500. The bond market with the bid yields in 3 basis points to 0.81%. Just got to say, Tom, on two big issues between the administration and Speaker Pelosi on liability protection, on state aid, just doesn't seem like we've moved the dial on that at all in the last 30 days.
No, absolutely not. It's not there, and it's not there for state aid or city aid. And it's not a shock here. It is political, which is what you get 8 days to an election. On the political, on a careful analysis of all these policy decisions, Jacob Parakilas joins us now with LSE, their ideas, where he is an associate. Jacob, I want to talk about the election, and as John mentions, policy forward. What kind of gridlock is the next gridlock? Trump presidency, Democratic Senate, Biden presidency, Republican Senate. Define that gridlock.
Well, I think you're more likely to see a Biden presidency and a Republican Senate. It's very hard to imagine an electoral map that would produce a re-election for the president, but a Democratic Senate majority. I think if you do end up with a Biden presidency and a Republican Senate, the gridlock is going to be, in the first instance, about personnel. The Republican Senate is not going to have much interest in confirming Biden's first choice for a lot of his economic policy positions. You will probably be able to get through Biden, I'm guessing, is going to have sort of relatively establishment choices for foreign policy and defense posts, and I suspect there will be enough Republican sort of acquiescence to the idea that those are fundamentally important for national continuity that those people will get through. But there will be huge dissension over economic policy posts, everything from Secretary of the Treasury down to Fed board posts to people in sort of assistant secretary roles at Treasury and Commerce. And then that's before even getting to the question of stimulus, which will be, again, a huge gridlock.
But well described, and I bring this up, Jacob, because so much of this is about the gridlock and the anger of all Americans that nothing's getting done in Washington. I mean, frankly, Mr. Trump campaigned on that in 2015. The level of anger in this nation, can a gridlock Washington deal with that? I don't see it.
No, I mean, I think there needs to be a fundamental change in the relationship between Congress and the White House. It's become extraordinarily dysfunctional, except in situations where you have a Congress wholly controlled by the same party as the White House. And even that, we saw that in the period from 2017 to early 2019. Even that doesn't produce the kinds of results in terms of new legislation, in terms of filling vacant positions in administrations. I think a Biden administration and a Democratic Congress would probably have lesser and certainly different problems than a Republican than the Republican administration and the Republican Congress that we saw. But that's not to say that it would magically fix everything. There would be other issues, particularly since obviously the economic and social circumstances of America circa 2021 are dramatically worse than the circumstances circa 2017, 18, 19.
Jacob, are you anticipating any parallels to the situation coming out of the last financial crisis, or do you anticipate something marginally different?
I think it will be, obviously everyone has had the experience of the 2008-2009 crisis, not least of all Joe Biden. I think everyone has sort of looked at that and tried to come up with solutions and responses to the things that didn't work with the stimulus package and the sort of slow, grinding recovery that took place after the 2008 collapse. Again, a lot of this is dependent on Biden having a relatively friendly Democratic Congress to work with, and the Democrats in Congress being willing to, go along with the administration's initiative, which is not a given by any stretch of the imagination. A Democratic Congress, assuming a Democratic Senate next year, you will, under any circumstance, have a much smaller majority, but also a more or less more ideologically narrow caucus. The Democratic Party in general has moved not as far to the right as the Republican Party has moved, but significant to the left. And the most moderate members are not as conservative as the most moderate members of the Democratic Senate in 2009. So I think you'll see a little bit more ideological coherence, but there will still be debate over the appropriate amount of aid going to the entertainment industry, for instance. That's something that some states have an enormous interest in, and other states it's more peripheral to other issues of state aid.
Jacob, one aspect that you pointed to was that if Trump loses, there is no chance of some sort of fiscal stimulus getting passed before Biden takes office. If Trump's reelected, that means that he will pass something, and is a higher likelihood, but that it would be targeted to states that supported him and not those that were against him. Can you talk about how that will play out in terms of the economy?
I think what he would seek to do, what he's set up as a possibility, is that aid to states would be conditioned on reforms in states that have resisted some of his immigration policies, some of his economic and social policies. Typically, it would be saying, California, New York, you will get aid, but you have to get rid of sanctuary cities. You have to be more draconian. You have to, sign a pledge saying that you won't ever reduce law enforcement budgets, that kind of thing, which would be an incredibly difficult pill to swallow. Of course, the irony, especially with law enforcement budgets, is, if the state aid doesn't come through, those budgets will be slashed anyways, because states are going to have to start making incredibly difficult calculations, and there's no way to maintain the same level of spending on everything, including law enforcement, as has been the case up until now. So I think states have some leverage to push back, but obviously not as much as the federal government. At the end of the day, the federal government just has much more leverage in this. And if Trump wins, even if he squeaks through, I think, you can imagine a Biden squeaking through or a Biden landslide. Given the polls, I think it's impossible to imagine a Trump landslide. But, if he squeaks through, he will act as though he has unlimited political capital. And I think that'll set the boundaries very strongly of what that aid package looks like.
Jacob, looking out 8 days and beyond many years. Jacob, fantastic to catch up with you, sir. Jacob Parakilas there, LSE Ideas Associate. It's the price action. Can't get away from this right now. A bit of a sell-off, 1 hour away from the opening bell. Equity futures down. Dollar lira, Tom, with an 8 handle. Just wow. Here's a headline from the Turkish president, Tom. The French leader needs a mental check. Seeing a lot of that recently, aren't we?
We are. I believe Mr. Macron commenting on that this weekend to Mr. Erdogan.
From London and New York this morning.
Actually,
Good morning.
Pharaoh commented on that about Mr. Keane.
David Page. I usually do that in a commercial break, Tom, not live on air. But I think people know.
We do. Thank you.
can get a warm burger, soba noodles, even a bowl of curry rice. In a city like Tokyo, vending machines seem to be everywhere. There are literally millions in Japan, and it's a big business, selling $44 billion of goods in 2016. With COVID-19, those sales are slowing down, which means getting rid of unprofitable machines. Vending machine sales were already falling even before COVID, with competition from convenience stores that are open 24/7 and have way more options. But there is hope for some of them. About an hour away from central Tokyo is the Retro Vending Machine Park. Here you'll find 50 or so machines side by side selling some quirky items. Turning vending machines into tourist attractions may not be a solution for bigger business, though, since it requires labor and efficient distribution. Saito says it takes 5 people a day to restock his machines, just in time for lunch.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
From London and New York, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 60 minutes away from the opening bell this Monday morning. Just a little bit of risk aversion to kick off the trading week. A week of losses last week. We add to that. We're down 34. We're negative about 1%. Losses across the continent as well. Dollar stronger, euro weaker. Euro dollar still just about above 118 at 118 and around about 20. In the bond market, there's the move for you. The bid is back, down almost 4 basis points on a 10-year to 0.8060%. Quite clearly, one of the big stories around the world, in the United States and Europe specifically, has been the increase of infections of COVID-19 and the additional restrictions we're starting to see from some of the biggest economies on the continent. This is what Mohammed Al-Arian, Queen's College Cambridge president, had to say.
Going on, and we will see more and more dispersion going on, because in the West, we are not doing a great job of living with COVID, and COVID is the great unequalizer. The strong get stronger, the weak gets weaker.
And that has been the story through the last 9 months, Tom Keene. Is it going to change? That's the question going into 21.
Let's make very clear here, folks, for those just getting up to speed on a Monday, there has been a massive change over the weekend in pandemic dynamics that does fold into, of course, GDP estimates. Some of that, the shock, say, in Germany today that we saw was software provider SAP down large. David Page joins now with the French insurance giant AXA, where he is head of macroeconomics. David, a perfect day to speak to you. What is your fourth quarter shape up as? U.S. GDP, EU GDP. What does the final 3 months of 2020 look like?
So for us, we've been spending the last sort of 4 weeks really downgrading that outlook for Q4. I mean, Q3 still looks good. Q4, we've been reducing. So in the US now, we've got a quarter-on-quarter view of just under 1%. We're looking at about 0.8% coming in for that final quarter. Of course, it does depend a little bit on the momentum coming out of Q3. We'll learn that towards the end of this week when we get the Q3 numbers. But for Europe, perhaps even a bit softer. I mean, obviously, Europe is really the epicenter of this re-emergence of the virus coming through now, and we are seeing restrictions being reimposed. So we're seeing growth that could come in almost close to flat. Now, we're not looking at contraction coming through, so there's some relief there. But these economies are desperately weak. We've seen huge drops in output in European economies in the second quarter. We are expecting pretty strong rebounds in Q3, but we should have been seeing ongoing growth coming through. And if we do get something that's closer to zero across European economies in the fourth quarter, that suggests a pretty soft backdrop for 2021, and it suggests that it's going to be difficult to get the people back in jobs. The unemployment rates are going to be trending higher.
David, so much of this is the great divide between American finance and economics, which is sort of growthiness and percent change, versus the level that I see in old world economics. Carl Weinberg mentioned this earlier this morning. What is the level that you see of growth and all these other trends out 36 months or 48 months? Do we get back to normal, or do we level out at a lower range?
I think we're still rising. I mean, our projection is not that we level out at a lower range, that we're sort of trapped in a sort of somehow glass ceiling that stops the level getting back. It's just that we've dropped so far that even with these large pickups coming through, the level is still far short of even where we were at the start of 2019. At the end of 2019, and of course that's not where you've got to get back to. Normalcy isn't about getting back to the end of the 2019 level. It's about re-establishing the trend growth that's emerged over that period, and that's going to take a long time. Now, there are a lot of unknowns. What we do know is that the economies aren't going to get there on their own. The monetary policy authorities are continuing to provide a lot of stimulus, so that will give some tailwinds to growth. We are expecting we're seeing fiscal stimulus across the Eurozone already being extended. We're expecting that to come through in the US under any electoral scenario. We do expect another short-term stimulus package to come through, but there is a prospect under certain electoral scenarios that you'll get a medium-term boost come through as well. Obviously Congress would probably be able to put through some medium-term fiscal stimulus. And thirdly, what markets have been looking for some time is a vaccine. Looking at next year, one would have to suggest the likelihood is we will see a vaccine start to roll out, and that will have a positive impact on the economies. So all of these things are going to give the economies some further impetus, but they really have a lot of ground to recover.
David, every crisis that we've come out of in the last 20 years, trend growth has been lower, our tolerance for higher interest rates has diminished, and the ability of central banks to stimulate us out of this mess has been eroded. Bob Prince of Bridgewater spoke really eloquently about this last week. When you look at Europe right now, David, even before coming into this, trend growth was just about 1%. What's trend growth going to be coming out of this?
Well, I think there is a fundamental mindset shift that is going on now, and we are starting to see European leaders talking about how they're going to stimulate the economy over the medium term, how they're going to provide governments spending into sort of clean energy, and areas where you might see some infrastructure boosts, some large multiplier come through, and hopefully some productivity lift. And ultimately, that's what we're talking about. I mean, part of the reason we've seen trend growth lower is because the labour force growth has slowed over the last 20 or 30 years in ageing societies, and that process is ongoing. So the only thing that governments can really do, economies can do to address that, is boost productivity. Now, that hasn't happened over the last decade, but I think going into this decade, Europe has some hopes that it might, and we are starting to see a European Commission that's mutualising some of its support to the economies, and that will help that process come through. So there is a little bit of hope that we shouldn't see this sort of ever-softening trend growth come through from Europe. And I think, in certain electoral scenarios, there's also that hope for the US as well. The Biden proposals, for example, are very progressive, and, might help boost longer-term trend growth in the US as well. But as we know, it's difficult to know at this stage exactly whether they'll be enacted and over what time frame. But I think there is some hope that we may not repeat this sort of continual downward trend in trend growth. But population growth slowdown is a key part of that, and that's going to be ongoing, particularly in Europe.
David, to build on what John was talking about from the Bob Prince interview that he did of Bridgewater last week, he noted, Bob Prince that is, that China didn't have to borrow the trillions and trillions of dollars that the U.S. and that Europe did just to plug an economic hole, because China dealt with the virus that much better. That will put China in a better position, less hampered by all that debt to move forward. Do you adhere to that idea that possibly people should look more to China because they handled this crisis so much better, that they are in a better shape to plow forward at a faster pace?
Yeah, I mean, to some extent, that's absolutely right. I mean, certainly China and much of the Far East has handled this in a much better way, and therefore the economic impact that they're going to swallow is much less, and therefore the sort of the debt that they rack up to try and account for it is going to be less. And we've just published a couple of papers actually on the government debt outlook. The debt outlook for US, for European governments, is going to be to pay this debt down, not over years, but over decades. It's going to take a long, long time to go through that process. And that doesn't mean that we shouldn't be providing fiscal stimulus now, but it does mean that there's going to be a fiscal consolidation program that has to kick in within 3 or 4 years' time, and that's going to be there for a long time, and that is going to act as a headwind. So that is going to be something that encumbers those economies for some period of time. But, we can still see productivity growth within that, and clever fiscal management can still sort of see an adjustment come through. But no, I mean, undoubtedly, being able to control the virus in a better manner when it's hit will leave economies in a stronger position, and China is undoubtedly one of those economies in that place.
David, just a final one from me, if I may. Thursday, an ECB news conference with President Lagarde, widely not expected to do anything this time around. Pressure clearly building. David, what are you looking for in that news conference, that meeting this week?
We're really just looking for the usual ECB sort of tipping the nod to the next meeting, the next rendezvous. So we are expecting to see an extension of QE, both in terms of quantum and time. We think that the ECB will certainly roll out this QE support throughout most of 2021. And that announcement comes, we think, in December alongside the medium-term forecasts. But, to be fair to the ECB, that there is a question, why not just do it now? It's relatively obvious the direction of travel. But I think at the moment, the ECB will go into this meeting. They're not going to know about whether or not they've been ratified in terms of European national budgets. They're not going to know what the UK-EU trade deal is going to be. And they're not going to know what the electoral situation is and therefore the economic background for the US economy. So there is an argument really just to hold and wait here and then react when there's more information in the bag. And that will be the case in December. But we very much expect to see an extension of QE to the tune of around 500 billion euros announced in December.
Just a cool 500 billion. David, thank you. David Page of AXA, thank you very much. Tom Keane, I've got no idea where we will be in that December meeting at the ECB. A month is a lifetime right now. How many times have we said that this year?
But we've shifted. You brought this up earlier, John, and on radio and television across this nation with this pandemic. There's a shift. Remember the certitude, John? It was like the first week of March. I was away the third week of March, and we were framed out. May 15th, we're in control. We're watching the news cycle. We're going out 6 weeks or 8 weeks. And then we were sort out this diffuse 3 months. Where are we now? And I would suggest, John, on the edge of nowhere in terms of how we're looking out.
Vaccine watch, Tom. End of November, start of December.
You said end of November.
That's what everyone's on.
Yeah, granted, there's a collegial debate about this, which keeps us employed. But come on, the vaccine is there, and then the distribution of the vaccine, knowing the first one won't be as efficacious as the third one.
Totally agree. And Lisa, weigh in, please. I think you agree as well. End of November, start of December is judging the efficacy of a vaccine. Have we got one? Yes, okay. Distribution, widening the access to that could be a Q1, Q2, Q3 story for all we know.
Yeah, and there's a lot of questions about how much the vaccine will protect people. I go back to what Tom Frieden said over the weekend, the former head of the CDC. He said the final stage of this coronavirus pandemic is acceptance. It's not going away for a long time, and trying to imagine life in a very different way going forward. Kind of sobering, John.
That's pretty miserable, actually, Lisa.
Anytime,
Thanks,
John. I'm here for you. You want to get brought down?
I know.
Right here.
I know. That's what she's Monday to Friday. She's here for the depression. Okay. Thank you, Lisa. Alongside Tom Keane and Jonathan Ferro. Coming up, Rebecca Green.
Is it Lester
William and Mary
or
Law
Lister?
School professor. It's Leicester, Tom.
Leicester.
Why are we doing that now?
Leicester City.
Why?
Leicester. Okay, I
Leicester
just don't know how to
City.
pronounce it.
Leicester. You got
Leicester.
that? All right.
Yeah, okay, Leicester.
Well, that's that done. Anything else?
No, I just
Before I go? Good.
Come back to it.
Go ahead, John.
All right. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi and the White House accuse each other of doing the same thing when it comes to a pandemic relief plan. And that is, quote, moving the goalposts when it comes to what's in the actual legislation. Pelosi says the House could pass a bill this week. Still, an agreement with the White House isn't certain, and the Republican-led Senate may not act before the election. Coronavirus cases are surging again in the two countries at the center of the initial wave of the pandemic in Europe. Italy is introducing its strongest restrictions since the end of the national lockdown in May, and meanwhile, Spain also will impose new measures, including a curfew. Joe Biden calls Republican questions about his son Hunter's business deals a smear campaign. The Democratic presidential candidate also told CBS News that the release of documents allegedly belonging to his son may have been part of a Russian disinformation campaign. Biden's claim has not yet been substantiated. More deliberate blackouts in Northern California. The state's largest utility, PG&E, cut power to 1.1 million people to prevent live wires from falling into dry bush and starting wildfires. Winds as high as 50 miles an hour swept through an area north of San Francisco. The blackouts may last until tomorrow. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated the dramatic impact of this outbreak.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
seeing advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
Democrats are the shutdown party. They will shut down your jobs, shut down your schools, your businesses, your police departments, your energy. They'll shut down your freedom, and they will shut down the greatest economic comeback in the history of our country.
You know, you'll be seen and you're heard and respected by me. Our campaign is a broad coalition. It welcomes Democrats, Republicans, and Independents. If elected president, there will be no red states or blue states, only the United States.
It is that time of every 4 years, a presidential election, and of course 8 days away. You know it's going to be interesting with surprises over the next 8 days. David Weston leading our coverage, really looking forward to his work, not only on balance of powers, but some special efforts through the week. And of course, Kevin Cirilli, tanned and rested down in Washington, will give us his perspective as well. Right now is a great joy. If you go to a fancy school like Harvard and you get a bunch of fancy degrees, if you are ever so lucky, you get to go to the founding school. That would be William and Mary and their law school of 1779. It was an historic moment for the nation when a number of people, including Mr. Jefferson, got together and said, we have to be different. And they did that at William and Mary. Rebecca Green is at Williams and Mary. She is the winner of their acclaimed teaching award given by graduate students, and that is a good and wonderful thing. Professor Green, thank you so much for joining us on election transparency. Can our radio listeners, our television listeners, can they be confident of safety at the voting booth on November 3rd?
Well, first of all, thank you for having me. And second of all, absolutely they can. Election officials and local governments have been working hard to ensure that we have a safe and secure election.
There have been so many elections going back to the founding of William and Mary, 1800, particularly 1824, and then on to 2020, that are this fractious. Is it normal to be this angry where there's so much tension about our voting process?
You know, I would not say it's normal. We certainly do have a long history of problems at the polls, but it is the case, I think, that we're in, a hyper-partisan mode, and, we certainly haven't seen anything like regular comments emanating from the White House that there's a problem with our election administration. So it certainly is a different tone than any previous election, at least in the modern era.
Rebecca, there's a question about November 3rd. It will be the last day of voting. And then there's a question about the weeks after that, as both sides of this campaign get their cavalry together to fight the legal foundations of this vote. What are some of the battles that you're expecting to see in the court based on both President Trump and former Vice President Biden's comments so far?
Yeah, well, so I think the first thing to say is that post-election litigation is normal. It's part of our system. It's how we resolve disputes, and this country has a long history of resolving post-election disputes in the courts. Post-election disputes are generally guided by state law, so it's different in every state how this will all unfold if it unfolds. There's kind of three different. Well, there's different kinds of there's different types of post-election litigation. So everyone's probably familiar with recounts. When elections are close, candidates can call for recounts, and again, that process is governed by state law. And then there are ways that candidates and campaigns can challenge either ballots, or they can allege official misconduct. It's called different things in different states, but it's generally a contest or a protest are the words that are most often used. And so those are the various vehicles by which you can challenge or litigate an election result. And so we can expect, if it's close, we can expect to see one or both unfold.
So there's a high likelihood that Amy Coney Barrett will get confirmed to the Supreme Court as soon as this evening, if she does passes through the Senate today. What's your expectation about a potential case that would come between the Supreme Court the way we saw back in 2000?
Well, I think it's pretty unlikely that we see a 2000-like, event. I mean, there would have to be a lot of circumstances that would coincide for that to come about. I mean, it's pretty extraordinary that the whole race came down to Florida and that the race in Florida was 537 votes, spread. So I think, the chances of lightning striking again seem pretty remote to me. I think what's more likely is a case could end up at the Supreme Court that, deals with the fundamental powers of state legislatures versus state courts. That's a kind of, we've already seen a premonition of that with a 4-4 split last week on that question. And that could reemerge as, there are some unsettled questions about, authority in elections in states.
Rebecca Green, Brian Rosenthal and Michael Rothfeld in the New York Times this morning have an absolutely brilliant article on the nepotism involved. In this case, it happens to be, I believe, the city of New York election process and all that. How are we going to vote 5 or 10 years from now? Do you have, in your expert view, a better way we're going to vote than the nepotism and the local politics of this nation's electoral process?
Yeah, it's pretty extraordinary when we have foreign visitors come and look at our election system. They're often amazed that we have this very decentralized and sort of partisan-based election administration in this country. And it is, many volumes have been written about how problematic it is for a lot of reasons. But on the other hand, if you look at 2016 and hopefully in 2020, one of the features of our system being so decentralized is that it's very hard to do anything to harm it from the outside, right? Because there's essentially 10,000 different elections in this country. And so that kind of provides some protection in terms of the kinds of potential harms that we see. So it's sort of a two-sided coin. In terms of reform and like what we might, what changes we might have, 10 years from now, you could imagine after this insane election season that Congress decides to take a little bit more of a heavy hand in terms of mandating some certain basics in terms of how we run our elections.
This has been a joy. Rebecca Green, thank you so much. Professor Green at the Law School of the College of William and Mary. Lisa, -37. I'm going to say futures deteriorate out 2 big figures on the VIX.
Yeah, interesting to see what Greg Peters was saying, that the 60-40 portfolio is not dead, and you can see it today because you've got risk-off in futures, but you also are seeing a bid into bonds, and this underscoring the conundrum that a lot of people have when arranging their investments. Tom.
Yeah, I'll say, and we heard that from Michael Swell of Goldman Sachs as well, with some enthusiasm there on the ownership of bonds, even at this yield. We must bring you up to date on the Turkish lira, out to new record weakness moments ago, 8.10 on the lira. That is a distressing statistic for Mr. Erdogan. Our Middle East team will have more coverage on that, including out of Istanbul, Owner Ant and our team on Turkey, France, and the Levant. Please stay with us with futures at -36. This is Bloomberg Radio and Bloomberg Television.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the Open starts right now with 30 minutes until the opening bell. Futures down 35, we're negative 1%. We begin with the big issue. Infections climbing, restrictions intensifying and stimulus talks reaching a stalemate. Europe clamping down amid record cases, with Spain announcing a nationwide curfew and Italy introducing its strongest measures since May. The US facing its own difficulties amid 2 days of record infections and stalling stimulus talks. With just 8 days until the election, Democrats and the administration spending the weekend accusing one another of moving the goalposts.
We don't even have the bill yet because Nancy Pelosi, and she's coming up, I know she can speak to this, but we've continued to make offer after offer after offer, and Nancy continues to move the goalpost.
We're waiting for the final.
Well, they
yes.
said they would, and you're waiting to see it on paper.
They haven't yet. And also, same thing, they keep moving the goalpost. We want it the sooner the better, and that's why we're making concessions.
All of this adding up to a risk-off Monday morning to kick off the trading week. Bloomberg's Kaylee Lyons joins us now for more. Hey, Kaylee.
Hey, John. Well, that's absolutely right. Not a lot of good news happening over the weekend. In fact, worsening news as it relates to the pandemic, and basically no real news or progress at all when it comes to stimulus. As a result, when futures trading opened last night, it was a sharp leg lower, and it's just getting worse as the morning goes on and we head toward the opening bell. John, right now, S&P 500 E-mini futures off by around 35 points for the Dow, and NASDAQ futures down over 300 and 100 points respectively. And if these losses hold, it doesn't bode well for the week to come, because in 13 of the last 14 weeks, the direction the market goes on Monday is the direction it went for the end of the week. Now, as we know, John, we have to look at the bond market as well. We know the 10-year yield has been really in a trading range for more than half a year, really range-bound since all the way back in March. It did look like it was staging a breakout last week, rose as high as 85 basis points, but it seems, at least for now, that breakout has failed. We come in around 3 basis points this morning as there is that bid for safety, though we do remain above 0.8%. And as it relates to the curve, John, as bets that a stimulus deal was going to happen were building, we did see that curve steepening, the spread between the 2s and the 10-year notes climbing as high as about 70 basis points at one point last week. But as those talks have stalled out, so has that steepener trade. The spread coming back in now around just 65 basis points. And of course, it's not just about stimulus, not just about the virus, but also about the election, John. It's a week from tomorrow, and the market is starting to factor that in as well, John.
That is the third time that 2's 10 spread has topped out at around 70 basis points. Katie, thank you. A couple of observations on this market about 27 minutes out from the opening bell. Yes, futures gap lower. Yes, there's a bid into the Treasury market. Katie ran through that beautifully. What I think is interesting about Europe at the moment is what is happening with Italian bonds. BTPs are not falling. They are rallying. That's good news for the continent at a really difficult time. The Italian bond market resilient. The euro, 118.11. We break down just a little bit. I think it's been really impressive how resilient the euro has been. Weaker today, but still north of 118, even with everything that's going on. Can that continue? Today, dollar strength through G10. We're down by 0.4%. And here in London, the FTSE hammered the energy majors, the mining companies. Commodities struggling. WTI 38 handle, $38 and around about 80 cents. That's the story of the price action. Here's a take from Stuart Kaiser of UBS weighing in on the market action. He says the following. The cross currents of strong earnings, delayed stimulus, rising restrictions, the US election, tech oversight and stagnating economic data have held risk markets captive for the past 2 weeks. Stuart joins us now for more. Stuart, of those things that you listed in that quote, when will we resolve half of them?
We'll resolve the big one next week, hopefully. And that obviously would be a big step. I think what happened, Jonathan, is a couple weeks ago, you just had a lot of good news priced in. The market had begun to expect a very strong 3Q earnings season. We had been pricing, very positive kind of stimulus outcomes. And since then, with all those good news things, fully priced, the market's now had to digest, the other side of the ledger, which is, delayed stimulus or things of that nature. So obviously earnings will be resolved. This is the biggest earnings week of the season. We'll get a lot of news on that front, and tech will be the focus this week. We'll have the election hopefully resolved next week, God willing. And if you get those two big things out of the way, maybe we get some vaccine news, by year end, and we'll have a whole lot more clarity on the path of the stimulus as those other dominoes fall.
That's the hope, I think, Stuart. And right now, the vaccine put seems to be the conversation amongst the equity bulls. At the moment, what we see playing out in Europe and potentially in the United States is this second wave building. And, Stuart, I think a question we've got to ask and think about, does a second wave necessarily lead to a second dip? Do you think it does?
This is a risk that we've been focused on probably for too long and to our own detriment, which is just that, as you get the second wave and as, the vaccine gets announced, but then the actual, wide distribution of it gets pushed out, it creates pressure on U.S. economic data and particularly on the employment side. So I think to the extent that you had a second wave and employment sentiment continues to struggle, that is something that could kind of push you a little bit lower. If you look back to over the summer, the blue wave was not necessarily considered the best outcome by a lot of equity investors. And over the last couple of months, it has become not only the best outcome, but almost a necessary outcome. And I think the thing that links that is the fact that we've seen U.S. economic data and the recovery start to slow, particularly on the labor side. So I think what could cause the viruses to drive another second leg lower would be we don't get enough stimulus and the U.S. Employment situation and outlook continues to deteriorate.
Do you think, Stuart, there's something that we need to think a lot more about is the potential for persistent fiscal failure? The happy talk around election scenarios seems to discount the possibility, or ignore it entirely, that we could have a situation after November 4th where we're staring down the barrel of political arguments well beyond the lame duck section and well beyond next year, where we just can't get it together and get another fiscal package together as well, Stuart.
Yeah, it's a huge risk in the sense that I think a lot of market participants, particularly on the equity side, not only are expecting but are demanding additional fiscal. And, the chance of the GOP Senate is probably a little bit underpriced, even though that is not the most likely outcome at this point, if you believe the various forecasting sites. But if that were to happen, then you're in a situation where you need fiscal and you have, a GOP Senate that could be a little bit resistant to that. Not that I think it'll go down this path, but if you think back to 2011, there was a lot of controversy over fiscal expansion and how to sort of control that going forward. And that led to a lot of political uncertainty in the U.S. and very negative, implication for equity markets. I don't think that's the case this time because I do think, the pandemic is a very broad-based existential issue that I think hopefully will allow people to, cross the political aisle. But if you were to come up with the negative scenario, it's that you get a very resistant GOP in terms of the size of the stimulus package at a time when, frankly, it's very needed, and I think also largely priced into markets. So if it's not rewarded, then markets are going to react, and they're going to, be the forcing mechanism in that case.
Stuart, one thing we have seen over the last couple of months that perhaps not many people are used to is persistently high implied volatility at a time where the equity market has continued to rally. Stuart, is that something you think can continue?
We do think it'll continue at least through the election. I mean, 10-day S&P realized volatility is at 11 right now, and the VIX is near a 30 handle. So to your point, there's just a very wide gap between those two things. In the U.S. in particular, those gaps are extremely wide because, most of the risks that we're discussing are almost centered in the U.S. right now. So I think investors have just driven that premium wider. Our view, and I think the view of a lot of investors, is that implied realized spread is going to be pretty sticky. It probably won't be as wide as it is today because where we are is just, a little bit off the charts. But I think, going post-election, what you'll probably see is the VIX come down a little bit, the term structure steepen a bit, and those spreads compress a bit. But I don't think that's going away. And if you think of even back to last year during the trade war negotiations, you had fairly wide implied realized spreads, and you had a curve that was steep in the front, and then you had this sort of, high and flat plateau in the 4 to 6 month space. And as a base case, I think that's probably what the vol term structure is going to look like, going into early next year, with the caveat that, anything could happen. But, I think our view is you will get a little bit of a steepening of the term structure. Implied realized will compress, but remain, wide by historical standards. And you're going to have some risk premium priced into that belly of the curve because, similar to the trade war, this is a major event catalyst. You don't know when it's going to resolve itself, and you don't know in what direction it's going to resolve itself. And, without knowing the timing, magnitude, and direction of a catalyst, the vol marks are going to be forced to just leave a heavier premium than they might normally price in.
Stuart, before I let you go, I've got to put you on the spot. 8 days away, conviction trade going into the election. Can you have a conviction trade going into this election?
I think it's very hard to have a conviction trade. If you look at what the market's priced, the market is putting a premium on November puts and a premium on December calls. So they're worried about near-term downside risk, and then they're worried about that kind of upside in December if we do get that outcome. What I would say is, ahead of previous elections, the VIX starts to price its biggest premium a week to 10 days ahead of the election. And a number of investors we've talked to have said, we're not going to trade this until basically Halloween. So it wouldn't surprise me if people that are looking to put on hedges or directional trades are kind of waiting to the last minute until they have a better idea of what the cost is in terms of implied volatility and where the S&P is from a strike perspective. So it's very, very hard to have conviction, but what the market is telling you is kind of near-term risks and then medium-term upside if they get the outcome that they're demanding.
Hey, Stuart, great to see you, sir. Thanks for joining us. Stuart Kaiser there of UBS. 20 minutes out from the opening bell, equities near session lows, down 34 on the S&P. We're negative 1%. With your movers at the market desk, here's Abigail.
John, fitting to the risk-off tone for global equities and certainly the U.S. futures, SAP, the shares of the enterprise software company, are having their worst day in Europe since 1999, set to have something similar here in the U.S. This after the software company cut their full-year revenue view. They expect fresh waves of lockdowns to hurt demand, and the pandemic will also delay the company's goals around the cloud. And most painful about the reduction is for the first half of the calendar year of 2021. So they really see the pain extending, and you can see that stock absolutely punished. As for other movers, Dunkin' is popping to the upside. This on the news that they are in talks to be acquired by Inspire Brands. That is a private equity-backed company which also owns Buffalo Wild Wings, and they bought that company for a 20% premium. So you can see Dunkin' trading at almost a 20% premium. And then to the downside, the defense contractors. This, of course, as China is imposing unspecified sanctions on these companies to punish the U.S. for the $1.8 billion arms sales in Taiwan. So mainly movers to the downside, John, keeping with the bearish tone.
Abigail, thank you. SAP, just absolutely ugly. I caught up with the CFO earlier this morning. His words, not mine. He wasn't unhappy. They were comfortable with the direction of travel. I did ask how investors would feel about that statement, given where the stock was set to open in Germany, and he seemed constructive. Hey, look, I guess he's got to be, but that stock is getting absolutely crushed in Germany. Coming up on this programme, Democratic nominee Joe Biden heading to Georgia with the polls tightening in key southern states. That conversation coming up next with SocGen's Sabajh Rajappa, and we'll touch base, of course, with Bloomberg's Kevin Cirilli. From London and New York this morning, good morning. Equities down, going into the cash open, futures lower by 0.9%. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Have to think about all the other offsets to tax. And so we're looking at it. I think we're going to be prepared. And, we're modeling out a whole bunch of different scenarios. I think we're going to be well positioned no matter what the outcome is.
You have a choice, New Hampshire, between a Trump boom or a Biden lockdown. The Biden lockdown would permanently destroy the lives and dreams of tens of millions of our citizens, wipe out what will be and what's turning out to be the greatest economic comeback of all time.
Our campaign is a broad coalition that welcomes Democrats, Republicans, and independents. If elected president, there will be no red states or blue states. Only the United States.
Presidential candidates ramping up the rhetoric with just 8 days remaining until the election. The former vice president and his running mate campaigning across key southern states this week. Joe Biden leading off in Georgia, where polls are tightening despite voting Republican since 1992. And look where Senator Harris is going. Heading to Texas, hoping to flip another traditionally red state in the Democrats' favor. Kevin Cirilli joins us right now, Bloomberg chief Washington correspondent. Kevin, it's Texas which made the headlines over the weekend with that poll from the Dallas Morning News, 46-44 Biden. The average of polls in Georgia showing a tie. Kevin, there's a risk here, isn't there, that the campaign moves beyond the battleground states, the traditional ones, and starts spending a little bit more time in places like Texas, Kevin. What's going on?
Well, two things. First and foremost, the Democrats seizing upon the national poll momentum and trying to expand the map. You mentioned Texas. The average poll of polls has Joe Biden leading 48% to 45%, according to one poll that came out there. Of course, that is a deeply conservative state. So and really could be a bellwether of sorts on election night and in terms of the scope of a potential blue wave should Joe Biden defeat President Trump in the battleground and what now I guess is a battleground state of Texas. But the second point that I would make here is that I was just up on Capitol Hill speaking with Senator Kevin Cramer. He's a Republican from North Dakota who defeated a Democratic incumbent in Heidi Heitkamp back in 2018. I asked him how he did it. He said energy policy. It's how Republicans are trying to close the ground that they've lost to the Democrats on a host of different issues and it's really the energy argument, Jonathan, that they are making in Michigan and Wisconsin and Pennsylvania, and yes, now including Texas. The bottom line, though, we're a week and 1 day out from the election day when upwards of 50 million people have already cast their ballots. So as Senator Kevin Cramer put it to me, does the energy argument work at a time in which many voters have already cast their ballot?
Is it working? Let's talk about, is it working? Never mind have they missed the boat already because so many people have already voted. We know for the last 2 weeks, 4 years ago, there was a huge momentum build behind the President of the United States, Donald Trump. This time around, we all get to see the same polls, Kevin. We don't see it. They seem to be confident their approach is working. What gives them that confidence right now, Kevin?
They have internal polls that suggest that Republicans are just as motivated, if not more motivated, to show up and vote on Election Day, and that they will turn out on Election Day, regardless of what's standing in their way, whether it be COVID-19 or any other issue. They also feel that issues pertaining to the Supreme Court will only further motivate many of their Republican base who quite maybe not are in the Trump base, but in the Republican base, who are motivated to show up as a result of judges. And of course, Judge Amy Coney Barrett widely expected to be confirmed to the Supreme Court sometime this evening, and that's still much moving along schedule, according to the Republicans. So that is what they feel is going to help them. But I can tell you that, as is typical, and I'll keep this very short, as is typical in the lead up to an election, both the sides of the staffers are feeling that anxiety of what do they do next? We're playing the outcomes game for a week from tomorrow.
Kevin's so busy, we didn't even talk about the office of Vice President Mike Pence, which has got its own difficulties right now. Kevin, great to catch up. Also so busy that we didn't actually have to talk about fiscal stimulus talks this morning with Kevin just yet anyway. I mean, the short guide to all of this seems to be the distance between Senate Republicans and House Democrats was already wide. And the distance between the administration and Speaker Pelosi on two key issues, liability protection, one, and state aid, two, just hasn't seemed to close whatsoever in the last 30 days. And maybe that's one of the reasons equity futures are down 31 this morning and off 0.9%. Here's a take from SocGen Subhadra Rajappa discussing how to position around the US election. She writes the following: the yield on the US 10-year is drifting higher, with increasing odds of a Biden win. With less than 2 weeks to the election, we are neutral on duration, but recommend positioning for high yields and steeper curves over the long run. Subhadra joins us now. Subhadra, your view on the election, do you think that holds the keys to whether we break out of this tight 10-year Treasury range we've been in for quite a while?
Possibly. I mean, I think if you get a Democratic sweep, there's a good chance that 10-year Treasury yields could sell off to perhaps 1%. But really, the struggle is going to be any sell-off beyond that 1% level, given the fact that you're having an increase in infections across the globe. Global inflation is quite low, so any sort of a sell-off risks sort of profit-taking from short positioning, as well as new investors coming in and taking advantage of higher yields to go long. So I think any sort of sell-off is going to be capped if there is a Democratic sweep after the elections.
That's the Treasury story. Let's pair the Bund story with that, not just the US politics, but what's happening in Europe at the moment. You think if there is a sell-off, Treasuries underperform Bunds. Now, Subhadra, people might look at the price of Bunds and say, look, negative 60 basis points, far more scope to sell off there in a German bond market. Why do you see things playing out a different way?
Well, because of the inflation outlook. If you look at Germany, not just Germany, but all of Europe, core inflation is very close to zero. So the key risk for the ECB going to this meeting is on inflation. Inflation expectations are very low. And what are they going to be able to do to prop up inflation? So in an environment where inflation is so low, I think it's going to be a struggle for bond yields to rise meaningfully. So I think we see more prospects, perhaps, for a rise in Treasury yields to be the catalyst towards modestly higher bond yields. But on the contrary, if you get sort of a resurgence of infections and bond yields remain low, then Treasury yields could rally and sort of come towards bonds. So this tug of war between the two continents is going to continue for the near term.
Do you think about that spread directionally or just in terms of a range, Subhadra? Right now, that spread between 10s, Germany, the United States, is about 140. What kind of numbers are you putting on that?
It's definitely directional, as in if there's a sell-off in Treasuries, you're going to see that spread widen. And then if there's a rally in global bond yields, you're going to see that spread narrow. So that directionality, I think, is going to broadly remain very much in play. The question is the Treasury yield going to be able to sort of break out of the current range? And given the fact that we're seeing a resurgence in infections in the U.S., I think it's going to be very hard to make the case that Treasuries there's going to be sustained sell-off in Treasuries when bond yields are this low.
Subhadra, always wonderful to catch up with you. Fantastic to catch up on a Monday morning in the bond market with Subhadra Rajappa of SocGen. Coming up on this programme, the analyst action you need to know. That'll be next in our morning calls. Then later, JP Morgan's Stephen Parker joins us for the opening bell to preview a big week for tech earnings. That coming up and more in this market. 7-8 minutes away from the opening bell. Equities down in Europe. Really hard. On the equity benchmark in Frankfurt, Germany, we're down by 2.65% and recovering a bit. Equity futures down 31 and down 0.9%. Monday morning, 8 days away from an election. The eyes of the world, in markets at least and elsewhere, on Washington, D.C., and just a little bit of risk aversion to kick off the trading week. This is Bloomberg.
Sure. Skip this ad, just like you skipped out on buying Amazon stock and Google and Apple. Lucky for you, there's eToro. So whenever opportunity knocks, you just log in, pick a stock, set an amount, and hit trade. eToro.
Five minutes out from the opening bell. Equities lower this Monday morning on the S&P 500. We are negative. We're down in Europe. We're off by 31 on the S&P. We're down 0.9%. That's the price action. Bit of risk aversion this Monday morning. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street. JP Morgan and the team adding Lululemon to its analyst focus list, a 415 price target. The analysts seeing upside to quarterly results with a preferable setup for the second half of 2020. That stock positive 0.7%. The team over at Raymond James upgrading Toll Brothers to an outperform a $55 price target. The analysts expecting strong demand for new homes to continue boosting the company's sales of luxury buildings. That stock is negative by 2.36% going into the cash open. And your third and final call, it comes from Credit Suisse downgrading First Solar to underperform ahead of Tuesday's earnings. The analysts seeing limited tailwinds with the stock approaching peak multiples following its 180% rally from March lows. That stock is down by 1.8% going into the cash open. There are three of the calls coming up next. We're looking ahead to big tech earnings this week with JP Morgan, Stephen Parker. That conversation still ahead from London and New York this morning. Good morning. Equities lower. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
So in 8 days, we wrap up voting in the United States. For America, in 9 days, you might find out who the president is going to be in America for the next 4 years. Maybe. It is the maybe that haunts this market. It's the maybe that shapes the volatility curve, as Stuart Kaiser of UBS pointed out, high and flat into year end. It's the maybe that is playing into a little bit of uncertainty with 1 week to go. Equity futures down 30. We're off by 0.9%. The story for Europe and the United States this morning. And good morning to you all. Restrictions across Europe, surging COVID cases again, and stimulus talks. What talk? Switch up the board in the bond market. Treasuries with a bid. Risk aversion. Building up a little bit of demand back into the Treasury curve. Yields coming down 3 basis points on the long end on 10s. We're back to 81 basis points. Crude lower. We head south. 38 handle just south of $39 at $38 and around about 95 cents. And in the FX market more broadly, stronger dollar story reflecting that diminished risk appetite. 118.20 on euro dollar, down 1/3%. A few days out, Thursday, ECB meeting, news conference with President Lagarde. It's got to be one of the biggest events on the schedule for this market. That's the price action. Your cross-asset movers at the market desk with your stock movers. Back with us, here's Abigail.
John, with today's bearish open, let's take a look at a number of names that are dragging on the major averages here in the U.S. Starting out with the shares of Hasbro. They don't have Barbie, and that's a problem. Mattel last week put up a great quarter, but not so much for Hasbro. They did beat revenue estimates, putting up $1.8 billion, but that's down 4% year over year, so it's just not enough. That stock down about 6%. JP Morgan is also lower. You were talking about that bid for bonds and this risk-off tone. That is weighing on the yield curve. Banks last week rallying, not so much today. Oracle down in sympathy with SAP taking down their guidance for the year. And in particular of concern is the fact that that includes the first half of calendar year 2021. The company saying that they see future lockdowns that will weigh on demand. Speaking of the virus, if we take a look at some travel and leisure movers, we are going to see more declines. This, of course, as we've had record numbers here in the U.S. back to back for 2 days, record numbers elsewhere as well. TSA airline check-in numbers are down, and Italy and Spain, as you were mentioning, John, restrictions tightening in Europe, getting close to lockdown level restrictions. So again, we have travel and leisure stocks down on this as folks are anticipating that there could be some more pain ahead around the virus.
Abigail, thank you. About 2 minutes into the session, let me run you through things sector-wise. Every single sector on the S&P 500 in negative territory. We're down 0.9% on the S&P. Bottom of the pile, the more cyclical parts of this market, energy, materials, industrials, financials getting hit. Abigail mentioned the financials. Curve flatter, the bull flattener back into this market. That means financials naturally get hit as well. That's the price action of the moment. My producer, Jamie, this is his favourite week of the quarter, the busiest week of earnings season, where he gets me to stop talking macro and gets me to talk about individual names. 5 days, 185 S&P 500 companies, and a sizable dose of the mega-cap tech names in the mix as well. Bloomberg's Sarah Ponzek joins us for more. Hey, Sarah.
Hey, John. It's not just Jamie's favorite week of the earnings season. Mine, too, and I think many others. It's certainly going to be a busy one. The third week of the earnings season and the busiest one. To this point, though, 85% of companies have beaten EPS estimates. Sure, it's relative, but even with that high beat rate, it's not acted as a boon to share prices. Since JP Morgan and the big banks kicked off the earnings season, the S&P 500 has fallen, and we do see shares lower yet again this morning. This is S&P 500 performance since that day that the banks really kicked off earnings, so down almost 3% or so. But not only are companies that are beating not being rewarded, companies that miss are being severely punished, according to Wells Fargo Securities. So Chris Harvey over at Wells Fargo Securities has tracked this data since the beginning of 2015. Well, this quarter, if you miss EPS estimates, you have seen your shares fall 4.4% on average in the day that followed. That is the worst performance ever. At the same time, just about double what the historical average has been. Now, companies that beat have fallen about 20 basis points, 0.2%. Meanwhile, in history, when we've seen companies beat, we've actually seen a gain of 0.7%. So companies are falling. JP Morgan says this is just because, as you mentioned, the election upcoming 8 days, that is really taking precedence over the earnings season. However, if this price action does remain, it will have very large implications for this week because it is going to be a doozy. As you mentioned, 185 companies, that's about $15 trillion worth of market cap, about half of the S&P 500's market cap. Tomorrow, we have Microsoft and Pfizer. Wednesday, Visa, MasterCard. Thursday is really going to be that big one. We have Starbucks and Twitter, and add to the list Facebook, Amazon, Apple, and Google. It's going to be a very busy afternoon after the bell on Thursday, John.
I'm looking forward to it too. I promise you, Sarah. Thank you. I mean, naturally, it's my job. I've got to look forward to these things. Sarah Ponsek, thank you very much. 5 minutes into the session, JP Morgan's Stephen Parkner seeing an unenthusiastic reaction to earnings, writing, quote, of the 14% of the S&P 500 companies that have reported earnings, a remarkable 85% beat consensus EPS expectations. While this seems like great news as the economy continues to recover, expectations are coming from a pretty low bar. Even with these beats, less than half have had positive price action. This playing into the story that Sarah described just moments ago. Stephen joins us now. Stephen, by definition, there is information in news. For market participants, there is more information in how markets react to that news. What's the information takeaway you take from this right now?
Well, I think what we're seeing, and particularly the reaction to the fact that while almost 85% of companies are beating, we're not seeing the positive reaction, tells me that the analyst estimates are probably still a little bit lagged. We haven't gotten to the right place yet, but markets have set a higher bar than what those consensus numbers might mean. Now, I think that's particularly relevant for the parts of the market that have done so well. So think technology, think other types of growth stocks, where in my mind, coming into this earnings season, the bar certainly is higher. And while we expect strong results this week, we think we're in a period of consolidation for the market. What I think will be more interesting is when you look at some of the sectors that have lagged, so think banks, industrial, some of the more cyclical parts of the market, where I do think the bar is still a bit lower. Are we going to see signs this quarter that some of that cyclical recovery may be beginning to take hold?
Well, Stephen, on the other side of this, it also raises a different question. What we're seeing play out in Europe right now in European equity markets is a story of more restrictions and higher COVID cases. The risk, I think, that people are discussing even more so, not the base case perhaps, but the risk certainly, and a downside risk at that, is that the cases pick up in the United States again, consumers disengage, and it weighs on growth. In that scenario, Stephen, given where things are priced, given where expectations are set, which part of this market's more vulnerable?
So I think first thing we have to keep in mind, Jonathan, is yes, we're seeing a tremendous pickup in cases, not just in the U.S., but in many places around the world. We're also keeping a close eye on mortality rates. Obviously, we're in a much better place to treat this pandemic now than we were earlier in the year. And I think watching the fact that those mortality rates remain low is probably something that will keep the consumer more engaged in the economy. Now, clearly, if we see a big pickup in both cases and mortality and concerns around a slowdown, even with the higher expectations, I think consumers are going to and investors are going to continue to look at the secular growth beneficiaries of what's going on. We've seen it with tech this year. That digital evolution continues to push forward. And even though valuations may be a bit elevated, we think that that's going to be the first place that investors look, particularly when you think about the $20+ trillion of assets sitting in money market funds and deposits today. The first place that will go back to work if we see a pickup again as it relates to the pandemic is likely to be technology and growth.
So, Stephen, that's the downside risk. Let's think about this. I think we're always looking for that inflection point, that internal rotation. A lesson, I think, for a lot of people that they struggle to really get their hands around. I talked to Hugh Hendry briefly about this, a former hedge fund manager last week. The ability to stick with what's working, the confidence just to stay with what's working. Stephen, why not just stay with what's working right now?
You know, let me tell you kind of what we're telling clients today. One, sure. when we think about the things that have worked, so technology, secular growth, those are a huge part of our clients' portfolios. That was the first place we were allocating back in March and April. I think when we've seen the tremendous performance dispersion this year, even for clients who did nothing, those winners are now a much bigger part of their portfolio, just given how much they've gone up. So what we're saying is be disciplined, think about locking in some gains, rebalancing. We still like these winners over the next 5 to 10 years. It's where secular growth is going to be in a low growth, low rate world. But as you're taking some of those gains, think about reallocating a little bit to some of the laggards, whether that's cyclical areas like industrials, dividend growth strategies. I think that investment discipline is key to the long-term success in building our portfolios.
Stephen, great to catch up. As always, it's like being a therapist for clients sometimes. Stephen Parker, of JP Morgan. Thank you, sir. About 9 minutes into this session, a little bit of relative outperformance on the Nasdaq. Stephen and I just talking about that. Down 0.4% on the Nasdaq. The S&P 500 off by 0.9%. SAP, German software company, that stock absolutely hammered, and I mean that, down about 20% at one point in German trading. The DAX really underperforming, off by 2.7%. More broadly, though, more restrictions in Europe. The outlook for the economy not doing great. The outlook for that company not great either. So that's the setup in the equity market. Weighing on the financials, Abigail touched on this. The bond market with a bid at the long end. 30-year yields coming down 4 basis points to about 160. On 10s, we have a rally there as well. Story of the bond market behind us, in front of us, Abigail Doolittle to get us some more movers. Abigail, bit of risk aversion this morning.
Certainly some risk aversion. A lot of it has to do with the virus. And on this, let's take a look at some virus-related movers specific to healthcare, because we do have the shares of AstraZeneca actually moving to the upside as their vaccine candidate has produced an immune response in older adults. So that's clearly seen as a positive. And Moderna is popping higher in sympathy as, the idea that perhaps their vaccine will be approved at some point soon. Pfizer, they are having investors a little bit nervous. They, of course, report tomorrow, but with just 5 days left, investors are, again, getting a little bit anxious about when the vaccine results that are due out this month will actually be out. And then finally, Procter & Gamble. It's sort of interesting, John. Those shares are down about 0.7%, despite the fact that their new Lysol competitor has received EPA approval. So 2 winners there relative to the virus and the fight against the virus, of course, as it is really reemerging, especially here in the U.S. with 2 back-to-back record days.
Abigail, thank you. 11 minutes into the session, keeping an eye on the Nasdaq right now. Just stocks starting to come back a bit, particularly on the Nasdaq. Only 11 minutes in, already raising a lot of the losses this morning on the Nasdaq. We are down by about 1/3 of 1% there. Coming up on this programme, pressure at the ECB meeting on Thursday amid rising infections and renewed restrictions. That conversation coming up shortly with Morgan Stanley's Brian Weinstein, and a recap to get you the highlights of what is happening on the continent all over again, unfortunately, in just a moment. This is Bloomberg.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
Jacinda Ardern's Labour Party holding 64 seats in the 120-seat parliament. Now, that is interesting because it's the first time since the introduction of proportional representation in 1996 that any party has won enough seats to govern on its own. Now, this is by turns rather luxurious and also slightly terrifying for the new Labour government because there are no checks and balances on power. There is no upper house. Jacinda Ardern can pretty much rule as she sees fit. So she did rule out, heading into this election, any capital gains tax, but as revenue collapses, it must be very tempting to give that policy another look. She's also contemplating going into coalition with the Greens Party, even though she doesn't actually need them to govern. Now, the Greens Party did take forward a more comprehensive package of tax reforms to this election. So were she to govern in concert with the Greens, they could do much of the heavy lifting on tax reform, which may also prove to be a little unpopular with some portions of the electorate. So it's going to be very interesting to watch this new turn. There's going to be a lot of new and untested MPs in the caucus. So a second Jacinda Ardern term is going to be full of all sorts of different challenges to the ones that characterized the first.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It is Monday morning. Good morning. 15 minutes into the session, we're down 1% on the S&P. Some relative outperformance on the Nasdaq. That defensive posture back again. Big tech outperforming on a relative basis. A bit into the bond market. A stronger dollar capturing that risk aversion this Monday. Off the back of no stimulus talks or a breakdown in stimulus talks. And this. Fresh outbreaks of the coronavirus spreading throughout Europe. The WHO urging government leaders to action.
The next few months are going to be very tough, and some countries are on a dangerous track. Too many countries are seeing an exponential increase in cases, and that's now leading to hospitals and ICU running close or above capacity, and we're still only in October. We urge leaders to take immediate action.
The region moving a step closer to the strict rules imposed during the initial wave, with Italy and Spain edging closer to a lockdown-level curbs. The Spanish health minister saying, "We will face very tough weeks. Let's not fool ourselves. This is how it will be. It's not a threat. It's reality." ECB President Christine Lagarde likely discussing the resurgence in Frankfurt on Thursday as clouds darken over the euro areas ahead of the central bank's rate decision. Bloomberg's Guy Johnson joins us now from London. Guy, great to catch up with you. This story in Europe is just not looking good right now, is it?
No. Governments will never talk about the fact that we're heading back towards national lockdowns, John, but by stealth, that is ultimately what is happening here. Spain over the weekend declaring a state of emergency. That feels very much like it did earlier on this year. You've got Italy closing bars and restaurants at 6 p.m. Local curfews are in place. The health minister here in the UK, Matt Hancock, over the weekend, refusing to rule out a further tier. At the moment, there's 1, 2, 3, with 3 being the highest in terms of the restrictions. He's refusing to rule out a 4. So we're certainly moving back in that direction, John, and the data certainly is also turning for the worse as well. You saw the IFO numbers out a little bit earlier on from Germany, particularly the forward-looking component there, very weak, and that will be a cause for concern. Angela Merkel talking about the virus being on the verge of being out of control in Germany. So all things are looking fairly difficult at the moment for Europe, as that chart in front of you really depicts quite clearly. And that poses some big problems for Christine Lagarde, John. The consensus at the moment is that she waits until December, until we get the staff projections, before there is any further addition to the easing that has already been delivered. But the expectation is growing, obviously, that we could see more in terms of the PEPP program, and that we could see further buying. On the one hand, and I sound like an economist here, John, you've actually got peripheral spreads behaving really well. Italy's trading 128 over Germany. You've got a similar story as well in Spain. And also the euro's behaving. But on the other hand, you've got this fresh wave, John.
I'm with you, Guy. I think the really good news is we're talking about a breakdown of the European recovery and not a breakup of the Eurozone, a problem that Christine Lagarde right now really doesn't need. Guy, great to catch up. Much more still to come with Guy Johnson and Alex Steele in around about 12 minutes' time right here on Bloomberg TV. Elsewhere, the story for Europe, well, that continues in this bond market. Try and get your hands around it. Morgan Stanley's Brian Weinstein joins us now for more. Brian, great to catch up with you, sir. Can we just touch on Europe just briefly, if we can? Your thoughts on what on earth is going on at the moment with the economy and how insulated do you think this market is?
You know, the economy in Europe, it just seems to just stay weak no matter what, and it's surprising that the ECB would wait, although it does seem like they will. You can see it in the performance of the equity markets, but if you look at fixed income, people have really pushed yields on corporate spreads in Europe in line with other markets, so that the fixed income markets don't share the alarm that the equity markets share about the direction of the European economy.
Is that something that persists in your mind, Brian, or something you want to reduce your allocation to?
I think it persists. I think it's a matter of time, right? Everyone knows there'll be more stimulus. And again, the bond market is so starved for yield and income. There are certainly pockets of places where I think you want to pull money back. But broadly speaking, our clients know that they need to find income, that these central banks will act, that governments will continue to act, maybe at a slower pace than they'd like. But we don't see a lot of people selling yieldy assets so long as they're in a place where there will be stimulus.
If you had to nudge them internationally, Brian, would you be steering them away from Europe and towards Asia?
We like Asia, and you can certainly get more yield there in pockets. So yes, I think broadly you can find now opportunities away. Europe was cheap for a while. It's not obvious that it's the market you need to look at right at this moment. That's probably fair.
Brian, I'm spending a lot of time talking to people trying to work out just how insulated this credit market is. If we don't get a fiscal package in the United States, if there's some kind of political outcome in America that leads people to capitulate on the idea that it's coming soon, how vulnerable is this credit space? And the reason I ask this is because do we really believe that monetary policy can keep financial conditions uber loose on its own?
No. We're at the point now where we're going to need, beyond monetary, we're going to need fiscal stimulus. So the market is certainly vulnerable. But let's not forget there are some cross currents away from the political news, right? You could get a vaccine announcement or some type of announcement that makes the forward outlook better. But you're right. We think the biggest problem right here is that if you do get a split between the presidential party and the Congress, and you end up with more gridlock, that the market is not set up for it. So pulling back a little bit on risk here makes some sense. Yields have moved 20 basis points higher, not a lot, but certainly you could take off some of the underweight and duration positions or overweights in credit. But remember, the market continues to be short things that have yield, and we wouldn't want to get underweight risk. We would just want to be buyers of dips and have a little bit less risk than we've had on.
Brian, great to catch up, sir. To get your thoughts on the programme. Come back soon. Ahead of that election, Brian Weinstein, 8 days away. 21 minutes into this session, equities down 1% on the S&P. Some real relative outperformance on the Nasdaq with the sector price action. Here's Abigail.
John, well, there certainly is a bearish tone this morning, carrying right through from last week. The S&P 500 falling last week for the first time in 4 weeks. So we see that selling pressure continuing on a combination of factors: the virus, the trade war reemerging, of course, uncertainty around the election. It is showing sector-wise. If we go into the Bloomberg terminal and use the IMAP, all 11 sectors are lower, so folks want out of stocks. But you're talking about that relative outperformance relative to the Nasdaq. That is all about consumer discretionary. Think Amazon, communication services, think Facebook and Google, and then tech, of course. That's one of the defensive areas this year. So those sectors are down the least. What we have down the most, though, the cyclical and the reopening trade. All of those sectors, real estate, materials, financials, industrials, energy, all down more than 1%. This is a microcosm of what we have happening on the year, John. If we take a look at the sectors on the year, the outperforming sectors this year are tech and consumer discretionary. The worst sectors, basically both in a bear market, the financials as yields fall, and then energy down more than 50% in sympathy with oil. So that's the tone on the year. It's the tone on the day, and it's certainly risk off. Although on the year, of course, you do have stocks a little bit higher.
Defensive to kick off the trading week. 8 days to go. How many times will you hear that today? 8 days to go. Abigail, thank you. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. In your market right now, 23 minutes into the session. Equities lower to kick off the trading week. 8 days to go. This is Bloomberg.
what would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated the dramatic impact of this outbreak.
Biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
"25 minutes into the session, here's the equity market, down 0.9% on the S&P, just down 0.2% on the Nasdaq. We're back to that story again. That's the equity market. Here's your trading diary. New home sales coming out at the top of the hour. President Trump speaking in Allentown, Pennsylvania at 11 a.m. Eastern, his first of 3 rallies today alone. Wednesday, the CEOs of Twitter, Facebook and Google testifying on Capitol Hill. All 3 of those companies, plus Amazon and Apple, reporting earnings on Thursday. Some brilliant coverage lined up right here on Bloomberg through the week as we count you down to that event. Plus, a BOJ and ECB rate decision coming up too, and US GDP, and another round of initial jobless claims. So quite a week at the back end of the week, and more campaigning to come. 8 days away. Let's get into price action. 26 minutes into the session. Equities just a little bit lower, down 0.9%. I say a little bit on the Nasdaq, down by 0.2%. The pain in Germany. SAP hammered. That does it for me. This was the countdown to the open. Catch me on Twitter at Ferro TV. This is Bloomberg.
Lexus Finance by 월 납입 플랜을 내가 원하는 대로 up and down. 중도 상환 수수료는 제로. 다시 가슴 뛰게 Run again. 렉서스 라이프의 시작. Lexus Finance by.
2 p.m. in London, where the clocks have already changed. 10 a.m. over in New York. We're now 30 minutes into the trading day over in the United States. From London, I'm Guy Johnson. My co-host in New York, Alex Steele. Welcome, everybody, to Bloomberg Markets. Alex, tough start to a Monday morning.
Yeah, and you got an extra hour of sleep, though, right? So it actually helps you?
In theory, yes.
In theory,
I haven't
I know.
met my children, though.
The kids, not so much. Okay, let's get to the markets here. It's definitely a risk-off day, led by Germany, had the weaker EFO data. You also had SAP, a disastrous day within the market. That's spreading a little bit here in the U.S. Boeing, though, really not helping the Dow. The Dow, the underperformer in the market. Where do you go? You go to Treasuries, and you go to the dollar outperforming in the G10 space. A little bit of a bid in the bond market. Yields down here in the U.S. by 3 basis points, but crude getting hit as we continue to see some targeted lockdowns over in Europe. And what are we, 8 days? Countdown to the election, Guy.
Yeah, there's quite a lot going on, isn't there? You got the election countdown, and investors are faced with the busiest week of earnings thus far. We've got almost $15 trillion worth of corporates reporting. We need to figure out exactly what the setup looks like. Let's do that with Scarlet Fu.
Okay, Guy, what's clear and what we've learned so far is that we're deep in an earnings recession right now, with more than a quarter of the S&P 500 having reported. Third quarter EPS down about 18% versus last year. Third quarter revenue down by less, but still off 4% versus last year. But we have definitely turned the corner here, because declines in both the top line and the bottom line are less bad than it was in the second quarter, and in fact may even turn positive by the second half of 2021, when the comparisons become a lot easier. Of course, the market had priced in all these third quarter declines, so what matters more now is really how the results stack up versus expectations. And so far, so good. Some 80% of S&P 500 companies are topping estimates overall. Sales are beating estimates by around 3%. That's the most in at least 2 years. EPS is surprising to the upside by around 18%, slipping from a 23% margin in the second quarter. Gina Martin-Adams of Bloomberg Intelligence says that growth companies are beating estimates more widely than value companies, but analysts are upgrading their fourth quarter forecast more for value than growth. And as a result, when value stocks beat their estimates, they outperform the S&P 500 by an average 1.4% the following day. Growth beats, however, don't generate any outperformance. And you can see how this has added up over the past 2 weeks. Now, Nick Colas over at Data Trek Research says, on the whole, Wall Street analysts remain reluctant to boost their fourth quarter or 2021 EPS estimates by a meaningful amount, even though we've seen this track record of beats in the third quarter. And yes, analysts tend to be behind the curve here, but Nick reads this as consistent with general market uncertainty about further fiscal stimulus. So as a result, it's hard to know how much of this third quarter strength is sustainable when you don't know if there's going to be more government aid coming. Alex?
All right, great breakdown. Bloomberg Scarlet Fu, thank you very much. Let's get the breakdown even further with Lee Drogan, Estimize founder and CEO. Lee, market's pricing in a pretty solid expectation of a rebound in this first half of 2021. Is it overdone? What's your takeaway so far?
Well, so here's an interesting aspect from, our specific data set and the specific systematic quantitative model that the hedge funds leverage from us, the post-earnings drift model. In the first 6 months of the year, that model didn't work at all. In fact, it saw negative alpha, negative residual returns. It had a pretty sizable drawdown. In the last 4 months, that model has made back all of that negative drawdown and some, and we're seeing it continue into this quarter. Now, what this means is that in that first 6 months, beats and misses just didn't matter to the market at all. In the last 4 months, it's mattering a lot, and we think that's because when a company, especially these growth names, and now it's starting to filter into the value names, when they surprise to the upside here, analysts are taking that as a cue of future performance and future fundamental strength, instead of in the first 6 months where they just wrote it off, threw it in the garbage, and said, this doesn't matter at all. Things are way too up in the air to extrapolate off of these numbers.
Lee, one of the things that's happened over the last few months is that companies have withdrawn guidance. To your point, is that what is creating this new environment? And as long as companies continue not to post guidance, will it continue?
Yes, that's part of it, right? Because, and again, this goes back to what Scarlett was talking about in terms of the reaction to the growth names. Growth names normally see more pre-earnings announcement drift in the direction of the revisions going into the report. whereas the value names don't as much, especially these growth names. The guidance is just completely gone now. And so that pre-earnings drift has largely disappeared and been replaced by the post-earnings drift, where there's a surprise to the upside or the downside. We just saw it today in SAP, right? And just, you get all of the, you get all the reaction kind of in that post-earnings period.
That's really interesting. So where does that leave like the small caps and value then, Lee?
I mean, look, you guys know that I'm a little bit of a broken record here over the last couple of years in terms of that trade, and we just don't see anything in the Estimized data set in those out quarters. Again, Nick Kolas from DataTrack, a good friend of mine, pointed it out that, for the growth names, we continue to see really good upward revisions, 2, 3, 4 quarters out here, which leads us to believe that this trade fundamentally isn't really going to change. There are some spots in the value trade, in terms of industrials that got really, really beaten down and are now, the benefit of this big housing boom, consumers basically just buying anything and everything for their homes. But honestly, some of that is really already played out. You just saw what happened with Whirlpool. There's going to be some other names this quarter. You might want to throw some of these consumer discretionary names in the value bucket, technically, like Williams-Sonoma. But, they've surged a lot already as well. So that part of the value trade may be over. And I'm still personally, when I look at the data, I'd rather own these enterprise tech names. I'd rather own the social media names relative to the classic value trade.
Big week for those kind of names. Lee, thank you very much indeed, as ever. Lee Drogan, founder and CEO of Estimize. Thank you very much. Coming up, 8 days until the US elections. We're going to speak to someone who has spent nearly 4 decades on Wall Street on what the outcome could mean for investors. Peter Krause, Aperture Investors Chairman and CEO, is going to be joining us shortly. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
9 minutes past the hour. Welcome back. Live from London, I'm Guy Johnson. Alex Steele's over in New York. This is Bloomberg Markets. Alex, we're in the final countdown. Great song. The US President, Donald Trump, and Democratic presidential nominee Joe Biden are making their final pitches to swing state voters with just over 1 week until the election is over. For a picture of the current state of the race, let's bring in John Zogby, founder and senior partner of John Zogby Strategies. John, what's your current call? Which way do you see both the presidential election going and critically some of those key Senate races?
You know, the presidential election is competitive, particularly in the battleground states. But as of this moment, advantage Vice President Joe Biden. And that seems to be a growing advantage nationally. Battleground states, though, are really very close. I caution people, however, 4 years ago to this minute, it was advantage Hillary Clinton, and so there's still 8 days to go. The Senate does look like it'll change hands. Democrats need, and it's competitive, but Democrats need a net of 3 or 4 seats, depending on whether Joe Biden wins or not. They could pick up as many as 7 or 8.
Wow. So, John, does that give us like a blue wave, or would that give us like a light blue wave?
That would give us a blue wave. If where we stand right now, we are seeing pre-election a huge blue wave of a massive turnout, 60 million or so. Just by the looks of it and the voter registration of it, it's a huge blue wave. But remember, we are expecting a huge red wave of voters on Election Day. Give you an idea, my latest poll has Joe Biden leading among pre-election voters by 16 points. We're seeing that. But the poll also shows that Donald Trump leads on Election Day, by Election Day voters alone, by 18 points. So, you know, we're still watching this.
You referenced 2016. The models, I'm assuming, have been fixed. Are you worried about the models?
I'm not, personally. Some of them, and they're not daily tracking, so we lost track of them about a week ago. I did detect that some of the major polls had samples that were too highly representative of Democrats and not enough Republicans. That's kind of a problem I've had with this industry right along. And for the record, personally, I am a Democrat. But I've always been bothered by samples that show models that show a 10, 11, 12-point differential between the number of Democrats polled and the number of Republicans polled. One of the best out there that's doing daily tracking is the Investors Business Daily polled TIP. They get their elections right, and they've got, I think, a more equitable distribution by party identification.
Hey, John, are shy Trump voters a real thing this year?
I don't know. It's really very hard to tell. We've never had a problem with that before. Shy Obama voters, for example, didn't materialize. When you see 96% as of today, 96% of Republicans saying they're voting for Donald Trump, 93% of Democrats saying they're voting for Joe Biden, who's left?
Final quick question. It's virus at the moment. That certainly seems to be the narrative.
Yeah.
John, is there anything the president can do about that in the closing stages?
I don't believe so. Too late, to trust the vaccine. There will be more than half that don't trust it. I think what the president can do is watch and wait and see if Biden stumbles. So in other words, I think at this point it's only something external for Donald Trump, not something that he can produce proactively.
All right, John Zogby, founder and senior partner of John Zogby Strategies. Thanks a lot. As we head towards Election Day T-8, let's talk about what this all means for investors now. In a recent note, J.P. Morgan says U.S. stocks could hit 3,900 by the end of the year if Donald Trump gets elected because, quote, a blue sweep scenario is expected to be mostly neutral in the short term. It would be accompanied by some immediate positive catalysts like large fiscal stimulus and infrastructure, but also negative catalysts like rising corporate taxes. For more, let's bring in a Wall Street veteran, Peter Krause, Aperture Investors Chairman and CEO plus Bloomberg's Sonali Basak is with us as well. Peter, thanks for joining us. How does Wall Street look at this?
Yeah, I think actually you summarized it pretty well. I think the market right now probably is discounting a Biden win. In other words, I think that's in the numbers. I think the market is probably not saying it's a blue sweep because the point you noted is that if it was a blue sweep and if the Senate does go Democratic, taxes will go up on corporations, and that will probably have a less than positive effect on the level of the market. As to where the market ends up at the end of the year, I don't really know that that's driven by the election. I think that that's a confluence of economic growth and recovery, where the virus is, where the vaccine is. I think those things will drive where the market goes. But as it relates to the election, I think it'd be a big surprise if Trump wins. I actually don't know what the market would do. I think it will be probably a somewhat negative reaction if there's a blue sweep.
So let's talk about the blue sweep scenario for a second here. In the event of one, how would investors be repositioning?
Well, I do think that what I think will happen is that investors will think about what companies will pay more in tax over time, and they'll discount that. But they're also going to do the math on infrastructure spend and a CapEx cycle. And it will probably take 18 months or longer for that to be in place. But you're going to see some of the industrials and stronger cyclicals react well to that, and particularly those that are domestic, because the spending is going to be domestic. So I do think investors will start to look at that more carefully.
So what about taxation here? You started to mention it, but do you think we're going to see more forced selling in anticipation of that as well?
Well, I think that companies that have unusually low tax rates and companies that benefited significantly from going from 34 to 21 are probably going to have investors saying, well, 21's not really sustainable. 28's probably more likely. And how do I feel about discounting earnings with a 28% tax return or a tax effect? And I think that will probably either have a slowing effect on how earnings are grow or potentially a negative effect on prices. But that's a one-time change. And after that takes place, then the market will start discounting future growth.
Peter, good morning. We're talking a lot about taxes here, and there seems to be an assumption that they would come relatively quickly. Do you really think a Biden administration would introduce tax hikes that quickly, given the backdrop of the virus?
I don't think it's possible for anybody to introduce tax hikes that quickly. It's a whole process. It's unlikely that anything happens in 2021, but by 2022, I do think there will be tax policy that will be debated and put in place.
So based on that, Peter, what I'm interested in is there was a great chart in the Journal over the weekend that looked at specific industries and them giving more to Republicans versus Democrats. And interestingly enough, a lot of the industries actually gave more to Democrats than Republicans. Does that tell us something different than might have been the case like 4 or 8 years ago, and change then how you think about future policy?
I'd have a hard time speculating on policy changes based on people's political contributions, but I think it does certainly highlight the fact that the market generally thinks that the Democrats are going to be in power, and so you're seeing the political contribution shift to that group.
We were talking about wealth taxes here as well, on top of any corporate taxes. How do you think the investor class is likely to take in some of those taxes, especially on the state and local level, when we're seeing so many investors just move with their feet and move to Florida, for example?
Yeah, look, wealth tax, I don't think a wealth tax is going to happen in the United States, at least at the federal level. And I don't think any states will put in wealth taxes either. I do think the question will be what happens to the state and local tax deduction. And with a Democratic group in charge, it's possible that some, maybe all, of that state tax deduction will be reinstated with a higher tax rate. Now, Biden's plan does not assume that. But on the other hand, you can't just bleed the cities of the country from their revenue source. And you have some large cities in the country that have high tax rates because they have a lot of social services and they have a lot of people, and over the years have provided for those people. And you just can't assume that those cities are going to fall apart from a revenue point of view. And it may actually be cheaper for the government and the country to actually have to reinstate those state and local deductions and to keep some of the revenue in the cities. That's a debate that's going to happen. I don't think any of us knows what the answer is going to be, but I would expect to hear that debate.
Well, speaking of the cities and the trouble they're facing right now, I mean, you're seeing so many of your peers just move jobs outside of these cities. Are you worried about the future of the workforce, especially the big Wall Street workforces in London and New York?
Well, I think London and New York are slightly different. London has a Brexit question. New York, I think, is probably just dealing with how do they locate jobs in the least expensive space that still can attract high quality and top talent. I think New York, I've lived in New York for a long time. Many other people have as well. New York is a very unusual city in that it is capable of evolving and changing. And this change may be a change in which the financial industry is not the leading revenue producer for the city in the future. It may be the tech industry. It may be the Googles and Amazons of the world. Amazon obviously didn't move to New York, but you know it's not done growing and changing. And so I think New York is going to change its character, but it's impossible for me to conceive that New York is going to decline from here. You know, New York still is a growing metropolis in terms of population, and I think that's going to be true for the large cities in the country. There still is an attractiveness to being in a city. People want to be together. At the end of the day, there's excitement and economic growth out of that, and we will solve the coronavirus, and we will have a vaccine, and you know we will return to some degree of normality.
Peter, over the last 3 months, the US 30-year has gone 135, 160, 165. Is the market ready for higher rates?
Yeah, great question. I think the biggest risk in the market is assets or long rates, if you will. And so what that means is that they're very exposed to rising rates in the long end of the curve, the 10-year and the 30-year, but principally the 10-year. So the question is, are those rates going to go up and when? And the answer is, of course, they're going to go up because they can't stay at this level forever. But the speed at which they're going to go up, I think, is probably not as fast as some people who are concerned about inflation are thinking. You know, you have to remember that all of Europe's interest rate construct is negative. And if the German Bund stays at -60, it's very hard for the U.S. 10-year to breach 100 basis points or 120 basis points. And I think going from 80 basis points to 100, 120 basis points, while that's a 50% move, 40 basis points, I don't think that's the end of the world and doesn't signal a huge amount of inflation. I do think that we will have inflation. I think we will have a CapEx cycle at some point, and I think that that will cause structural changes in labor costs and other inputs that will cause some level of inflation, not 8 to 10% or 7% inflation in the 70s, but you know 3 to 4% inflation, or at least north of 2, and that will drive interest rates up. But that's not around the corner, and we'd have to see a wholesale change in the interest rates around the world for that to happen. And you'd also have to see significant growth in Europe and change in inflation in Europe, and that's not on the horizon right now.
Nope. Doesn't appear to be anywhere right now. Peter, we really appreciate your time. Thanks very much indeed. Peter Krause, Aperture Investors Chairman and CEO. And of course, our thanks to Bloomberg's Sonali Basak. This is Bloomberg.
Lexus Financed by 월 납입 플랜을 내가 원하는 대로 up and down. 중도 상환 수수료는 제로. 다시 가슴 뛰게 Run again. 렉서스 라이프의 시작. Lexus Financed by.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders.
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I think what we want to do is take a consumer-first approach. We really want the consumer to guide us on how they want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
And one tech company that we're watching today is Ant Financial. So the Ant Group is set to raise about $34.5 billion through initial public offering in Shanghai and Hong Kong. A blockbuster deal. Huge numbers involved. Want to show you Alibaba, which of course owns about a third of Ant. They're going to subscribe for about 730 million of those Shanghai shares. We're all looking how it's going to price, how it's going to trade. And interestingly enough, you're going to have mom and pop investors are going to be able to buy the stock with it, which is with as much as 20 times leverage. That's just how confident the Ant IPO is expected to go among the financial community over in Asia. So fascinating there. We'll break that down later on in the show. Coming up, it's the Barbie boom. Why Mattel's surge in toy sales will last through the holidays. We'll talk to the CEO next. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York, I'm Alex here with Guy Johnson in London. This is Bloomberg Markets. So U.S. third quarter earnings parade marches on. Scarlett Fu's back with a roundup of how toy makers are faring. And you have boys. Guy has boys. I have a girl. Barbie Central, man.
Yes, and we'll get to that shortly, Alex. It's a tale of two toy makers here because Hasbro, the biggest U.S. toy company, is down as much as 9.1% this morning after reporting sales that fell short of its smaller rival, Mattel. And Mattel off a little bit today after a big gain on Friday. And the culprit here is that Hasbro has much more of a reliance on toys that have movie tie-ins than, say, Mattel. And, of course, we haven't seen a lot of major movie releases during the pandemic. So while Hasbro did sound optimistic about the upcoming holiday season, it wasn't able to offer any details. By contrast, Mattel specifically forecast higher fourth quarter sales. So let's go back and look at what happened at Mattel. Aside from preschool toys like Fisher-Price, for instance, all categories had sizable gains. And you can really see how vehicles like Hot Wheels rose 9%. Dolls led the way, up 22%. We're looking there at Hasbro. Let's go back to Mattel for a moment here. And overall revenue at Mattel rose 10% for the biggest gain since 2011. In particular, let's get to the Barbie franchise, Alex, because you mentioned it. It was a big winner for the company with a 29% surge in the third quarter. That's compared with a 7% gain in the second quarter. And what it does is close the books on the Barbie line's best third quarter in more than 20 years. Now, a note of caution here, because Jeffries did say that Mattel may have seen some holiday demand pulled forward into October at the expense of what we'll get in December. Still, analysts highlighted Mattel's margins in particular. They topped 50% in the quarter thanks to inventory control and lots of cost cutting. And in fact, inventories now are lower at retail outlets than they were at the same time last year. Looking ahead, it's not that Mattel won't look to do any movie tie-ins. In fact, they're going to be developing on that. It's an area that the company is looking to expand. It's got 10 movies in development, but as with everything in the COVID period, there's no specific release date yet. Guy?
Scarlett, thank you very much indeed. Perfect setup. Let's talk more about Mattel's business. We welcome Ynon Kreiz, Mattel's chairman and CEO. Thanks for your time today. Look, I'm going to start off with a big picture question that I think every investor and every parent wants to know. Are you going to be able to keep up this holiday season?
Well, thanks for the question. Let me first start by saying that this was a very strong quarter for Mattel. We saw a major upswing in revenues and a significant increase in profitability. We're very encouraged by the quality of the results, in that we grew in every region in constant currency and broadly across our portfolio. So our brands and product offerings resonate with consumers, and our partnership with retailers in driving demand is working very well. We gained share in the third quarter in double-digit growth in demand, according to NPD, and we see that momentum continuing into October. So our strategy is working, and we're very excited by the consumer demand and continuing momentum we have heading into the holiday season.
So I guess same question. Are you going to be able to provide all the products? Where's the weakness in the supply chain?
Well, our supply chain remains fully operational as we chase what we see as extraordinary growth in consumer demand for our product. We believe we're well positioned to manage through the disruption, but at the same time, we're mindful of any COVID-related volatility and do what we can to meet consumer demand in partnership with our retailers in driving our operation as best as we can.
You know, why no guidance? How much visibility do you have?
Well, at this point in time, based on consumer demand, the momentum in demand for our product and the low retail inventories heading into the holiday season, together with the early start of the shopping season, we expect sales to grow in the fourth quarter, and we gave guidance of mid-single-digit growth for the fourth quarter. We actually also gave guidance for the full year in profitability, and we do expect profitability to grow significantly year on year, driven by all the operational improvements and momentum we're seeing at the company.
So when you look at then products for the future, how do you monetize what you have, create new products while not be tied to a movie franchise to avoid the area like Hasbro did?
Well, this is where the strength of our product offering and the brands that we own comes into play. You're seeing growth in Barbie, 30% growth in the quarter. As you said, this was the highest growth we've seen for Barbie in more than 20 years. This is really all driven by great product innovation, strong product offering overall, effective demand creation, and what we see as very strong cultural relevance. Our toys have a purpose. Part of our mission is to create innovative product and experiences that inspire, entertain, and develop children through play. So it's all about quality, safety, and value. And we're able to create products that do exactly that, and we see the results in the numbers. Our product resonates very well with consumers, and our partnership with retailers in driving demand is working very well.
As we heard just a moment ago, some analysts are concerned that you are getting pulled forward demand at the moment, that it's not sustainable, that once we get back to normal, we are going to see behaviour changing once again. We're all playing Uno right now, but for how much longer will we be? And do you think kids will return to previous behaviour, which didn't work out quite as well for you?
Well, we don't believe there's any pull forward in the third quarter versus the fourth quarter. And in fact, based on our own internal shopper research, we see that the vast majority of parents plan to spend the same or more on holiday toy purchases through the fourth quarter. When it comes to more of a long-term perspective, the toy industry was projected to grow before the pandemic. Clearly, there are some benefit during the pandemic in kids staying at home, but overall, the toy industry is a growth category. And it's been, and always has been, and expected to continue to be, a strategic category for retailers. It's all driven by, today what we see, it's driven by quality product, trusted brands, and the ability of parents to offer product for children that will entertain and inspire them and add value.
So, but what happens if we don't get another round of stimulus in the U.S.? How secure is that view? Different when people were still employed, maybe they weren't hit by furloughs, or there was a stimulus money to make that up?
Well, we're seeing the toy industry as a whole growing and showing resilience in challenging economic times. Parents always prioritize spend on their children and look for high-quality product at affordable price points. The decision to buy a toy is not difficult. The items are not expensive, and kids are important for all of us. Every parent, every family will always prioritize spend on their children, which is why the industry as a whole grew in the third quarter in the midst of a pandemic. We outpaced the industry because we believe we've done a really good job in driving demand and leverage the strength of our product and offering overall. But the industry has grown, and we expect that to continue to stay resilient even in challenging economic times.
Ynon, you've got 10 movies in development. When are we going to see them, and what is the calculation that you're making?
Well, we are very excited about the progress we're making on our mid to long-term strategy to capture the full value of our IP. As you said, 10 movie projects already in motion. There's more coming. We're also making a lot of progress on our television offering. We are in production or development of multiple projects right now with great distribution partners. We just recently announced 104 episodes that we greenlit and 2 specials for Thomas the Tank Engine. And we're doing a lot of activity in finding ways to leverage the quality of our library outside of the toy aisles. In today's world, everybody's looking for big brands, quality product that will rise above the noise level. In a world of unlimited supply and unlimited shelf space, it is all about quality brands, quality trusted brands that have a built-in fan base and very high awareness. This is exactly what we bring to the table. So when you think of brands like Barbie, Hot Wheels, American Girl, Masters of the Universe, you're talking about some of the most iconic brands in our history. So this is all what we're bringing to the market, and are very excited by the momentum we're seeing and with the quality of the partnerships we are making with some of the biggest filmmakers and content creators in the world.
So you sound very confident about your business and the future business and its resiliency. Can you then give assurances that there'll be no cost cutting in terms of staff and in terms of the salary reductions? Can you be that confident about that part of your business?
Well, we're not giving assurances here, but what we did do, and we can say that out loud, is that we did achieve a lot of savings. We are on track to exceed $1 billion of cost savings that we drove over the last 2 years. We still expect additional savings to come through our capital light model. This is where we optimize our manufacturing footprint. And overall, we're seeing very strong improvement in gross margin, which, as you said earlier, was at 51%. This was the 9th consecutive quarter of improving year-over-year gross margin. And, you know, that I don't think there's a better way to show the momentum we are driving in improving our profitability, which is really key to our strategy.
Right. Well, we're going to leave it there. Thank you very much, Anand. Thanks for joining us. Anand Creeds, Mattel Chairman and CEO. Thank you very much. All right, coming up, we're going to chart China's economic future. The country's top officials now holding their all-important plenum. We're going to discuss the key industries to watch with Linda Zhang, Purview Investments CEO. That's coming up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Seeing advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
Let's check in on the Bloomberg First Word News now. I'm Ritika Gupta. Ant Group is now on course for the biggest IPO ever. The fintech company, founded by billionaire Jack Ma, has set the prices for the dual share listings in Shanghai and Hong Kong. And together they would raise about $34.5 billion. Now that would surpass Saudi Aramco's record 29 billion share sale last year. China will impose unspecified sanctions on American defense contractors Lockheed Martin, Boeing, and Raytheon. That's after the U.S. approved a $1.8 billion arms deal to Taiwan last week. China's foreign ministry says the sanctions are needed to, quote, uphold national interests. And in China, President Xi Jinping opened a meeting to map out the country's next 5-year plan. It could push the economy past the US within a decade. China's latest roadmap will center around technological innovation, economic self-reliance, and a cleaner environment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks, Ritika. So for more on the plenum, we're joined now by Linda Zhang, Purview Investments CEO. Now, Purview is an investment firm offering actively managed ETF solutions that specialize in global investing and ESG. Linda was also head of quant strategy at State Street Research earlier in her career and now has decades of experience in asset management plus investing in China. Linda, thank you so much for joining us. When we talk about China being self-reliant, the conversations that they want to beef up all their industries like tech, like chips, so they don't have to rely on imports while still remaining a global exporter. Does that happen? Can you see that happening?
Yeah, I see that coming since the trade war started when this has been by this administration in the U.S. And I think there's an increasing reality that technology systems are decoupling. But, I really don't believe that there will be a complete decoupling of the trades and also technology sectors. I think there will be certain vital industries where China may have to resort to self-reliance. I think that's not their intention, but they have to do that, such as the high-end chip segment that you mentioned.
In terms of...
Go ahead. Mm-hmm.
Sorry, Linda, carry on. No.
No, I was just going to say that in a lot of other sectors, you're actually going to see opening up, in particular financial service sectors and environmental and projects.
In terms of what this all means for investors, it was interesting, Jack Ma speaking at the Bund conference over the weekend, talking about the fact that a few years ago, 3 years ago, listing Ant outside of New York simply wouldn't have been possible. This is a company that's going to be 4 times the size of Goldman Sachs. The headlines, obviously, very impressive. I'm assuming that the fact that this is happening around the same time as the plenum is no accident. What signal is China and its leadership trying to send to investors?
Yeah, I'm not so sure if the decision for dual listing, unsteered listing in Hong Kong and Shanghai are, necessarily has anything to do with the government signaling. I think many Chinese companies, in particular tech-savvy, tech-focused companies, have been not very welcomed in this market. So as a result, they are going back to the local markets. And, I think it's more of a necessity. Also, there's a willingness to get closer to the home markets where they generate most of the revenues, as well as there's a huge investment appetite for this type of listings.
So, Linda, how do you put money to work then? You were putting money into the healthcare sector before it really opened up. So what kind of technology or financial services or something that's going to be really important to have in your portfolio?
Yeah, I think globally, there's several sectors that are very important. Obviously technology sectors, whether it's in the U.S. or in China. And now, since we're speaking on China specifically, I think technology upgrade is going to be one of the key elements in next 5-year plan that's coming up. Tech is still good play. Healthcare, R&D research, preventative cares, and the whole hospital infrastructure that China desperately needs. I think that should be a good long-term play for next 5 years. And also renewable energies. We're going to see a long-term investment thesis in the rise of renewable, not just in the U.S., in Europe, but China is a big elephant in the room. They are already the leader in energy transition to low-carbon economy, whether it's in renewable energy usage in power generations, as well as electrification of transportation, both public transits in terms of high-speed rails, buses, as well as EVs.
Linda, what do you think a win for Joe Biden in the election would mean for China assets?
Yeah, I've been following this very closely. I think Biden is less likely to have, very, the in-your-face kind of toughness on China. But I think the long-term competitive mindset, in particular on the U.S. administration side, whoever wins the White House will likely to continue. However, I think under Biden, he is very pro-environment, and he understands clearly this is a global issue. So I think he is going to seek out to China in terms of technology, productions, and policy coordinations on the global transition to low-carbon economies.
Linda, quickly, what has not been priced in yet? Where's going to provide the most opportunity? The opportunities, as I think one of the areas is really fintech financials. And, Ant IPO is a perfect example of that. So Ant is not just, the deal is just not big by size. Ant is a reflection, is example of it's a financial ecosystem for everyday's life. Because when you look at Ant, it's not just payment, right? It's insurance, it's wealth management, right? And it's loan. So it's, I recently talked to my family in China, my nephew and his wife, they don't go to traditional banks anymore, right? They make mobile payments. They recently bought 1 year life insurance. With like less than $200. So there's an incredible financial innovation, helped by fintech companies. And, Ant IPO is just one example. Tencent, Baidu, they're all doing that.
Linda, we're going to leave it there. Thank you so much for joining us here on the show today. Linda Zhang, Purview Investments CEO. This is Bloomberg.
Live from New York, I'm Alex Steele with Guy Johnson in London. This is Bloomberg Markets. Time now for Futures in Focus. You got a big short position piling up in treasuries and the expectation of Democratic sweep in U.S. elections. Joining us now, Sarah Ponzik, Bloomberg Cross Asset Reporter. But that's not all there is in terms of positioning. But let's start with the futures market.
Right. So it's not all there is. But as we discussed last week, we have seen this record short position being built out across Treasury bond futures, according to CFTC data, particularly for leveraged funds. This with the predominant narrative that come November 3rd, just 8 days away, we'll see this blue sweep, we'll see more fiscal policy, we'll see inflation, we'll see growth, and thus we will see a backup in yields. So if you look at total open interest for Treasury bond futures, second highest on record, highest since February. At the same time, if you look at the options market, we have seen hedging against a move higher in yields. So investors, traders positioning for this. But one thing that is interesting that our colleagues at Bolingbroke and Liz Capel-McCormick with Bloomberg pointed out is that all of a sudden, late last week, we started to see options bets surface that bet the opposite, that bet against this, that actually get paid out if this rise in yields that we were at least seeing at the end of last week with the 10-year testing its 200-day moving average, that will stall out before 1%. We won't hit 1%. We are seeing yields come back down once again today, the 10-year closer to 80 basis points. And really the thinking here is that, sure, we may see a blue sweep, but the outcome is still far from certain, and it's not the only story. We are still dealing with COVID-19. Clearly, we've seen that resurface over the weekend. We're seeing it reflected in markets today. So the move higher in yields, not all that certain.
Sarah, later this week, we're going to get a GDP print. It's going to be epic. How much of that's priced in?
It is going to be epic, quite the comeback, Guy, that we are expected to see. But this really is already priced in. The expectation is that we know this is what happened in the past. We know that in the third quarter, coming back from what we saw, total lockdowns at the beginning of the year, we are going to see epic, tremendous growth coming back. But the question is really about what comes next. I think especially hearing from SAP overnight, that puts a question mark over that in future lockdowns.
Yeah, we're going to talk about SAP a little bit later on. Sarah, thank you very much indeed. In the next hour, we're going to talk to Jeff Yu. We'll get his take on what's happening in these markets. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
You have to think about all the other offsets to tax. And so we're looking at it. I think we're going to be prepared. And, we're modeling out a whole bunch of different scenarios. I think we're going to be well positioned no matter what the outcome is.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It is 11 a.m. in New York, 3 p.m. in London. I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, here in the U.S., markets turning sharply lower here, despite the fact that Pelosi and Mnuchin still going to meet today at 2.
Yeah, does anybody really believe that we're going to get a deal done this side of the election? That certainly is not consensus right now. In terms of the story here in Europe, Alex, as you can see, markets definitely on offer. The S&P underperforming the Stock 600. But within Europe, there's a huge dispersion in terms of the performance that we're seeing. The DAX is down by 3.3%. SAP, the prime reason behind that. In fact, the technology sector is the big underperformer here in Europe. SAP getting smashed lower, the biggest move to the downside we've seen for Europe's biggest technology stock since 1999. But the FTSE is only down by 0.8%. In terms of elsewhere, we're seeing bonds on offer, certainly for the Bunds. We are moving, as you can see, higher by 8 basis points. But over in Italy, we're actually seeing the exact opposite. In fact, quarter periphery spreads tightening up again. And look at that, the Turkish lira moving through 8, Alex, a 1.61 move against the percentage move against the Turkish currency. And we are seeing a war of words emerging between Erdogan and Macron, the French and Turkish leaders. Alex.
And we'll break that down later in the show as well. Let's stay focused on the European story of the virus surge. A top European health official saying that many countries went too far in easing restrictions.
In the EU, that countries have followed after the loosening or easing of measures in May, June, have followed the expansion of testing and contact tracing. However, apparently, some of the easing of the measures was a bit too enthusiastic. So we're dealing now with an increase.
Joining us now with more from Brussels is Bloomberg's Maria Tadeo. Maria, it's so hard to understand what regions are subject to what lockdowns and what that means. And I was really hoping you'd help clarify that for us.
Yes, Alex, there's a lot of different measures, but what I would say is that right now, and especially after this weekend, it's very fair to say that a lot of Europe and the biggest economies, including Germany, France, Spain, Germany not so much, but potentially headed there, have gone into something that we could even call a partial lockdown, where you have a curfew, when you're really not allowed to go out on the streets at night, where you're not really allowed to go to a restaurant or anything that involves a social gathering, because hospitality has completely shut down, and anything that implies you going to a gym after work or having some type of social life has also ended. So it really is a situation that looks very similar to what we had in March, except that there is no full lockdown. But again, there's a real question now as to whether that could be coming in the next few weeks. And that is what I would say it's really the highlight, that we are seeing countries that just a few weeks ago, like the French, said we're not going to halt the country, we're not going to stop, we're not going to do what we do in March, now saying we hope we're not in a situation where we have to do that. But the numbers really speak for themselves. The number of infections have really risen. That pressure on hospitals also increasing, and that is problematic. And there has been a real change in tone from governments in which they say the restrictions are going to be here for long, potentially until Christmas, and then we'll have to decide. But no one should be under any impression that we're going to relax or go to anything that looked like what we had in the summer. The situation is now very serious.
People are pushing back, though, Maria. Social cohesion is beginning to break down. Walk us through what we're seeing.
Yes, Guy, and I think really that is an excellent point, and it's almost the elephant in the room now, because we saw it play out in Italy, where there was real big protests happening on Friday in Naples. We've seen that in France, in Marseille. We saw that in Madrid too. And really what's changing here is that governments for weeks had said that this was under control, that we were very prepared, that the second wave was not going to be similar to that of the first wave, and that we were going to manage to just deal with the situation and avoid a lockdown. Clearly, that tune has changed. And citizens, you could argue, are angry. They feel this is not being well managed. It's now having a real impact on their lives. It's having a real impact on their personal finances. And there's this big question as to what's going to happen with Christmas, which you could argue is just a holiday, but for many people it's very sentimental. So there's this whole pushback as to why did we not get things in order during the summer, and why are we being told everything was going to be fine? Clearly, it's not.
Maria, on that note, we will leave it. Bloomberg's Maria Tadeo joining us from Brussels. Let's get some more insight into what is happening here right now. The virus concerns front and center. Joining us, Jeffrey Yu, Senior Strategist for EMEA Markets at Bank of New York Mellon. Maria laid it out. Jeff, what is your thoughts when it comes to European assets, given that backdrop?
Well, I totally agree with her. It's really a challenging environment. And with the ECB this week, they're going to be under pressure to say, OK, what are your assumptions up ahead? Because clearly assumptions, for a V-shaped recovery, extrapolating from the data through the summer and early autumn, that's just plain wrong, right? So, if governments can actually back that up with stimulus right now, with furlough programs, then perhaps it can just smooth the blow to household income. But overall, I think the Eurozone economy and the UK economy, they're heading for challenging times up ahead, and finally we are actually seeing that being priced into markets.
Is it going to be priced in with the ECB on Thursday?
I think it's still going to be a bit too early for the ECB to act on Thursday. They don't want to be seen as, again, they're doing tactical policy making and having a knee-jerk reaction. But I think they will absolutely lay out their expectations and basically the thresholds, basically what are the bars for them to go ahead with them easing. I think it'll be easier for them to actually do something in December, when the new staff projections come out and say, look, next year's inflation forecast, have to revise them lower, then that can justify easing quite easily.
Is December too far away, though? Yes, I appreciate that core to peripheral spreads are coming in and the euro's being relatively well behaved. But the economic backdrop is deteriorating relatively quickly here, Jeff. And the rescue plan on the fiscal front, well, that's not decided yet.
True. And one, I would say, positive aspect right now, and we saw it in the iPhone numbers today, and it's been clear across, all the PMIs in Europe, is actually manufacturing's holding up quite well, right? So you're seeing prints well above 50, but services are coming off. So how do you actually reconcile the two? How do you reconcile the fact that manufacturing companies, they're facing, good order books, they are enjoying the tailwinds, from a recovering China, especially Germany can certainly benefit, from that. So how do you reconcile that, which would argue lack of a need for easing versus what the retail side is doing right now, where also central banks could say actually it's more of the government's role to again stem the blow from what could happen. So it's a balancing act.
So work with me as I try and draw some lines here. So is the U.S. in some ways 6 weeks behind Europe in terms of virus outbreaks, but then Europe 6 weeks behind the U.S. and where they are with fiscal and monetary policy?
So I don't think people in the markets really know where the US is, right now in terms of a fiscal policy. But having said that, there is much more of a willingness, I must say this, there's a much more willingness to price in strong fiscal in the US, because no matter what happens with the election, there will be fiscal coming through, whereas in Europe, the usual wrangling about how the money is spent seems to be coming through again. So credibility on fiscal is actually stronger in the US, I'll give you that. But on the other hand, pandemic management, it seems like everyone's heading in the same direction. So it's time the S&P, starts to take into account growth risks coming in from that and whether the Fed will need to respond.
How do you think risk assets are going to respond if we do, as the polls suggest, currently get a Biden win?
So what kind of a win I think is going to be important is going to be straight. It won't be contested. There won't be any volatility around that. I think that first phase is important. Secondly, though, let's look at the policy. So again, if it's going to be stimulus, then from a medium-term horizon, I think how the Treasury curve is behaving, how inflation expectations in the US are behaving. I think markets will acknowledge there will be growth. Now, growth is going to be different compared to, say, a tax cut deregulation-driven program, but spending-driven programs similar to what happened in 2009. You have investment, you have growth, earnings, that would be positive as well. So I think markets are gradually factoring that in.
I've been reading a lot more about real yields and how the market's sort of overlooking the importance of the deeply negative real yields here in the U.S. Do you think that run the risk of going even more negative if you get a Biden win, but you get the Fed kind of capping in some respects the long end, but inflation expectations increase?
So we'll have to look at policies, but I think long-end inflation expectations will need to increase. Again, it's pro-growth policy. If there's going to be infrastructure, those sectors, they will benefit. But crucially, if monetary policy is going to work, if we believe the Fed's current policy is credible, then you need to see a steepening in the yield curve. I'll borrow a phrase from Kuroda. Kuroda has said from the BOJ, he's happy to see the yield curve beyond 10-year steepen, because that's a sign that policy is working. That's what QE should be doing. And I think the Fed heading in that direction should send a strong enough a signal. But ultimately, if it's pro-growth policies, no matter who's in charge, with the Fed anchoring the front end, inflation expectations in the US, they'll be sure to rise. And I think the market is giving them much more credibility compared to the Eurozone on that front.
OK, let's just pick this apart a little bit. If we do see the US 10-year moving north of, say, 1.2%, A, that's a really big move. But B, you don't think the Fed will sit on that?
So the Fed hasn't, committed, to a 10-year target or anything like that. So of course they'll watch the pace of the move. Again, it has to be for the right reasons. If you start to say that the market is worried about the US's fiscal position and pricing in some kind of term premium, then I think the Fed may actually have a different reaction compared to a market reaction to a strong spending program or a strong growth program, where you can actually have a growth-driven steepening in the yield curve. So we have to distinguish, why the yield curve is moving. Again, if it's a combination of an easy Fed forward guidance and anchoring the front end, plus a strong spending drive where market prices in a credible, being the keyword, credible growth strategy, I think the Fed will actually allow it within good reason in terms of speed, will allow that to happen.
OK, let's pretend that happens. What happens to the dollar, and which other currency pair needs to re-rate the most on that?
Right, so the dollar then, if market actually starts to see the dollar as a growth currency again, then I think the dollar on a broad basis against some of the more stretched EM names, the dollar can do well. I think euro dollar, so trade in a range for the time being, but once European fiscal comes through and in a credible fashion, then euro dollar can actually reach high as well, because euro is more favorable from a valuations basis, right? Dollar higher, while the Fed is, let's say, gradually moving away from its current policy. That's where some of the more, I would say, vulnerable EM names, Turkish lira being the forefront right now, that's where markets will start to ask more questions. Where you don't want to buy the dollar against perhaps right now is, say, North Asian currencies, where Asia already is growing and there's a credible growth prospect there. Let's see what the Chinese 5-year plan puts out. There's no conflict between the dollar and, say, the likes of renminbi, Korean won, both advancing at the same time.
Definitely counterintuitive on that dollar and steeper yield curve. Jeffrey, we love having you. BNY Mellon will be sticking with us. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
What would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated
the dramatic impact of this outbreak.
Let's check in on the Bloomberg First Word News now. I'm Rishika Gupta. White House Chief of Staff Mark Meadows is defending comments he made to CNN Sunday that the Trump administration is, quote, not going to control the pandemic. Asked why, Meadows said it's because it is a contagious virus just like the flu. Speaking to reporters today, Meadows tried to clarify his remarks.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can. If you look at full context of what I was talking about is we need to make sure that we have therapeutics and vaccines. We need to make sure that when people get sick, that they have the kind of therapies that the President of the United States has.
Meadows says President Trump won't give up until all Americans are safe and the virus is defeated. Russia's President Vladimir Putin is trying to preserve the collapsing framework of nuclear arms control. Putin has offered new missile verification measures to NATO countries. This comes after the U.S. withdrew from a Cold War-era treaty. Each side rejects the other's allegations of breaching the agreement. And Turkey is deepening its rift with France. President Recep Erdogan is urging his nation to boycott French goods over what he says is the country's hostile stance towards Muslims. The tension between Turkey and the EU has been escalating over a number of issues, from the Libyan civil war to Turkey's energy exploration in the eastern Mediterranean, with French President Emmanuel Macron criticizing Erdogan for his assertion of regional power. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Alex?
All right, thanks so much, Ritika. Let's stay with Turkey for a second. The lira continues to decline against the U.S. dollar. You got skepticism over the central bank's efforts to shore up the currency. Jeffrey Yu, senior strategist for EMEA markets at Bank of New York Mellon, still with us. Dollar lira. Record high yet again. I mean, what's the top here? How do we look at this move?
Well, it really is, again, a matter of leaving aside the geopolitical issues for a second. Turkey is unique in terms of its foreign exposure, right? So you've got to look at the foreign claims on Turkey. So the estimates, if you look at BIS numbers, the foreign claims on bank claims, $120 billion, that kind of level. So there is a big deleveraging risk if capital is going to move out. And in this environment where it's globally, it's a risk-off environment, then that is going to be a risk. And it's really telling, why Turkey is unique right now, because it's very rare where you get broad EM sell-off, in an environment where the Fed is holding rates at zero and, where maybe more easing is priced in. So we can't look at, so people are asking about contagion right now. I think that's a bit of a step too far for the time being, but watch this space, right? So I don't think it's going to cause, wider EM ruptures, but from Turkey itself, right now, they really need to manage their FX risk.
Okay, so how does this happen? Are we setting ourselves up for a huge hike in interest rates, and will the president tolerate that?
I think that's what the market is looking for, or the market is saying we need to see a huge or a sizable hike in interest rates. But on the other side, the political side, is that going to be acceptable? So that's where people will question, this internal, let's say, clash between what's going on the political side versus what is needed from central bank point of view. But my view is, again, use this opportunity, and the same is for Argentina. For any emerging market looking at its FX exposure, use this opportunity for when the Fed is relatively loose on the front end and will anchor rates at zero to try and get balance of payments in order, because there won't be a better opportunity to do so. They must grasp it.
What other idiosyncratic risks out there are there in the FX market? That, yeah, okay, you get the higher dollar overall, you still have the feature from the election, et cetera, but still.
Global inflation. So global inflation expectations really coming back much earlier than expected. And let's go back to our earlier conversation. If it's healthy, growth-driven inflation expectations gradually moving higher, then that's fine. But if it's suddenly a supply shock, and there are many sources for that, we've seen supply shocks and due to production disruptions around COVID, and also deglobalization is going to happen, right? So no matter who wins the US election, China has already said, look, we're going our own way. Dual circulation, internal circulation first. China wants to drive things internally sterling and a stronger renminbi also means, for the time being, more expensive exports from China globally. So we may have, these inflation shocks come much earlier than expected without the growth to back it up, and that's where FX vol, inflation-related fixed income volatility, all that's going to rise. And then if real incomes start to get hit because of that, we could have some problems as well. So I think that certainly is not being priced in.
Jeff, do I want to be long in, short out of a Brexit deal when it comes to sterling?
So right now, I think sterling's reaction today, tells you Brexit, no one really cares anymore. It's going to some place. But now the UK growth trajectory is going to be a problem. Still think the BOE's got it wrong. They're going to have to move towards more QE. And when they're ready for negative rates, and perhaps move on that as well, with unemployment surely set to soar. So watch that space. I think sterling's one of my favorite funders right now, especially if you want to own an Asian currency. We want to have Asian exposure. I think sterling is going to be a good one to have on the other side of it.
So then what downside does that imply then?
So right now, if I look at cable per se, maybe it's not the best way to play it because of US election-related volatility. Euro sterling higher, can we revisit well above 90, even if there is a Brexit deal? If Europe, has fiscal on the table, Europe can grow high as well. I'm looking at crosses like Korean won, sterling won, sterling renminbi. They could all go a lot lower. So sterling, as a reflation metric, global Britain wants to do trade with globally. You're going to have to see sterling move more, perhaps against global currencies. So now's a good opportunity to do so. But we'll have to be driven by a change in the BOE stance.
When we look at what is happening around the world, is there a concern that we will see the strong growth, and you've mentioned Asia continuously throughout this conversation as being on the front foot and the rest of the world being on the back foot? At what point does Asian growth become limited by the rest of the world?
That's a good point. So, right now, when you look at, some of the tailwinds, the likes of Korea and Taiwan and even Singapore, it's actually almost a China proxy trade, right? So it's almost wholly dependent on, China continue to invest domestically and to maybe capture 5% growth in next year. So as long as, China can hold, let's say, between 3 to 5% growth, that kind of a level, major trading partners in Asia, so Australia and South Korea, they'll be okay. Japan, will be okay, but they will also, have to, mark down their trend growth a bit because of the US and Europe, again, key trading partners. If they're just going to stutter along, for another 12 to 18 months, right, then that's going to mark off a good third of their potential GDP growth. So it's not ideal, but again, as long as China can hold the line right now, it's acceptable for Asia. If we get China wrong, if China gets its own policies wrong and goes back to say 2 or 3 or thereabouts, then it's going to be a global growth problem.
Absolutely. Jeff, always appreciate your time. Jeffrey Yu of BNY Mellon, thank you very much indeed. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Ant Group is now on course for the biggest IPO ever. The fintech company, founded by billionaire Jack Ma, has set the prices for the dual share listings in Shanghai and Hong Kong. Together, they would raise about $34.5 billion. That would surpass Saudi Aramco's record $29 billion share sale last year. The parent of coffee and donuts chain Dunkin' is in talks to be acquired by private equity-backed Inspire Brands. According to the New York Times, the deal is valued at $8.8 billion and could be announced today. Shares of Dunkin' Brands have more than doubled since March. Inspire Brands owns Buffalo Wild Wings and Jimmy John's. And Sergio Ermotti is wrapping up 9 years as CEO of UBS. Ermotti led the Swiss lender from volatile investment banking to being a world leader in wealth management. He spoke to Bloomberg about the economic situation in Europe and the US.
It's difficult to see how Europe can gain grounds from where it is today without, a significant shake-up of its, system, and the U.S. is still not to be underestimated because it's always been able to come out somehow stronger from any changes in administrations or politics.
He'll say goodbye to UBS this weekend, and you can watch the full interview. Then, in our special broadcast, a conversation with Sergio Ermotti. And that is your Bloomberg Business Flash. Guy, Alex?
Thank you very much indeed, Ritika. Alex, let's talk a bit about what is happening at UBS. What they're doing is they're going to reduce variable pay and increase fixed pay. Now, on the face of it, you would have thought that that might make them a little less competitive, but actually it's exactly the opposite. They're trying to increase some people that are underpaid at the moment. Poaching's a big deal. It's also potentially going to help with regulators as well. And investors, well, they'll probably welcome the clarity as well when it comes to the cost story.
Well, yeah, we heard something a little different from Jamie Dimon and JP Morgan, who was saying, look, we're doing really well. Our revenue's great, trading's great, but you might not get your bonuses that you're accustomed to when you're delivering these kind of revenue numbers for trading, in part because you want to save money in case there's a crisis, et cetera, but also you don't want it to look bad from regulators when the banks are trying to be let to increase their buybacks and their dividends and all that. So an interesting take. I wonder how many follow suit.
Yeah, in some ways, fixed pay at other banks may actually already be higher, which is in some ways what UBS is reacting to here. We're going to switch to tech after the break. SAP shares plunging. We're down more than 20%. We'll talk about why in a moment. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart
when we should.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
Our outlook that we had adjusted in April assumed that over the course of the second half year, we would see a gradual improvement in the demand environment due to lockdowns easing. Unfortunately, the opposite is starting to happen.
SAP's CFO speaking to Bloomberg a little earlier on today. The German software company cutting its revenue forecast for the full year. It now also expects a fresh wave of lockdowns to hurt demand through the first half of 2021. The news sending shares tumbling the most since 1999. Joining us now, Anurag Rana, Bloomberg Intelligence Senior Software and IT Services Analyst. Anurag, the stock is down 22% right now. Why was today's news such a surprise to the market?
I think the big surprise was if you go back and look at in August, Salesforce and Workday said that, the clients have started to spend back again. And I think that's where the market got some comfort that software spending is not going to be hurt as one would expect because of the economic slowdown. And I think the weakness in September because of resurgence of COVID, I don't think anybody was expecting that.
So is that a product issue or is that a pipeline issue? How do you think about it?
I think it's a combination of both a macro issue as well as some issues with SAP's own portfolio. Macro issue is you are seeing a slowdown in new software installations. The large ones that's the one that SAP sells, large ERP implementations. Second thing is their Concur portfolio, which is travel and expense, related issues. If people are not traveling, they're not using SAP software to either book travel or later on using expense software to expense that particular transaction. So those are the things that are more, specific to SAP, coupled with all the macro weakness that we just talked about.
Is there a read across to the rest of the sector, or is this specific to SAP?
No, this is more broad-based. We think it is going to impact all software companies. Now, within that, we think it's going to impact on-premise companies a little bit more than cloud-based companies. Companies like Oracle and VMware. We think Microsoft is less susceptible, given they have a huge cloud portfolio, as well as they have a good work from home trade as well that relates to their Teams product or consumer PCs, as well as gaming.
What do we also learn, Anurag, about what is priced into a stock going into earnings, and if you don't match it and you disappoint? And what does that tell us about its peers? And you mentioned Microsoft holding up well, but nevertheless, they're still, going to report tomorrow after the bell, and what kind of risk there is.
So the issue, in the software world that we have been talking about for a while is not so much the, just the growth rate or the revenue growth rate. I mean, that could be down 100 to 200 basis points, but that's not much compared to the current environment. I think the biggest issue in software is the valuations that are currently trading significantly higher than their 3 to 5 year means and averages. I mean, if you look at some of these names that are trading at 20, 30, 40 times sales in the software world, I think that's where the biggest worry, in my view, is going into 2021.
How long will the markets give management to fix this, do you think? I appreciate what you say about the wider market, but just specifically on SAP, new management team in, new leadership, does the market give them extra time to get their arms around the problem and get on and fix it?
I think the stock down 22% is the reset that the base we're going to go from. Now, remember, SAP is a very sticky product. They have, very good, steady free cash flow. The question is about growth now, and they have, their CFO is one of the most respected CFO in the industry, and I think have laid out a plan. The question is going to be that most likely the big pickup in sales is not going to come till 2022, and I think that's where you could see some pessimism from investors because, you're not going to see decent growth rate for 1 year now.
Can we break it down regionally and what areas of SAP are doing well and which are struggling the most and why?
Well, surprisingly, U.S. is the one where they're seeing a little bit more of the pullback. And as I said, that's where a lot of the clients are now allocating their spending into software that helps them become more productive very quickly rather than infrastructure upgrades.
Anurag, is this an argument against the kind of growth that we've seen at SAP? When I say growth, I actually mean the kind of M&A we've seen at SAP. Basically, they brought a whole load of companies in. None of the systems really got integrated, so nothing really kind of talked to each other in the way that it was meant to. You've got to figure that out. You've got to bring all these different products together because your clients are using them together, make them interoperable. That's got to be really expensive. Is there an argument against that here?
That's probably the best question I've heard on SAP in a long while, frankly. And this has been our biggest issue with SAP for several years, is a bulk of the growth that they have gotten in cloud has been from acquisitions. But frankly, I'm going to give a lot of credit to the new CEO that came back and said, no more large acquisitions. We're going to focus on our core. We're going to focus on our core and growing that core. And I have respected that. In fact, we put out a lot of research beginning of the year that we expect cloud growth to slow down quite a bit because of this focus and the move away from large acquisitions. Now, this is where investors would have to be patient and trust both the CEO and the CFO that they are focusing on what they're good at and staying away from acquisitions for the sake of revenue growth.
Well, Anurag, I can't top the best question you've heard on SAP. I mean, come on, that's not fair. So I guess my end of conversation question is, does this provide an opportunity for another company to come in and get more market share from an area of SAP that may be struggling or just needing to grow?
Alex, my apologies. That was, our best question for all times. But we think it's going to open doors for somebody like a Salesforce, somebody like a Workday, and frankly, even somebody like Oracle to come out and get some of the market share from SAP. But frankly, SAP is a very sticky product. It's going to take a lot of work by the rest of the three companies that I mentioned to take some market share away from them. It's not going to be easy, but SAP has their work cut out for them at this point, and they really need to work hard to regain their market share.
All right, so not the best question he's heard, but whatever. Anurag Rana, really appreciate it. Bloomberg Intelligence Senior Software and IT Services Analyst. All right, coming up, you got China's top policymakers meeting to hammer out the country's future economic blueprint. We're going to break down what all that means with Ginny Yan, ICBC Standard Chief China Economist, coming up next. This is Bloomberg.
is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. China will impose unspecified sanctions on American defense contractors Lockheed Martin, Boeing, and Raytheon. That's after the U.S. approved a $1.8 billion arms deal to Taiwan last week. China's foreign ministry says the sanctions are needed to, quote, uphold national interests. In China, President Xi Jinping opened a meeting to map out the country's next 5-year plan. It could push the economy past the U.S. within a decade. China's latest roadmap will center around technological innovation, economic self-reliance, and a cleaner government. And Ant Group is now on course for the biggest IPO ever. The fintech company, founded by billionaire Jack Ma, has set the prices for the dual share listings in Shanghai and Hong Kong. Together, they would raise about $34.5 billion, and that would surpass Saudi Aramco's record $29 billion share sale last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thank you so much, Ritika. This raises a bunch of things for me, Guy, but one of them is just the idea of the monstrosity of this IPO. And what do you do if you're a U.S. bank? You want to have that business, right? You want to have part of that listing. You want to be a part of it. But then how do you navigate that when we're slowly moving into a bifurcated world of sort of the West and China? And that doesn't seem to then be changing under President Biden if we get that.
No, I think it's going to be really difficult. Yet, on the other hand, you have an economy that is growing and growing rapidly. Others are not. We're going to hear about the 5-year plan over the course of this week. We'll probably get the details later on this week. So a real challenge, I think. What I think is fascinating, though, is what do you do actually if you're a Chinese bank here? Because in some ways, what we're signaling is this move away from traditional banking in China towards the kind of banking that Ant is very strong at. It's not just a payments company. It does a whole range of stuff. So actually, there could be a real kind of loss of confidence in the Chinese banking sector from an investor point of view. And that's where the U.S. banks are partnered largely at this point. So I guess that's where the risk maybe comes from.
Yeah, that's a good point. And here's a fun fact for you, Guy. Based on this potential listing here, you're looking at Jack Ma is the world's 11th richest person. Would you know that? Exceeding that of Larry Ellison, his total fortune, $71.6 billion. Just take a moment with that.
Yeah, this is a
serious
huge
cash.
step forward. That's pretty serious money. He's come a long way. He's done really well. Baba and then spinning it out in the way that he's done. Yeah, there's been some bumps along the way, but certainly this is an incredible move. And to have that listing in Shanghai and Hong Kong, I think is something that's worth dwelling on as well. 3 or 4 years ago, as he mentioned in the Bund conference over the weekend, he just never would have done this. So let's talk about that IPO. Let's talk about the 5-year plan. The plenum is on this week. We'll probably get the details later this week. Ginny Yan, ICBC Standard Chief China Economist, joining us now. Ginny, from an investor's point of view, what am I looking for out of this 5-year plan? Which details should I focus on?
Well, really, from an investor's perspective, we're looking for really positive signals to really consolidate the thinking right now that there still will be positive policy support when it comes to recovery. Let's face the fact that we're not quite yet out of the woods when it comes to getting back to potential growth in China. Yes, we may see a positive print in 2020 GDP, and that's the best we could hope for. But how well is that going to be sustained over not only the 1-year, 2-year, but 5-year horizon? Investors, particularly long-term investors, are looking for some really positive signs out of this latest plenum to see that there is more investment coming out of the policy's way, more infrastructure spending, but also, more importantly, I think the market opening up to really unleash domestic consumption. Of course, recently we also saw some policies to really opening up the capital markets to also welcome international investors into the market. But really, more reforms are needed in the financial capital markets to attract more investors into that market, but also to look at a more diversified range of assets in the domestic market.
I guess what I want to know is, can China get a lot of inflow of money and private investment to help beef up industries that they want to be self-reliant on. At the same time, still stay a powerhouse of export growth that will need to be done to drive their growth in the short term. Can they do both at the same time?
Well, Alex, you've nailed it on the head, because this is, in fact, what's exactly behind the dual circulation strategy. Many people have been talking about that and hearing about that. But what does it actually mean? It means exactly that the economy will be more resilient. So not only relying on traditional industries and industries that are more domestically focused, but also to open up to the rest of the world. And really, given the current geopolitical circumstances and, of course, the gloomy outlook when it comes to global recovery, it will be a big challenge. But exactly what I said, the dual circulation means that on consumption domestically will be important. But what's also important is to make sure the rest of the industry is also agile. That includes industries such as technology, including SMEs, making sure that the labor market is also stable. These are the biggest priorities for the policymakers.
How do they avoid antagonizing the West and making the relationship with the US in particular worse with this 5-year plan? We're going to become more independent in technology. We're going to become less dependent on you. And this has been one of the key sort of limiting factors that the US has been able to use. If China is able to avoid that, how does the US respond? Does this sort of up the ante in terms of the tension?
Well, one of the things that last week was pointed out is more purchases by China of US goods. And we have seen that in the form of capital goods and also agricultural energy products. So in the immediate term, that's the best China could do. In the more longer term, however, partnerships, when it comes to technology, when it comes to other things, for example, energy, there needs to be partnerships with China and the West, not only US, also Europe, for example. We've seen lots of partnerships between China and Germany, another big powerhouse, when it comes to, trying to produce technology goods, but also making sure that the knowledge-intensive industries have the buy-in of both sides. And also global standards. China can't do it alone. It needs the West in terms of forming those global standards. And that is an aspect that I think the West could really help China with.
Is there any chance that happens? Like, what circumstances do we have to see evolve for that to actually come true?
Well, first of all, I think there needs to be an agreement that we need to agree to disagree. So obviously there are things that we will be disagreeing on, of course, we meaning China and the West. But globally, we need to recognize that there are certain industries that China will have, a competitive advantage, and still the West will have other competitive advantages. So really, there needs to be a middle path where there are a win-win scenario where both can benefit. We cannot see a situation where there will be losers. And this is exactly where the stalemate is at the moment, in that the West thinks that there will be a losing situation for the West. So I think it will be important for China to make the West realize there will be a win-win situation. And especially when it comes to emerging economies, those partnerships that China is seeking to form, it doesn't mean that this will be, meaning that the emerging markets will be losing its existing partnership with the US, but there are multiple partnerships to be had, and hopefully that multiple partnerships and also a much more multilateral world framework will be beneficial for not only China but the rest of the world.
How much are we going to hear about sustainability? How important is that going to be for investors?
Hugely, and particularly investors, because we know from a sustainability perspective, it is the demand for ESG, for sustainability, and that commitment to carbon neutral by 2060 is an important message and signal that China is committed. But just in terms of how that implementation of that will be carried out in the next 5 and even longer really depends on how the industries really start to implement those policies and start to realize that, this is a demand-driven, push really for there to be a more sustainable recovery going forward.
Ginny, where can China lead on that? I mean, is it small tech startups? Is it going to be just the massive amount of firepower the government had to throw money at this? Is it going to be in shutting down coal plants? Where do they have the edge?
Well, already what we're seeing is that China does have the edge in certain sectors such as renewable energy. So, for example, electric vehicles, etc. Renewable technology, much of that is made in China. But as I said before, China cannot do it alone. It needs partnerships across the world. So we have seen, for example, partnerships with the West already in these technologies. Really, to have the US also on board will be a huge, development. So whether it's in the next, presidency that we see that really partnership between the US and China on sustainable growth and sustainable industries is really a very visionary, aspect to have a look at and to look forward to.
Well, Ginny, it was a real pleasure to talk to you. Ginny Yan of ICBC. Thank you very much. We do want to update you on what's happening in the markets right now. It's a pretty ugly day that's unfolding. The Dow's off by 2.5%. You're looking at the low. It was about 722 points. NASDAQ also getting hit hard. Individually in the S&P, it's Royal Caribbean, Hasbro, Carnival, Norwegian Cruise, Apache, United Airlines. So the typical recovery trades are the ones that are selling off the most within the S&P. You're seeing a move into treasuries, no surprise, into the dollar as the safe haven bid comes. You are seeing a decline in the equity market over in Europe as well. We'll talk about that in a second. But you're still seeing a bid into BTP's Italian bond market. Part of that is a rating outlook. Nothing really bad came of it. In fact, it has a stable outlook now. But nonetheless, it's hard to make a super strong risk-off appetite move when you still have BTP's getting a bid with yields down 2%. We'll break that down a little bit in just a second. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Time now for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Apple wants to capitalize on the success of a product that's become an important source of growth. It's planning updates to its AirPods earbuds next year. Bloomberg's learned there will be two new models. One is a third-generation entry-level AirPod. The other is the second version of the AirPods Pro earbuds. Procter & Gamble's new sanitizing spray got perhaps its biggest vote of confidence yet today. Microban 24 has been approved by the EPA as effective in killing the virus that causes COVID-19. Microban was designed to be P&G's answer to Lysol and Clorox. It was introduced last February. And Blackstone Group has raised $8 billion for a private equity fund that will hold companies for longer than it normally does. Investments will focus on essential business, services, and companies with compelling intellectual property. Blackstone is the world's largest alternative asset manager. It brought in almost $48 billion the first half of the year. And that's your latest business flash, Guy.
Thanks very much indeed. European markets closing a little later than they normally would from a US perspective. We are 4 hours apart from New York this week. Big differences across Europe, and it's down to individual stocks, which is interesting. FTSE 100 outperforming, AstraZeneca having a really good day. DAX underperforming, SAP's having a really bad day. CAC 40's kind of in the middle. Peugeot's having an okay day, but some of the tech stocks like Capgemini aren't doing quite so well. So let's take a look at the individual names, just to give you an idea of the kind of scale of the differences that we are seeing here. Astra's a real heavyweight in the FTSE 100. SAP's a real heavyweight in the DAX. SAP is down by 22.27%. Astra's up by 2%. Peugeot up by just less than 1%. Alex, what's coming up?
All right, well, you will be doing the close in the next show, but it's it for me. Coming up is Balance of Power with David Weston on Bloomberg Television and Radio. Don't miss that. I'll be talking to the chair of the state Democratic Party in Wisconsin, Ben Wilkler, so definitely stay tuned for that. This is Bloomberg.
You can get a warm burger, soba noodles, even a bowl of curry rice. In a city like Tokyo, vending machines seem to be everywhere. There are literally millions in Japan, and it's a big business, selling $44 billion of goods in 2016. With COVID-19, those sales are slowing down, which means getting rid of unprofitable machines. Vending machine sales were already falling even before COVID, with competition from convenience stores that are open 24/7 and have way more options. But there is hope for some of them. About an hour away from central Tokyo is the Retro Vending Machine Park. Here you'll find 50 or so machines side by side selling some quirky items. Turning vending machines into tourist attractions may not be a solution for bigger business, though, since it requires labor and efficient distribution. Saito says it takes 5 people a day to restock his machines, just in time for lunch.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, I'm David Weston. Welcome now to Balance of Power, where the world of politics meets the world of business. I want to start with a check on the markets because they're not liking what they're seeing right now. Joining us is Abigail Doodle. So particularly the S&P, Abigail, is really not happy today.
Yeah, you know, we have a pretty risk-off day relative to stocks and the markets overall. At this point, the S&P 500 down about 2%, headed to its worst day in about a month. And David, I think largely this does have to do with the resurgence, the reemergence of the virus. Of course, over the weekend, 2 back-to-back record days of the virus here in the U.S. The virus getting worse in Europe, getting very close to some full restrictions, lockdowns in both Spain and Italy. So it feels like, we were talking about this earlier, it feels like traders were hoping for the best, but not quite preparing for the worst, now getting caught offsides. We see that the VIX, that quote-unquote fear index, is also higher. Oil, another risk asset, selling off, and bonds, haven bonds, are trading higher. Another play on the day, though, David, could be the reemerging trade war between the U.S. and China, because, of course, China's saying that they're going to slap sanctions on some of the defense contractors. So on this, we have some of the grains and other commodities lower, along with the SOX. The SOX, that chip index, of course, is a poster boy of sorts for the U.S.-China trade war, and that's underperforming, down even more than the other averages, down about 2.5%. So that's another nuance developing, as if we needed more, David.
Yeah, Abigail, talk to us about the Treasury bills. I'm sorry, the bonds for a second here, because last week we were talking about the reflation trade. We saw the yield on the 10-year go up above 85 basis points. Now I see it's down below 80, actually. What happened to that trade?
So that's certainly the bid for bonds, and that tells you that some traders are a little bit nervous here, that they are hedging around not just today, but last week, because while we had bonds sell off last week on that reflation trade, yields go higher, the yield curve steepened, we actually had stocks down. The NASDAQ 100 last week down for the first time in 5 weeks. So today's trading action is really a continuation of what we did have last week. And it's interesting, another piece of that you and I were talking about last Friday was that 210s, the yield curve steepening, that does pressure stocks. So today the yield curve is in, but last week the yield curve was at the highest level since February of 2018. So that could also be a piece of what we're seeing today. So many different factors weighing on the market, but net, stock investors, traders, not liking it, selling stocks on the day, David.
Yeah, a fair amount of action, which we will keep our eye on and bring to you as it develops. Thanks so much to Abigail Doolittle for that report on the markets. Well, the two sides in the stimulus negotiation reportedly made little progress over the weekend. That leaves hopes for getting something done before the election really pretty almost gone. We welcome now Terry Haynes, founder of Pangea Policy. Terry, always a pleasure to have you with us. First of all, can we basically drive a stake through the heart of stimulus before the election at this point? Is it over?
I certainly hope so, David. It's interesting. It's a classic example of people talking themselves into things. I'm frequently non-consensus, as you know, but I wasn't non-consensus on this in a Washington political context. My view of this for a long time now has been that both Pelosi and the White House thought it was in their political interest to keep tickling markets to avoid a market's downturn or a sell-off and take credit for whatever the resulting good is. But, that's clearly not going to happen before the election. Yes.
Okay, so that's before the election. What about after the election, the so-called lame duck session? Because we've heard Nancy Pelosi, the Speaker of the House, other people say, well, we can come back in the lame duck. Is that realistic? Are the problems going to go away or be better after the election?
I only remember 3 things that I was taught in law school. One of them is to say it depends as much as possible. But in this case, it depends. What it depends upon is what the election results are. But my view is that investors shouldn't be fooled by talk that the stimulus deal can get quickly sorted out immediately after the election. I think it's misplaced. I'll tell you why. If there's a status quo election, in other words, if you get Trump, still a Republican Senate, still a Democratic House, you've got the best opportunity to get something done quickly. But either in an all D or an all R scenario, and the all D is likelier as a second, certainly as a looming possibility. The opposition party, in this case, the one that's going to become the opposition party, the Republicans, are going to make the new majority wait until January the 20th. There's no political reason to do it otherwise. Pelosi wants a big number. Democrats want a big number. Republicans have no political interest in giving them a big number, so they won't do it. The only way and same with Republicans, if should we get an all-R Washington like in 2016, the only way that changes is if there's an actual economic crisis of something like a March 2020 proposal. proportion, and nobody thinks that's likely. So I would say not.
So Terry, even beyond the stimulus, let's talk about what happens after January 20, whichever way it goes, 4 more years of President Trump or a new President Biden. Is there as big a policy difference between the two of them as there appears to be? And more important, can Vice President Biden get that done if he becomes president?
Well, let me say 2 things about that. One is reflected in your first question about stimulus and markets. One of the more concerning things to me about what's happening with markets today is that there's an echo chamber on Washington issues that are far disconnected from what people in Washington actually think and believe what's going on. Stimulus is a very strong evidence of that disconnect. As we just talked about, most in Washington thought it wasn't likely for the last 2 months, but yet the markets continue to say that's the case. Today, we're now getting a situation where a lot of people on Wall Street are expressing increasing confidence in a unified Democratic government outcome that may lead to a significant fiscal expansion. I think that's somewhat misplaced. If you get a Biden administration, what's going to happen immediately is you're going to get internecine warfare between centrists and progressives who will think they elected Biden and will think they deserve a great deal. That sort of stuff's already happening. On a policy matter, what you're going to get is tooth and nail fighting on what a tax increase and what tax legislation looks like. Centrists will want it to look in a much more conventional way, but progressives will see it as the basis of a Green New Deal expansion. So you're not going to get something quick or easy, and you're going to get a wholesale fight among the Democrats alone about what's likely to happen. Trump in a second term, I think, is largely stymied by circumstances. Increased debt, increased deficit. I think he does make another run at infrastructure, though. But I think those who are interested in the blue sweep, I think, have a lesson coming to them about the ways in which the president and Congress work together. We saw that with Carter when Democrats in the majority clearly didn't agree with Carter's own priorities. We saw it with Clinton in the first couple of years, and we saw it again with Obama, and we're likely to see that again. And that's not good news for those who want a quick and easy change in priorities in Washington.
Terry, you've watched this happen in Washington for so many years. One of the most important things for a new president or a president's second term is to set priorities. What's the number one priority? Because you can't get everything done. We have Vice President Biden now, former Vice President Biden, laying out a raft of policy initiatives. He can't do all that at the same time. Do we have a sense, if he in fact were elected president, what his number one thing would be? You mentioned tax reform, tax increase. That's a means to an end. That's only because he wants to accomplish something. What does he most wants to accomplish?
Well, I think what he most wants to accomplish is infrastructure. Frankly, it's not by accident that the slogan of the campaign is "Build Back Better." But at the same time, I mean, what kind of infrastructure is it going to be? What are the priorities? That is exactly where the party split here between progressives and centrists will manifest itself. When the centrists who vote for Biden hear infrastructure, by and large, what they hear is they're going to fix roads, they're going to fix bridges, they're going to fix kind of the conventional systems. When progressives hear that, what they hear is we're going to put money into solar. We're going to put money into Green New Deal programs. We're going to accelerate, get rid of subsidies for oil and accelerate cleaner technologies. And push people in a different direction. And so I think even infrastructure will be a very hard sell, but they will try to use a lot of this, just as Republicans did, in so-called tax reconciliation, just like Republicans did in 2017. So that's going to be the centerpiece of whatever happens in 2021.
Terry, as I say, it's always a pleasure to have you with us. That's Terry Haynes. He's the founder of Pangea Policy. Coming up, our Swing State Series makes its last stop before the election, this time in Wisconsin, with the chair of the Democratic Party of Wisconsin. He is Ben Wickler. That's coming up next on Balance of Power on Bloomberg Television and on radio.
What moves the human spirit, what transcends time, comes from true craft. The artistry of Japanese craftsmanship. Presage, Seiko.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I think what we want to do is take a consumer-first approach. We really want the consumer to guide us on how they want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We turn now to Mark Crumpton for Bloomberg First Word News.
David, thank you. White House Chief of Staff Mark Meadows is defending comments he made to CNN Sunday that the Trump administration is, quote, not going to control the pandemic, end quote. Asked why, Meadows said it's, again quoting, because it is a contagious virus just like the flu. Speaking to reporters today, Meadows tried to clarify his remarks.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can. And if you look at full context of what I was talking about is we need to make sure that we have therapeutics and vaccines. We need to make sure that when people get sick, that they have the kind of therapies that the President of the United States has.
And Mr. Meadows says President Trump won't give up until all Americans are safe and the virus is defeated. Amy Coney Barrett could be a Supreme Court justice before the end of the day. The White House says a swearing-in ceremony is planned for tonight if she is confirmed by the full Senate. That would put Barrett on the court a week before the presidential election and create a 6-3 conservative majority. She is expected to easily win confirmation. Russian President Vladimir Putin is trying to preserve the collapsing framework of a nuclear arms control agreement. President Putin has offered new missile verification measures to NATO countries. This comes after the United States withdrew from a Cold War-era treaty. Each side rejects the other's allegations of breaching the agreement. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. We've been taking a look at the key swing states in the build-up to the election, and this week we conclude with Wisconsin, a state that President Trump won in 2016, making him the first Republican presidential candidate to take the state since 1984. To give us an overview of the politics of Wisconsin this time, we welcome now the chair of the state Democratic Party. He's Ben Wickler. So, Mr. Wickler, thank you so much for joining us. Give us your sense of where Wisconsin is right now with respect to this election 8 days from now.
Wisconsin in 2020 is so conscious that it might be the tipping point state in the entire presidential race that just about everyone is talking about politics all the time. The polls show very clearly that Biden has an edge in the Badger State. He is up in the public polling averages by between 6 and 7 points. The challenge is that is also how much Hillary Clinton was up in 2016 on Election Day. So at a surface level, you might think it's the same. The reality is it is totally different. In 2016, people on both sides, but especially the Democratic side, didn't know that Wisconsin was in play. If you look now, this is a state that is a relentless focus. We have folks on our team who've been organizing here for 3 years at the Democratic Party. Trump hired his Wisconsin state director in July 2019. There are ads every time you turn on a Packers or Badgers game, mostly Biden ads at this point. Trump keeps traveling here to try to shore up his numbers, and we're seeing a flood of early votes and absentee votes, of volunteers jumping on phone banking shifts, of chalk art on college campuses. This is a state that is in full battle mode for the ultimate battleground state status in the ultimate election, and it is intense.
Ben, talking about why this time might be different from 4 years ago, I think one of the factors last time was voter turnout. What do you know about voter turnout at this point? What are you anticipating?
So 2016, two striking things happened with turnout. The first is that Trump and Clinton both bombed. They both got fewer votes than 5 out of the previous 6 presidential nominees. They got fewer votes than the loser in 2004 and in 2012. Only John McCain did worse when he got completely routed by Obama in a 13-point landslide in 2008. So a lot of people just didn't vote for either of them. And the other part of that story is that a lot of people voted third party. There were 2 different candidates who got more than Trump's margin of victory in Wisconsin. There's no similar third party energy in Wisconsin this time. Folks who are fed up with Trump know that it is time to vote for Biden. And in 2016, a lot of people said, I can't vote for either of these candidates. That's just not happening the same way this time. Now, it is hard to model turnout in the middle of the coronavirus pandemic. What we can see is that there is a rush of people casting absentee ballots and now doing early vote in person. The total number as of today is more than 1.33 million ballots cast in a state that only cast 3 million total ballots in 2016. We think we have a decisive edge among votes cast by mail that have come in so far. It is closer among people doing early vote in person. Republicans are talking about a flood of people on Election Day. There are 2 very different election campaigns being run with different tactics to organize people to vote in different ways. And in a sense, it's a big kind of political science experiment. In another sense, every person who votes for Biden and Harris now is someone we don't have to focus on turning out for Election Day. And I think our strategy gives Democrats an edge as we race to the finish line.
When those of us who are not in Wisconsin hear about Wisconsin, we're told there's a big difference between the cities and the suburbs on the one hand and the rural districts on the other. They vote in very different ways. Is that true? And how is that breaking down this time?
So the magic recipe in Wisconsin for Trump, if he wants to win, he needs to stem his losses in the suburbs, especially the suburbs around Milwaukee. He is clearly trying to suppress the vote in cities like Milwaukee, as I'm sure he'd be happy to suppress the vote in Madison too, and he needs to rack up massive margins in rural areas. And for us, the recipe is the opposite. We're working to help every possible voter cast a ballot in our cities. We're working to organize folks in rural areas to hold down Trump's margins. And frankly, I think we're gaining ground in rural areas rather than losing it. And in the Milwaukee suburbs and suburbs across our state, there's a huge swing that we can see happening in real time. Trump would have to win a commanding share of the votes in places like Waukesha and Ozaukee County and Washington County, the so-called WOW counties. Instead, we're seeing, state assembly candidates who are on the march in these districts that were gerrymandered to be permanently Republican in those suburban areas. So, we're organizing for every square inch and for every voter in our state. And Trump is losing ground in all 3 areas, it's like a balloon. If it can't squeeze bigger somewhere, then the whole thing's going to pop. It feels like that's happening with Trump's numbers right now.
Ben, we've been talking about really the horse race aspect of it, which is terribly important as we're 8 days away from the election. But talk about the issues. What is motivating voters, in your judgment, in Wisconsin right now? What's driving them?
Wisconsin has one of the worst, arguably the worst coronavirus outbreak in the United States. If you look at new cases per capita, we are worse than 46 other states across the country. Only Montana and the Dakotas have a more rapidly rising case count than we do. We have hospitals filling up, spilling into field hospitals. This is something that's transforming people's lives, and it's crushing the economy, it's crushing small businesses, and it's forcing schools to make these impossible decisions in a way that squeezes working parents. So this is the inescapable reality in Wisconsin. Trump was already underperforming. He was breaking his promises about manufacturing jobs and farms before the pandemic hit. This has made that situation far worse. And in the middle of it all, people are terrified about losing protections for pre-existing conditions. So healthcare and the virus interact in this pretty intense way, and it's turning people against Trump. If you think coronavirus is a hoax, you're probably casting a ballot for Donald Trump. If you're worried about your family and your friends and what's happening to your business because of this pandemic, you're going to vote for Joe Biden. And more people are seeing that and are worried about it. When Trump comes here and holds super spreader events, it kind of reinforces that he doesn't fundamentally care. When his White House says that they can't get the virus under control, it underscores that this president's given up on the thing that is just taking a toll on every person's personal life. It's what affects people, as Kellyanne Conway said, not what offends people. And people are affected.
Right. Ben, thank you so much. That's really set the table for Wisconsin so terribly well. It's Ben Wickler. He's Wisconsin Democratic Party chairman. He's going to be staying with us for the second hour of Balance of Power, when we're going to talk about the voting process in Wisconsin this year and how they're going to count all those absentee ballots. And a programming note now, Bloomberg will have live coverage of the election results starting at 7 p.m. Eastern Time on Tuesday, November 3rd. This is Balance of Power on Bloomberg Television and Radio.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Turkey is in the news today as the lira falls below 8 to the dollar in the midst of geopolitical tensions, including with France. And France has recalled its ambassador now. And President Erdogan has now asked his citizens to stop buying French goods. To take us through where things stand, we welcome now Bloomberg's Istanbul bureau chief. He is Onur Ant. So, Onur, thank you so much for joining us. Where are things right now? Is he serious? Turks are just not going to buy anything from France?
Well, it's difficult to gauge and predict the success of these calls, David. People usually tend to forget about them after a certain period of time, and it's the first time Turkey really did. Well, Erdogan did try to call for a national boycott in a couple of years since the diplomatic spat with the U.S. back in 2018. So I guess we're not going to see people seriously sort of backing away from normal consumer behavior for a long time. But it's still, nonetheless, it's quite important what happened today because it shows how low the Turkish-French relationship has really sunk. And it wasn't really good to begin with, but it really got a lot worse.
And it strikes me, Onur, that it's not just these two countries and various issues they have, but there's a sectarian element to this because, as I understand it, it was triggered, the recall of the ambassador was triggered by President Erdogan questioning the mental ability of President Macron. And that's because President Macron had some things to say about that tragic beheading of a French teacher.
I think it will predate the gruesome murder of the French teacher earlier in October when President Macron first talked about his vision to quote-unquote reform Islam, which he said was a religion crisis. I think it really didn't go down well in Turkey, to say the least, with the political leaders, and especially Erdogan seems to have taken a serious issue with it. So the tension has been rising since then, but I think it burst to a level where it completely grabbed headlines over this weekend because of Erdogan's first remarks about President Macron himself, and then ensuing decision by Elysee to recall this ambassador from Ankara over this fact.
Owner, does the offense taken about the remarks by Mr. Macron about Islam, does it go beyond Turkey? Is it affecting other Islamic countries over in the region?
We are seeing signs of that. There have been calls for boycott of French goods in parts of the Arab world, just to the south of Turkey, in places like Kuwait and Qatar. But I think there has been a somewhat rough and broad division among countries in the region. Countries like Iran and Turkey, which sort of both champion political Islam, although in very different manifestations of the word, and their somewhat ally Qatar is on the one side and very vocal about criticism of French policies or French policies vis-a-vis the Islamic community there. And then on the other side you have the United Arab Emirates and Saudi Arabia, and you don't really see much of a backlash there.
Yeah, it's fascinating, really important story. Thank you so much to Owner Ant. He is Bloomberg's Istanbul Bureau Chief, joining us today. Coming up next, we're going to have former Massachusetts Governor Deval Patrick about the election. This is Balance of Power on Bloomberg Television and on Bloomberg Radio.
The Boston Symphony Orchestra presents
There isn't anything about trading that is more central to your success than accepting the risk. So wrote Mark Douglas in Trading in the Zone. But how do traders accept the risk? They apply good risk management. They never lose more than a very small percentage of their capital on a single trade. They protect what they have, concentrate on capital preservation and don't get hung up on making money. And they never let their ego, emotions, fear or greed get the better of them.
Doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
To give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Balance of Power. I'm Guy Johnson. Stocks finishing up the day here in Europe. Remember, this week, 4 hours between New York and London, hence I'm appearing in Balance of Power. Stock 600 gapping lower first thing this morning, but finishing near session lows. Bunch of factors coming together today. Some macro factors. We're seeing a huge pickup in COVID cases here in Europe. Plus, the data's not particularly good. We had a very poor EFO survey a little bit earlier on out of Germany. Plus, we've also got some granular stock stories, which are also pushing markets around quite a lot today. So a kind of macro top-down, bottom-up kind of story really hitting Europe in a pincer movement today. It's real dispersion between the individual markets as well. FTSE 100 only down by 1.2%. But take a look at what is happening with the DAX over in Germany, down by 3.65%. This is where the individual stock story is really coming into play. The CAC 40 down by 1.9%. The individual stock story for the German market today is SAP, absolutely being demolished in terms of its share price performance, as you can see, down by 22.32%. The earnings story out today, and particularly the outlook today from this Waldorf-based company, really very poor. And you wonder whether or not there's going to be significant read across into others within the space as well. US tech, certainly watching what is happening very carefully here. So SAP down hard. Just in terms of context, this is the biggest move in SAP to the downside since 1999, just before, obviously, the dot-com bubble burst, a very germane date, obviously, and a relevant date for everybody that's watching what's happening with the tech space. In terms of other individual stock stories, there are some that are definitely worth focusing on. London's outperformance coming in large because of AstraZeneca today, up by 1.85%, the biggest points gainer. The reason for this is we are seeing a very positive response to elderly patients who are in the test for the Oxford vaccine. That was taken very well by the market. That stock up by 1.85%. But travel stocks broadly on both sides of the Atlantic are under pressure. Carnival, the dual listing, down by 9.7%. And in the car sector, this is kind of why the French market kind of went in the middle between London and Frankfurt today. PSA up by 0.6%. We are seeing Peugeot merging with FCA Fiat Chrysler, and it looks like we're going to get European regulatory clearance for that story. That's the European close. David.
Thank you so much, Guy Johnson. Just to bring you up to speed on this side of the Atlantic, we continue to sell off in equities. We got the Dow Jones leading the way down right now about 2.75%. So we'll keep watching the markets over here as well. In the meantime, let's get back to politics. Deval Patrick served 2 terms as governor of Massachusetts after his tenure as Assistant Attorney General for Civil Rights in the Clinton administration. He is now co-chair of American Bridge 21st Century, and we welcome him back now to Bloomberg. Governor, it's always a pleasure to have you with us. You have a piece out of Medium in which you really take the Trump administration to task. And it's not surprising. You're a Democrat. President Trump is a Republican. But in reading this piece, it seems to go beyond just some disagreements. You think there is some fundamental damage that may have been done to the country. And I guess in reading it, my question to you is, can we turn it back around?
I think we have to. And I say that not as a Democrat who thinks you have to hate Republicans to be a good Democrat. You know, we don't always get it right. And frankly, most people aren't accepting 100% of what either party is selling. But I think that it turns out democracy depends, David, on some unwritten rules around decorum and restraint and respect, integrity. And so many of these rules have been flouted by this administration, and we simply have to see that as a threat to our democracy.
Let's talk about the thing that perhaps is most pressing to everybody right now in this country, and that is COVID-19. Because we had a terrible bout with it back in March, April, into May, and now it seems to be coming back, in some ways perhaps even worse than before. What can and should be done about that? And in fact, is Mark Meadows, the chief of staff to the president, kind of right? We really can't control it.
Well, we can control it. We could have controlled it better had we been honest with each other. And had the president been honest with the American people from the beginning. But health experts agree that wearing a mask, social distancing, rapid and widely available testing and tracing are all important, that we have to have guidelines that are followed consistently and are comprehensive across the country and not kind of state by state and region by region. This is one of the areas where the lack of leadership at the top has really, really hurt us. We've managed to politicize a public health emergency. Imagine that. It's like the last thing I would have imagined it could have been politicized, so that now wearing or not wearing a mask is deemed some, expression of freedom instead of what it is, which is a profound example of selfishness.
Governor, it's a tradition sort of in the United States, as you know, with a new president, talk about the first 100 days of the new presidency. Take us forward. If, in fact, the former vice president is elected and we have a President Biden, what would you imagine in that first 100 days with respect to COVID-19? What would be different from what we've seen in the past?
Well, again, remembering that COVID-19 and economic recovery are very much connected. They are not separate things. I think we can expect from an incoming Biden administration a comprehensive plan that talks about these public health steps that we should take, talks about what a distribution plan around a vaccine should be, and most Americans agree that healthcare workers and folks with contact with children and vulnerable populations should be first. That there will be to say it again, a plan, a step-by-step set of guidelines that we can all refer to in making our individual choices, and that those choices will be inspired by candor and clarity about what we know and what we don't know going forward.
As a practical matter, a lot of people are getting tired of the social distancing and even the wearing the mask. I mean, there's a fatigue that's setting in this country.
Right.
Would a President Biden be able to enforce those guidelines? I mean, would we have fines? Would we be arrested or detained if we didn't follow the rules?
I just don't know if we're going to need to go as far as all that. Everybody's tired. I'm tired. I have to imagine that the former vice president is tired too. We yearn for a return to our routines and to contact with other people. But the way we beat this is by making some shorter term sacrifices that are in the common good. And I think having a president, a leader, who shows that kind of leadership and reminds us how important it is at times like this to turn to each other rather than on each other is a big part of what we need, all of us, to get to the other side.
So, Governor, you obviously have successfully run for office more than once now. Give us a little insight into the strategy we're seeing right now. Which are the states that are key? And let me ask about a couple states I didn't think I'd ask about. New Hampshire and Maine. I understand now President Trump is heading up there. Does that signal something about a weakness on the Democrats' part in those states?
Well, I think it may signal something about a weakness on the president's part. First of all, let me just say, I don't think any vote anywhere should be taken for granted. And I think Democrats have to be about talking to everybody and making a case to everybody about what a Democratic plan would be, not a plan for Democrats, but a Democratic plan for America. And that is about growing the economy out so that everybody has an opportunity and not just up, so that the well-connected have their chances. It's about health care for everyone that is affordable for everyone, that is a combination of and a choice between public option in the ACA or private insurance, which is more effective and more equitable. It's about racial equity, and it's about engaging people and helping folks understand their own stake in their civic and political future. So I think that case has been made well by the Biden-Harris ticket and by other Democrats running for the Senate and the House. It's an exciting time, I think, because the challenges are so great, but the opportunities to try some new things, to do some things differently, is also presented. And so I think, yes, you'll see lots of folks talking about and focusing on at American Bridge, for example, where I'm involved, on Wisconsin and Michigan and Pennsylvania. There are pickup opportunities in the Senate in Maine. There are opportunities in Kentucky and Georgia and Alabama and Mississippi, where I was last week. Folks, Democrats are talking about Texas as a battleground state. But the point is, everybody everywhere counts, everybody. And I hope that folks remember that when they go to vote.
I'm glad you raised American Bridge and the work you've done in some of the swing states, because you've been on to talk about that. I want to talk about, two in particular. Florida, we all understand, is critically important. That President Trump has to win that if he's going to succeed as a practical matter. We see former Vice President Biden spending a fair amount of time in Florida. But what about Pennsylvania? That's the one I'm curious about, because we now have President Trump spending a lot of time in Pennsylvania and Vice President Biden not as much.
Well, I can't speak for the Biden campaign's choices on a day-to-day basis, but I know that they have spent a lot of time in Pennsylvania and spent a lot of money in Pennsylvania reaching voters, both for reasons of persuasion and also to get out the vote. Pennsylvania is a big, complex, really, really interesting state, I believe. It's one of the places where, our presumptive base in urban communities is pretty strong, and that in between Philadelphia and Pittsburgh, there is a lot of room and a lot that's up for grabs. I think when you heard in the last debate, for example, Vice President Biden talking about transitioning away from a carbon-based economy to a carbon-free economy, you heard President Trump say, "See, listen to that. If you live in Pennsylvania and you're worried about the future of fracking." And I think people should pay attention to that, but not for the reasons of sort of being afraid that President Trump brings up. Governing by fear, campaigning by fear, I think is never a good idea. This is about what kinds of innovations, what is the next thing that America can lead on. And what Democrats have to be about, and what I believe Vice President Biden is about, is how to make sure that everybody has a place in that future.
Okay, Governor, it's always such a pleasure to have you with us. That's Deval Praktic. He is the former Massachusetts governor and now co-chair of American Bridge 21st Century. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. With 8 days to go until Election Day, more people already have cast ballots in this year's presidential election than voted early or absentee in the 2016 race. More than 59 million people have voted in person at early voting centers or by mail. The surge comes as voters try to avoid crowded places on November 3rd during the coronavirus pandemic. President Trump's son-in-law and senior advisor, Jared Kushner, is drawing criticism on Twitter after saying that black people must, quote, want to be successful, end quote, in order for his father-in-law's policies to help them. Kushner made the remarks on Fox and Friends today. Mr. Trump lost among black voters by about 82 percentage points in 2016, but has closed the gap in support to about 71 points this year. That's according to polling data, 538.com. Residents in El Paso, Texas are being urged to stay home for 2 weeks. Officials are trying to stem a spike in coronavirus cases that has overwhelmed local hospitals. Governor Greg Abbott has also transformed part of the city's civic center into a makeshift hospital and is sending nearly 1,000 medical personnel from across Texas to the region. Americans are rushing to pharmacies in record numbers for seasonal flu shots as the pandemic brings new urgency to this year's flu season. CVS says it has already surpassed the 9 million flu shots it gave during the entire previous season and expects to double that number by the end of the season. Walgreens has given 60% more doses in its U.S. stores than at this point last year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. Coming up, we hear from Republican Senator of South Dakota, Kevin Cramer, about stimulus prospects and energy policy. This is Balance of Power on Bloomberg Television and Radio.
What would you say that the CDC or the FDA or the White House or HHS should have done differently?
Almost all of us have underestimated the dramatic impact of this outbreak.
Jacinda Ardern's Labour Party holding 64 seats in the 120-seat parliament. Now, that is interesting because it's the first time since the introduction of proportional representation in 1996 that any party has won enough seats to govern on its own. Now, this is by turns rather luxurious and also slightly terrifying for the new Labour government because there are no checks and balances on power. There is no upper house. Jacinda Ardern can pretty much rule as she sees fit. So she did rule out, heading into this election, any capital gains tax, but as revenue collapses, it must be very tempting to give that policy another look. She's also contemplating going into coalition with the Greens Party, even though she doesn't actually need them to govern. Now, the Greens Party did take forward a more comprehensive package of tax reforms to this election, so were she to govern in concert with the Greens, they could do much of the heavy lifting on tax reform, which may also prove to be a little unpopular with some portions of the electorate. So it's going to be very interesting to watch this new term. There's going to be a lot of new and untested MPs in the caucus. So a second Jacinda Ardern term is going to be full of all sorts of different challenges to the ones that characterized the first.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. However the election comes out 8 days from now, it looks increasingly likely that any stimulus bill will have to be taken up in a lame duck session after that election. Our chief Washington correspondent talked with Republican Senator Kevin Cramer of South Dakota about the prospects, as well as about his state's concerns about energy policy.
I've always believed there would be a lame duck deal, and I think as long ago as a couple of months ago already, the window had gotten pretty tight for a pre-election deal, partly because some people were waiting to see how the rest of it still played out, partly because we're getting closer to the election and nobody wanted there to be winners, only losers. And while the White House and the U.S. House were negotiating up, the Republican Senate was hanging tight at about $500 billion. And so I never really did think we were going to get a deal before the election. I was hopeful. But you asked the magical question, that is, and how much? And I think in the lame duck, regardless of the election result. Now, the election result will no doubt inform to some degree what that number might be. But either way, I think the pressure valve gets opened and people get back to at least some semblance of normal, and it'll be a number between the $2 trillion that they're talking about now and the $500 billion that Republicans have.
What do you say to folks who say, we just can't afford to spend upwards of $2 trillion?
Yeah. I say you're right, but we also can't afford to do nothing. And while the debt and the deficit certainly are important, and obviously they're skyrocketing, but we pretty much threw those rules out the window when we passed the not just the CARES Act, but the $1 trillion worth or so before that even. So now it's a matter of how much is necessary. I think at the point of the CARES Act, we didn't know how long it would last. I don't think anybody anticipated that the downturn would last this long. There's been some nice recovery, Kevin, certainly in lots of areas. However, I maintain it's very fragile. You mentioned investors up front. I think investors are watching very carefully, and the Federal Reserve has pretty much done all they can with liquidity tools that they have. It really is upon
What
us.
specifically are you fighting for in the next round of stimulus?
Yeah, so one of the big things I think is paycheck protection forgiveness. I think that's been clumsily handled by the SBA. I think a lot of our lenders at every level, large, small, credit unions, banks, they strongly encouraged after our encouragement to get a lot of borrowers into the PPP. A lot of people have been pleased with it. However, it was always designed to be forgiven if people used it to maintain their payrolls. People have been doing that, and now the bureaucracy kicks in. I think we have to do that, but I think we have to help the airline industry. And I know some people think, well, that's just a bunch of billionaires, rich people. Next to energy itself, I think the airline industry probably touches the value chain of just about everything in our economy, and they need some help until we can get, demand back.
Well, let's talk about energy, because last week in Nashville at the final presidential debate, there was a key moment where Democratic presidential nominee Joe Biden said that he was not against banning fracking. He was against banning fracking on federal land. And then he went on to say that he would like to have zero emissions by 2025. How do you square that circle?
Well, you can't, and that's the problem. That's why I think that his message was incoherent, and to the degree that it was what he meant to say, it was frightening. I mean, he did clean up he said complete zero emissions by 2025, which is absolutely impossible, obviously. A net zero by 2050 is what the United Nations, the IPCC, is advocating for. So he's very confused. I think he doesn't know much about energy policy, quite honestly.
Well, what do you say to the family of refinery workers or the refinery employees? I mean, I know energy is such a crucial economic engine in your state. You defeated a Democratic incumbent in your last election. Energy played a crucial role in that specific election. I mean, what do you say to refinery workers who have been pummeled by the economic downturn this year and who are trying to understand, and they don't really... Maybe they're for Trump, maybe they're against Trump, maybe they're for Biden or against Biden, but they're trying to figure out what their economic forecast is going to be for not their portfolio, but for their kitchen counter.
Well, no question. So when you talk about a desire to transition away from oil and gas, first of all, I don't even know why you would want to do that. We have an abundance of this resource in the United States. We've gone from being a net exporter to from a net importer to a net exporter. That has had national security implications as well as economic implications. So I think what we have to tell them is, no, we're not going to transition away until there's some other market force that requires it. We're just going to find cleaner ways to utilize oil and gas and coal and the other baseload fuel sources that are so important in the value chain of the global economy. So everything we consume touches energy, or energy touches it. Every value chain, every supply chain of everything we grow, produce, manufacture is touched by the energy supply chain. So we have to fight not just for those workers, but for everything that they represent, and that is national security, economic security.
That was Senator Kevin Cramer, Republican of North Dakota, speaking earlier with Kevin Cirilli. More on the market sell-off ahead. This is Balance of Power on Bloomberg Television and on radio. It's time to get a check on the markets with the equities down. Scarlett Fu is here with all the details. Scarlett?
David, of course, we're looking at some disappointment over any movement on stimulus, but I really want to focus in on three companies that are leading declines here. It's yet another sign of rising tensions between Beijing and Washington. Last week, the State Department gave Boeing, Lockheed Martin, and Raytheon it's okay to sell almost $2 billion of arms sales to Taiwan. Today, Beijing responded with sanctions on the three companies. No word on the amount or timing, but keep in mind that this weapons package is not a done deal. Congress still has to sign off on it and do a final review. What it includes are missiles from Boeing, a rocket system from Lockheed Martin, and aircraft surveillance sensors from Raytheon. Beijing also upset over Lockheed Martin's sale of some F-16 jets to Taiwan back in August. And the backdrop here is, as you know, Beijing considers Taiwan a part of China under its One China policy and has threatened to bring the island back to its fold by force if necessary. Taiwan, for its part, counts on the United States to keep peace in the region and also to sell its arms so it can defend itself militarily. Sanctions clearly not good for business overall. Lockheed Martin says its presence in China is actually limited. Asia as a whole makes up about 10% of revenue. Boeing is in a bit of a trickier spot because it sells a lot of commercial planes to China, including the troubled 737 MAX jet, which is still grounded. So for now, defense sales count a lot more. Meantime, if you look at what's going on in China, the leaders there are gathering this week to map out their 5-year plan. It's going to be a 4-day closed-door meeting, and whatever comes out of it, the National People's Congress will be rubber stamping in March. What investors will be looking for is some indication of a continued shift of the economy to be driven by domestic demand, domestic consumption, rather than exports. And of course, that's part of the dual circulation because it does count on additional external trade to supplement growth.
Okay, thank you so much to Scarlett Fu. Coming up, second hour of Balance of Power on radio. Thanks so much for joining us. This is Bloomberg.
I'm Mark Crumpton with Bloomberg's First Word News. President Trump plans to intensify an already packed travel schedule in the final full week of the presidential campaign. He's expected to hit nearly a dozen states in his effort to recover ground from Democrat Joe Biden, who is leading in most national polls. The president is scheduled to hold 11 rallies in the final 48 hours of the campaign. Amy Coney Barrett could be a Supreme Court justice before the end of the day. The White House says a swearing-in ceremony is planned for tonight if she is confirmed by the full Senate. That would put Barrett on the court a week before the presidential election and create a 6-3 conservative majority. She is expected to easily win confirmation. Turkey is deepening its rift with France. President Recep Erdogan is urging his nation to boycott French goods over what he says is the country's hostile stance toward Muslims. The tension between Turkey and the European Union has been escalating over a number of issues, from the Libyan civil war to Turkey's energy exploration in the eastern Mediterranean, with French President Emmanuel Macron criticizing President Erdogan for his assertion of regional power. In China, President Xi Jinping opened a meeting to map out the country's next 5-year plan. It could push the economy past the United States within a decade. China's latest roadmap will center around technological innovation, economic self-reliance, and a cleaner environment. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
It's 1 p.m. in New York, 5 p.m. in London, and 1 a.m. in Hong Kong. I'm Bonnie Quinn. Welcome to Bloomberg Markets. Here are the top stories we're following on the Bloomberg and from around the world. A global equity sell-off gaining steam. The S&P 500 headed now for its biggest decline in 7 weeks, thanks to surging virus cases, the Washington stimulus logjam, and just general malaise. Volatility rising too, as rising cases in the Midwest and the potential for fresh lockdowns already happening in Europe are driving investors to sell. Johns Hopkins professor Sabra Klein will join. And with just days to go before the US presidential election, we'll take a closer look at the tax policies of both candidates with Alan Auerbach of the Robert T. Birch Center for Tax Policy and Public Finance. Let's get a quick check of those markets now, and they were angry this morning and getting angrier as the day goes along. Just a few stocks in the S&P 500 higher. It is down 2.5%. The Dow down almost 3% right now. As you can see, we're also seeing Treasuries moving around just a little bit, 80 basis points this morning, 79 basis points on the 10-year now. And crude oil also adding to losses, down a further 3.3%. Not so, though, for the Chinese yuan offshore. That actually strengthened a bit at 671.20. U.S. President Donald Trump and Democratic presidential nominee Joe Biden now making their final pitches to swing state voters with just over 1 week until Election Day. Laura Kane is UBS Global Wealth Management Head of Thematic Investing Americas. And no doubt the themes most recently have all been election-related. UBS revising its forecast, Laura, now sees a 55% probability for a blue wave where Democrats capture the White House and both chambers of Congress. What took you to the 55%?
First of all, hi, Bonnie. Thank you so much for having me today. So based on the polling data and prediction markets that we follow, we are seeing an increased probability of a blue wave outcome. But overall, we believe that the blue wave outcome would be quite positive for markets in the sense that we could expect to see a larger fiscal stimulus package. And we have seen equity markets pricing this in to some extent already. But overall, regardless of who's in the White House, we do believe that once we get past the election and once we get more information on a potential vaccine, hopefully by the end of this year, that the economic recovery should take hold next year. And that combined with more fiscal stimulus should lead to a very positive environment for equity markets. So even though we're experiencing some near-term choppiness today and in recent weeks, we do believe that the outlook is quite positive.
Today, though, quite the statement, in fact, Laura. I mean, we've been seeing markets rise, and with with an odd drop every now and then when it looks like stimulus talks are going nowhere or what have you. But today it's a definitive statement. You know, a 3% drop for the Dow is not nothing. What's behind it?
Yeah, so I think there's a few key things at work here. So one is we're seeing rising COVID-19 cases across Europe and the US. And this, of course, is raising fears about the potential for further lockdowns. What I would say to that is that we do believe that while we're seeing cases rise, we are seeing fewer fatalities as a result. So doctors have a better understanding of the virus. We're also seeing more cases among the youth population that tend to be better able to withstand this virus. So we do believe that looking forward, like I mentioned, we will be getting more vaccine data, maybe even as early as the end of this month or even into next month. So I think that should also help to alleviate that concern. The other major concern is when we're going to get fiscal stimulus. It's looking increasingly unlikely that we'll have something before the election. So I think that's adding to the market's concerns. We also had some disappointing tech earnings results in Europe. So I think we're seeing some read-throughs into the US tech sector today. So putting it all together, there's a wall of worry for the markets to climb. And we do expect to continue to see near-term choppiness until at least we get past the election and have some more clarity on the policy front.
Now, Laura, as part of your election watch research, you do have a look at energy, financials, healthcare, infrastructure, technology, and so on. But just if you could give us a brief overview of what you are recommending consumers do in the event that, you know, we travel through this virus for another 6 to 9 months, and then, you know, we have to deal with perhaps more stimulus, also in the form of, you know, larger fiscal burdens.
Sure. So, you know, what we've outlined in our most recent election watch report is, you know, where to focus under the various election outcomes. And the two that we focus on are, you know, the blue wave outcome. And in this scenario, we do feel that we'll get a larger fiscal package. And then in terms of winners and losers, we should see a boost to companies with exposure to green infrastructure, more fiscal spending. So certain parts of industrials, utilities, and materials could benefit under that scenario. And then if we get our second most likely outcome based on our predictions, which would be status quo, we do expect to see somewhat of a relief rally for certain sectors like energy, financials, even healthcare, where we've seen more concern about potential for increased regulation under a Biden outcome. So those are some of the areas that we've highlighted in terms of winners and losers. But like I said, in any case, no matter who's in the White House, we do think that the driving force of the markets is going to be that economic recovery.
Right. But Laura, let's talk about your wealthy clients, because UBS has a lot of them, as we learned recently. Are they concerned about a potential Biden, you know, tax hike?
Yeah, so I would say that, you know, we are telling clients not to necessarily position for any particular election outcome right now. I mean, of course, once we have more clarity on what a Biden tax plan would look like, there are certain things that we may recommend for clients to do. But I would also emphasize that the more near-term effect that we're going to see is going to be the progress on fiscal stimulus and also the economic recovery. That's going to take priority. Whoever's in the White House, that's going to be the first.
Right, but if you're trying to protect your wealth and you are very wealthy, you are going to worry about things like inheritance tax and so on. Are your clients trying to move money right now before the end of the year?
Yeah, so one area that we're highlighting on the fixed income side is municipal bonds. So that is an asset class that we believe we'll see more interest in if we do expect to see personal tax hikes. So yes, this is a concern for our wealthy clients, but there are many things that we can do for them on the wealth planning side to buffer against some of these headwinds.
No doubt, no doubt. All right, Laura, thank you so much. Laura Kane, UBS Global Wealth Management Head of Thematic Investing Americas. Coming up, Intel is painting a gloomy picture of IT spending. We'll have the details in our stock of the hour. This is Bloomberg.
Retail, I think, is strong. We see a lot of people ordering online or going to the grocery store and buying and eating at home. We just don't know what restaurants are going to do this year in the state of Florida, which is the largest consumer of the crab.
You have to think about all the other offsets to tax. And so we're looking at it. I think we're going to be prepared. And, you know, we're modeling out a whole bunch of different scenarios. I think we're going to be well positioned no matter what the outcome is.
This is Bloomberg Markets. I'm Bonnie Quinn. It's time now for our stock of the hour. It's a busy week of market influences, and it's not starting off well. Abigail Doolittle here to look at some of the damage. Abigail, SAP.
Yes, SAP is certainly very brutal in terms of the German enterprise software company. They cut the guidance not just for the rest of this year, but into 2021, saying that lockdowns could happen and that could really weigh on demand. So the idea that overall IT spending may not be as strong as some have been expecting because of the virus, that is weighing on our stock of the hour, which of course is Intel. Shares of Intel are down in a big way on the day, one of the worst for the chip sector, but relative to Intel, now down for a third day in a row, losing more than 13% over that time period. And the weak IT spending, Vonnie, started in a way with Intel last week when they reported data center sales were down 10% on a year-over-year basis, missing estimates. That put overall sales down 4% for the third quarter, but they're expecting that to continue. Look at this, double-digit declines in growth for Intel over the next few quarters. So it really does suggest that there could be a weakening IT spend out there. And Intel you would think of as a need to have. In periods of past where there have been weakness for IT spending, you usually think about the need to haves and the nice to have. So if the need to haves are having problems or perhaps losing out to the competition such as AMD, it could really be a very, very tricky situation. And it's bleeding into the broader markets, SAP, the resurgence around the virus. If we take a look at what's happening on the day relative to the markets, big weakness. On the day, the S&P 500 right now is heading to its worst day, not just in a month, but since the beginning of September. That's the kind of selling action that we're seeing. And at a sector level, it's really pretty bearish. So earlier today, the sectors, there was actually a defensive play. You had tech and communication services and discretionary leading, underperforming just slightly, down modestly. Now tech is one of the worst sectors, down about 3%. But we also have some of the cyclical sectors, Vonnie, trading sharply lower, including the industrials, materials, energy. So there's really nowhere to hide in today's sell-off, Vonnie.
Yes, Intel has had a rough few quarters. It's been trying to find a bit of a direction. But if Intel and SAP are both lower, what company is benefiting from, from users' displeasure with these two?
That's an interesting question. So relative to SAP, there's a small possibility that they're using the macro environment to take down the guidance. You can see companies do that. But they are saying very specifically that they're expecting more lockdowns and that's going to cut into their demand. So they're getting ahead of that. But you can see what that's doing to the stock, down about 22% here in the U.S. The ADR heading to its worst day ever since 1995. But your question on Intel is very interesting, Vonnie, because they have been missing for a number of quarters. Their business has been weakening, though they are having on pace for the worst day since July. So there is some suggestion that these two stalwart tech companies not doing so well right now, certainly not falling in that need to have category. Let's see whether that can switch. But I think that this is really putting investors and traders on alert that tech, this year's defense, that there are some real areas of weakness in there to be careful around, Bonnie.
Absolutely, and it's certainly not helping today's dive. The S&P 500 obviously down 2.5%, and the Dow right now down 3%, with some of those major companies lower by many percentage points. Abigail Doolittle, thank you for that. Hoping for holiday cheer amid the coronavirus crisis, parents are planning to spend on toys. That's what Mattel chairman and CEO Ynon Kreiz anticipates toward the end of 2020. Kreiz spoke with Bloomberg's Alex Steele and Guy Johnson in detail about Mattel products and supply chain operations during the pandemic. Have a listen.
Well, this is where the strength of our product offering and the brands that we own comes into play. You're seeing growth in Barbie, 30% growth in the quarter. As you said, this was the highest growth we've seen for Barbie in more than 20 years. This is really all driven by great product innovation, strong product offering overall, effective demand creation, and what we see as very strong cultural relevance. Our toys have a purpose. Part of our mission is to create innovative product and experiences that inspire, entertain, and develop children through play. So it's all about quality, safety, and value. And we're able to create products that do exactly that, and we see the results in the numbers. Our product resonates very well with consumers, and our partnership with retailers in driving demand is working very well.
As we heard just a moment ago, some analysts are concerned that you are getting pull forward demand at the moment, that it's not sustainable, that once we get back to normal, we are going to see behaviour changing once again. We're all playing Uno right now, but for how much longer will we be? And do you think kids will return to previous behaviour, which didn't work out quite as well for you?
Well, we don't believe there's any pull forward in the third quarter versus the fourth quarter. And in fact, based on our own internal shopper research, we see that the vast majority of parents plan to spend the same or more on holiday toy purchases through the fourth quarter. When it comes to more of a long-term perspective, the toy industry was projected to grow before the pandemic. Clearly, there are some benefit during the pandemic and kids staying at home, but overall, the toy industry is a growth category. And it's been and always has been and expected to continue to be a strategic category for retailers. It's all driven by, today what we see, it's driven by quality product, trusted brands, and the ability of parents to offer product for children that will entertain and inspire them and add value.
Mattel CEO and chairman there, Ynon Kreiz, speaking earlier. It is now time for your latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Ant Group is on course for the biggest IPO ever. The fintech company founded by billionaire Jack Ma has set the prices for the dual share listings in Shanghai and Hong Kong. Together, they would raise about $34.5 billion, and that would surpass Saudi Aramco's record $29 billion share sale last year. PetSmart is kicking off a junk bond offering of almost $2.4 billion. It's part of a larger financing package that will separate the company from its online counterpart, Chewy. A group led by private equity firm BC Partners is betting the companies will be better off on their own. 3 years ago, the group loaded up PetSmart with debt to acquire Chewy. The biggest problem for the residential real estate market in the U.S. may be that there aren't enough homes. New home sales fell slightly in September, but remains elevated. It suggests demand is being held back by lean inventory despite record low mortgage rates. Purchases dropped 3.5% to 959,000 at an annualized rate. And that is your Bloomberg Business Flash. Still ahead. Global coronavirus cases top 43 million. We'll discuss the latest on the virus and look at risk factors with Sabra Klein of Johns Hopkins. This is Bloomberg.
There isn't anything about trading that is more central to your success than accepting the risk. So wrote Mark Douglas in Trading in the Zone. But how do traders accept the risk? They apply good risk management. They never lose more than a very small percentage of their capital on a single trade. They protect what they have, concentrate on capital preservation and don't get hung up on making money. And they never let their ego, emotions, fear or greed get the better of them.
just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
This is Bloomberg Markets. I'm Bonnie Quinn. Quick check of the markets now, because we did see that sell-off gain steam. The Dow is down now more than 3%. The worst performer in the Dow is Salesforce.com, down 4.8%. The best performer, Verizon, and it's still down 1%. The S&P, as you can see, is down 2.6%, and the Nasdaq is also down 2.4%. Of the groups in the S&P 500, I can tell you all of them are lower right now, led lower by the energy index. As I just mentioned, global stocks in the red on concerns. Rising coronavirus cases will weaken the global economy. Cases worldwide now topping 43.1 million people. For more, let's bring in Sabra Klein, Johns Hopkins Professor of Molecular Microbiology and Immunology. Professor Klein, thanks for joining. You have some important distinctions to make when it comes to men and women suffering from COVID. What have you found?
Absolutely. So what the data around the world is showing is that men are about 2 times more likely to die from COVID-19 than women. So around the globe, death rates are greater, as are hospitalizations and admissions into intensive care units. So myself and others interpret this to mean that the disease is more severe in men as compared with women.
And I guess we don't know why yet, do we?
Not completely. We're starting to get a little bit of a picture. Immune responses definitely differ. So it looks like men may not be mounting sufficiently early or sufficient immune responses to begin that initial control of the viral infection. And data that came out of China suggests that men are shedding more virus, so they have the greater potential to be transmitting more virus than women.
That's so fascinating. I know you also looked at data out of Europe that had consequences for how women recover from the virus, and that is to say, women actually are more likely to be long haulers, as they're called.
Yes, so these long haulers, people who have presumably recovered from COVID-19, but who continue to experience some of the long-term side effects, such as fatigue. There are data coming out of Europe suggesting that women are significantly more likely to fall into that category. So again, as a general rule, women tend to mount greater immune responses than men. This is true not just for SARS-CoV-2, the virus that's causing the COVID-19 pandemic. This is true for other viruses and even bacteria as well. And part of that greater immunity may be that there's more damage and some of these more long-term issues associated with not having quite adequate recovery could be revealing themselves to a greater degree in women.
Is it helping doctors decide the course of therapy these days? I know that we know a lot more about how therapy should go anyway than we did back in March and April. But if you're a man, will you be automatically treated differently now than if you're a woman in terms of therapeutics and what can be done?
No. So in this moment, there are no recommendations that men and women should be treated differently. The hope that myself and others have is that we really start to better understand these differences and start to apply this to how we treat individuals. And we might call this precision medicine, that you may have to treat us slightly differently depending on whether we're male or female in order to protect us equally.
It's really pretty phenomenal. Do we see this in other diseases? I mean, even in things like the flu, that men and women have different responses. And for these purposes, what constitutes a man versus a woman, right?
This is so true. So let's start with the last point that you made. What constitutes a man versus a woman? So much of what I am referring to often pertains to some of our biology. Our sex chromosome complement, so men having an X and a Y, women having 2 X chromosomes, the hormones that our reproductive tissues produce, men having higher concentrations of testosterone, women having higher concentrations of estrogens and progesterone. This would constitute the biological differences between males and females, which we do believe can impact the immune responses that I mentioned momentarily ago, just a moment ago, to be different between men and women. But there can also be behavioral and even social or cultural factors that go into some of what we might refer to as our gender norms.
Yes.
70% of healthcare workers, those frontline healthcare workers, our current heroes, 70% are women.
Sabra, thank you so much. This is really phenomenal information and very necessary to have it out there. Sabra Klein of Johns Hopkins Bloomberg School of Public Health.
Is now being reversed.
I'm Mark Crumpton with Bloomberg's First Word News. America's top infectious disease expert continues to stress the importance of mask wearing and avoiding crowds. In a Journal of the American Medical Association article today, Dr. Anthony Fauci said that's what is needed in our country in order to return to normalcy. Dr. Fauci has said he favors a mask mandate. The United States had more than 60,000 new cases of COVID-19 in the past 24 hours. White House Chief of Staff Mark Meadows is defending comments he made to CNN Sunday that the Trump administration is, quote, not going to control the pandemic. Asked why, Meadows said it's because, again quoting, it is a contagious virus just like the flu. Speaking to reporters today, Meadows tried to clarify his remarks.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can. If you look at full context of what I was talking about is we need to make sure that we have therapeutics and vaccines. We need to make sure that when people get sick that they have the kind of therapies that the President of the United States has.
Meadows says President Trump won't give up until all Americans are safe and the virus is defeated. Amy Coney Barrett could be a Supreme Court justice before the end of the day. The White House says a swearing-in ceremony is planned for tonight if she is confirmed by the full Senate. That would put Barrett on the court a week before the presidential election and create a 6-3 conservative majority. She is expected to easily win confirmation. More deliberate blackouts in Northern California. The state's largest utility, PG&E, cut power to 1.1 million people to prevent live wires from falling into dry brush and starting wildfires. Winds as high as 50 miles per hour swept through an area north of San Francisco. Those blackouts may last until tomorrow. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Live from Toronto, I'm Amanda Lang. Welcome to Bloomberg Markets.
And from Bloomberg World Headquarters in New York, I'm Vonnie Quinn. We're now joined by both our Bloomberg and our BNN Bloomberg audiences. Here are the top stories we're following from around the world. U.S. stocks in the red and getting redder. The S&P 500 heading for its biggest decline in 7 weeks. Global coronavirus cases on the rise, of course. Lawmakers struggling to reach an agreement on a stimulus deal and so much more. Tax policies under Trump versus under Biden. We'll speak to the director of UC Berkeley's Tax Policy and Public Finance Center about what to expect from each candidate with just 8 days until Election Day. The new era of U.S. bankruptcies. As filings surge due to COVID-19, some creditors are being left with just pennies on the dollar. We tell you why many lenders are coming to the realization that their claims are almost completely worthless. Amanda.
And Vonnie, as you say, we are seeing stocks tracking for one of the worst days since early September. A combination of factors seeming to be dragging the weight down. Every subgroup of the S&P 500 is moving lower. Leading the declines, energy, although as our Bloomberg colleague David Wilson has just now noted, and you'll hear more from him coming up on radio, energy now at one of the lowest weights in this subgroup, in this index for a long, long time. It is still techs that we're watching, and techs are declining in a big way today. They're in fact leading the declines in the S&P 500, and some big industrials are along for the ride, of course, as well. Names like Boeing weighted down by concerns about China's actions today, but stimulus package still a factor. The path of this pandemic still of grave concern, and we are watching the 10-year Treasury as well. Interesting moves, of course, in that market. Our Sarah Ponzik joins us, Bloomberg Sarah Ponzik, for a closer look here. And Sarah, there's so much for these markets to be worried about, and one question that I've had in the last couple of weeks has been, what is priced in? Is stimulus priced in and there's a wait and see on the details, or is stimulus not priced in? It's still hard to read, but what do you think we're seeing today by way of sentiment?
It is hard to read, especially since usually when we do get headlines on stimulus, we see markets jolt either which way. But today does really seem to be more so about COVID-19 and resurgences in different areas of the world. In Europe, we have record cases in the likes of Italy and France. Here here in the U.S. More than 85,000 cases, a record, and over 80,000 for 2 days in a row seems to be spooking investors and traders. There was a headline today, news breaking, that Newark is going to be rolling back some plans, imposing a few restrictions. Of course, we do have some stronger, harsher restrictions over in Europe as well. And if you do look at the breakdown of the trade today, like you said, all 11 major sectors are lower. We have seen tech start to succumb to the losses. But in the beginning of the day, we really saw this divergence between that stay-at-home trade and the reopening trade. And I will point out one name, and that, of course, is Zoom. Zoom is still slightly higher on the day. Earlier today, we had seen a more than 5% gain, a gain of close to 6%. Since we have really seen Zoom succumb to the movement, the direction of the broader market, but still one of two names that are higher in the NASDAQ. Amazon was also much higher today, too. But like I said, it has given in, and now we see Microsoft, Amazon, Google, they are all lower and pretty heavily, not as much as the market, but these are all heavyweights in the market. They make up about half of the NASDAQ combined, those top weights. So when you do see them moving lower, they're pulling. But when you see the largest moves, it's in those cyclical areas. Cruise lines, airlines, some cruise lines today down 10% or more. So it does look to be focused around this resurgence of fears and concerns around COVID-19.
Are investors also sort of getting out of the way of what could be a contested election, or at least an election with some unrest surrounding it, Sarah?
Well, it is a great question. We have 8 days until the election. Just a little bit over a week from today is the day. Now, concerns over contested election have waned over time, much less than they were about a month, 2 months ago, say. But still, it is a very large risk event that is nearing. It will be here before we know it. I can't believe it is already almost November. And the fact of the matter is, yes, it's possible that investors might want to de-risk ahead of the election, have some cash on the sidelines in case we do see the emergence of some good opportunities in the market. But it's also hard to really get a takeaway ahead of the election, considering that's such a large risk event coming up. There could just be some noise in the markets up until next Tuesday. There's no doubt about that. Investors are certainly expecting it, and everyone is a little bit on edge.
And of course, we are hearing from corporations with their earnings, and we've seen some outsized moves, right, when they disappoint. I'm thinking of Intel here in Canada, Rogers Communications, big names that where a 10% move is unusual. What are the earnings? What are we reading into them, and what do you think it's doing to sentiment for investors?
Right. We've seen very large moves this earnings season. So about 85% of companies have actually beaten earnings estimates. That's a very high share of companies. Now, companies that have beaten have actually, on average, according to Wells Fargo, seen a decline of 0.2% in the 24 hours after reporting. That compares to the historical average of a gain of about 0.7%. But those that have missed have been very severely punished. According to Wells Fargo, a decline of 4.4%. That's about double the historical average of what we typically see. So certainly weighing on sentiment. Of course, you have to take into perspective the fact that we had seen such a large run-up the past two earnings seasons. Even though we were really downtrodden numbers, we had seen quite the run-up in stock. So this time around, you're coming at it from a different perspective. And I do want to mention SAP, too, reporting earnings over in Germany overnight, down 20%, the worst day since 1999. And this is almost a wake-up call also on the COVID-19 front, the fact that they are saying that they could see their business affected into 2021.
Yeah, I mean, it's not like people hadn't been saying it, but SAP investors really sort of took it to heart. Sarah, what about oil? Which is leading which? Because we're seeing energy stocks dragging the whole market lower, but also oil down more than 3% now. It's sort of an in tandem thing.
So the two, of course, trade very, very closely together. When we see oil prices moving lower, oftentimes we'll see energy, especially those producers, heading lower too. Not sure which is leading which, but on the oil front, demand has been so important to oil prices this year. If you look at WTI crude oil, it's really been lodged around that $40 a barrel mark. Not all year long, but ever since that bit of a catastrophe that we saw when oil prices did move below zero earlier in the year. Since then, shot up to 40, been stuck around there. We have the supply side on one front with some concerns about OPEC and its allies maybe producing more than would be hoped for to really balance that demand. The demand side of the equation, it looks like last week we did see some positive numbers on the TSA front when it comes to airlines, but still so depressed compared to pre-COVID levels when it comes to cruise lines, airlines. If they're not going to be getting back on track, if we're not going to be seeing demand or traveling that really is going to weigh on oil prices. And it's really difficult to see an environment where oil really gets a strong, sustainable boost higher until, say, there is a vaccine or COVID-19 is on the back burner and travel can resume.
And you mentioned the techs, and obviously we're seeing some big moves. That group down more than 3% today for the S&P 500 in terms of the subgroup. So a pretty steep decline here. Are there key levels that we're watching on these markets? Because we've certainly seen what looks like a little bit of algorithmic trading going on around certain levels. Sarah, should we watch for some of those?
Absolutely. So one level that's been closely watched today is the S&P 500's 200-day moving average. That stands at 3407. So we did break below it. This was a level that was watched pretty closely earlier in the year. It acted as support time and again back in September, and we have since moved higher. But today we not only fell to the 50-day moving average, we did break through the 50-day moving average. And some traders, especially technical analysts, will say that if we close below a level that has acted as such strong support this year, not only could it mean further losses, but that line could then act as resistance if we kind of flip the script there.
And finally, Sarah, why are we not seeing more movement in treasuries? We did see a little bit.
We are seeing a little bit, but it is a pretty decent move. If you look at TLT, for example, I believe it is the best day for TLT, which is the 20-plus year bond treasury ETF since July 23rd, at 1.1% today. So we are seeing a pretty sizable move in the treasury market, and especially a notable reversal from what we saw last week. Just last week, we were talking about the 10-year heading towards its 200-day moving average around 85, 86 basis points or so. We had finally broken through that 80 basis point level for the first time since June, but now we see that movement back down. We do see investors moving towards those safe haven assets, and the 10-year moving back below 80 basis points once again today, just after a week in which investors were saying, at what point are interest rates going to be too high and we're going to see it affect equity markets? Well, that's not the case today. Clearly, we are seeing a reversal in treasury markets.
Sarah, thank you. Our thanks to Bloomberg's Sarah Ponczak, cross-asset reporter here. Coming up, comparing the tax plans of President Donald Trump and Democratic presidential nominee Joe Biden. We'll be joined by Alan Auerbach, University of California, Berkeley, Director of the Center for Tax Policy and Public Finance there. This is Bloomberg.
You can get a warm burger, soba noodles, even a bowl of curry rice. In a city like Tokyo, vending machines seem to be everywhere. There are literally millions in Japan, and it's a big business, selling $44 billion of goods in 2016. With COVID-19, those sales are slowing down, which means getting rid of unprofitable machines. Vending machine sales were already falling even before COVID, with competition from convenience stores that are open 24/7 and have way more options. But there is hope for some of them. About an hour away from central Tokyo is the Retro Vending Machine Park. Here you'll find 50 or so machines side by side selling some quirky items. Turning vending machines into tourist attractions may not be a solution for bigger business, though, since it requires labor and efficient distribution. Saito says it takes 5 people a day to restock his machines, just in time for lunch.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
This is Bloomberg Markets. I'm Bonnie Quinn in New York alongside Amanda Lang in Toronto. With just days now to go until the US election, tax policy is in focus with the candidates' proposals displaying divergent visions, obviously. Our next guest's research found millions of low-income Americans are locked into poverty thanks to tax policy. Alan Auerbach, University of California, Berkeley, Director of the Robert D. Birch Center for Tax Policy and Public Finance, joins us now to discuss. Alan, there are so many things that we could talk about in relation to tax policy. There's a lot of concentration over what would happen to middle-class families under a Biden presidency. But what would happen to lower-income families in either case?
Well, that's a very good question. The Trump administration is something, and the Trump plan is something of a tabula rasa. We really don't have any proposals, and certainly nothing that would affect lower-income people. The Biden plan does include, first of all, it's very explicit in trying to keep people under $400,000 of income unaffected, although might be affected indirectly. There are also some plans that would help people at the lower end, such as an expansion of the child credit and of the child care credit, the dependent care credit. So there's some things that would definitely help people at the lower end. But, you know, in terms of all in, it's a little bit hard to calculate.
Meanwhile, Alan, a lot of the attention and focus is on taxing the very wealthy, up 400,000 and higher. But the research that you were part of, in fact, shows that low-income Americans are sort of trapped in a tax cycle. Give us a sense of what we're talking about here. What's the problem with the tax code that's crushing some Americans?
You know, it's not a problem that's been unknown. It's sometimes been referred to as a poverty trap. You know, we have a lot of programs aimed at helping the poor, both tax programs such as the Earned Income Tax Credit, and then programs where people get benefits such as housing and Medicaid and things like that are aimed at poor people, and they all seem like things that should help the poor. But in order to limit the cost of these programs, we phase them out and we put various tests on, tests of assets, tests of income. And if your income goes up a little bit, you take a job, you work more hours, you can suddenly lose your benefits. You can be thrown off Medicaid. You can no longer qualify for other benefits. And we justify these limits because we wanted the benefits to go to the poor. But on the other hand, as people try to move themselves out of poverty, they may lose a substantial amount of benefits, and it could be to the point where it actually doesn't pay to work, where they could lose more than they earn. Now, this, of course, isn't true of every poor person, but if you look over the poor population as a group, many of them do face effectively very high tax rates that can be as high or higher for additional income as what people at the very top of the income distribution face.
Yeah. Speaking of which, Alan, Wall Street seems to be pretty convinced that there won't be a wealth tax under a potential President Biden. What do you imagine will happen? Would he go through with it? Could he?
I'm sorry, I didn't catch all of that.
Will there be a wealth tax?
A wealth tax?
Yeah.
Well, first of all, during the campaign, it was Bernie Sanders and Elizabeth Warren who were pushing the wealth tax, not Vice President Biden. Of course, there are certainly backers and constituents of his who would like to see a wealth tax. There are major issues concerning the implementation of a wealth tax. A number of countries in Europe that had wealth taxes repealed them. The U.S. has a special problem, which is a constitutional one. And there's a lot of thought that it would be unconstitutional for the U.S. to adopt a wealth tax. When we adopted an income tax in the early 20th century, we needed a constitutional amendment to do that, and many feel that we would need one to adopt a wealth tax too. And I think the sort of experience with the wealth tax in other countries, as well as the concerns about constitutionality, keeping in mind the evolving Supreme Court, would, I think, perhaps push them in other directions.
Alan Auerbach, great to have you with us. Really appreciate it. Obviously, it's one thing that's central on some voters' minds. Alan Auerbach is UC Berkeley Director of the Robert D. Birch Center for Tax Policy and Public Finance. And a programming note, all this week, Bloomberg Technology is diving into technology's role in the 2020 election in Bloomberg's special electioneering series. That's at 5 p.m. Eastern, 2 p.m. Pacific on Bloomberg Television. Quick check on the markets here. We have seen them sliding today, and some of the broad subgroups of the broad market, the S&P 500, down more than 3% here. So some momentum to the downside as concerns about COVID-19 continue and questions about where the stimulus package is continue to mount. Stay with us.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Markets. I'm Amanda Lang in Toronto alongside Vonnie Quinn in New York. Well, the effect of the global pandemic and, of course, the recession across the U.S. has hit some industries hard, and that means that the defaults are rising, especially in industries like energy and retail. And in those defaults, bondholders may find themselves fighting over pennies if they're lucky. Jeremy Hill covers defaults and distress for Bloomberg with us. He wrote a great story about this today. Jeremy, give us a sense of what's different here. You know, obviously, you always get some version of pennies on the dollar in a default. Why is there such a struggle now to recoup any kind of meaningful gains from these restructurings?
Right. So we always expect creditors to get less money back during a downturn like the one we're seeing now. But the major difference between this downturn and, say, 2008, 2009 is the Federal Reserve has, of course, kept interest rates at almost nothing for the last 10 years. And that's encouraged a lot more borrowing than maybe we would have even expected to see. And that means that money managers who need to generate returns have been increasingly okay with sort of letting traditional debt covenants become eroded, giving companies more wiggle room and letting riskier companies borrow. that is translating, as we're seeing in the sort of early stages of this recession, to potentially lower recoveries. Now, the way that we have seen this, and it's still, as I said, early days, but if you look at credit default swap auction results, these are like bond insurance contracts. The results in terms of the median are lower than they've ever been. We've seen a median of 3.5 cents on the dollar this year. Last year, that number was 46 cents. In 2009, it was 15 cents. These are really rock bottom payouts in these auctions, and a lot of this can be explained by loosened covenants and just an increase in borrowing overall, but there are also some structural factors at play.
Now, are these creditors that are seeing, very few pennies, if any at all, on the dollar, are they experienced creditors and they were expecting this, Jeremy, or are they being caught off guard?
Well, it just depends on what sort of instruments you're talking about. So when we're talking about credit default swaps, these auctions are referencing unsecured bonds. And so these are names like JCPenney and Neiman Marcus. And so there are all kinds of investors that hold these bonds, very big funds, smaller, more retail type investors. But the weaker recoveries we're seeing not only in bonds, but also potentially in loans as well, which are typically more restricted in terms of who is holding these kinds of securities.
All right, we have to leave it there, Jeremy, but it is a fantastic story and no doubt the first of many, because this is going to be a rolling process, I'm sure. Jeremy Hill, their Bloomberg reporter, on those potential bankruptcies coming. Now, let's have a quick look at markets, because when we looked at them last, they were on the way down. Worst day in 7 weeks, apparently, so far. The Dow right now down 3%, the S&P 500 down 2.5%. The VIX is actually above 30 once again. It's at 32.5, up a few points there. And the NASDAQ is not leading the way. It's actually the best performing index right now, but it is down 2.4%. So keep an eye on where we close. From New York and Toronto, this is Bloomberg.
want to see content. Right now, they're telling us that they really want to see more and more content on Disney Plus and Hulu.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I'm Mark Crumpton with Bloomberg's First Word News. With 8 days to go until Election Day, more people already have cast ballots in this year's presidential election than voted early or absentee in the 2016 race. More than 59 million people have voted in person at early voting centers or by mail. The surge comes as voters try to avoid crowded places on November 3rd during the coronavirus pandemic. Americans are rushing to pharmacies in record numbers for seasonal flu shots as the pandemic brings new urgency to this year's flu season. CVS says it has already surpassed the 9 million flu shots it gave during the entire previous season and expects to double that number by the end of the season. Walgreens has given 60% more doses in its U.S. stores than at this point last year. Residents in El Paso, Texas are being urged to stay home for 2 weeks. Officials are trying to stem a spike in coronavirus cases that has overwhelmed local hospitals. Texas Governor Greg Abbott has also transformed part of the city's civic center into a makeshift hospital and is sending nearly 1,000 medical personnel from across Texas to the region. Japan is setting an ambitious pledge for becoming carbon neutral by 2050. Officials didn't say exactly how they will do that, but promised to detail concrete goals by the end of the year. The pledge was announced by Prime Minister Yoshihide Suga during his first policy speech to Parliament since taking office last month. His predecessor, Shinzo Abe, was not known for prioritizing environmental policies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
It's 2 p.m. in New York, at 6 p.m. in London, live from Bloomberg World Headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Boster.
And I'm Taylor Riggs.
And it's a rout to start the week. The S&P 500 on track for its biggest drop in 7. That's as COVID cases fuel investor nerves with no stimulus to ease them. Energy, industrials lead the way. The dollar and treasuries, your haven of choice. Meanwhile, Beijing sanctions U.S. defense contractors. China taking aim at Boeing, Lockheed and Raytheon following U.S. approval of a $1.8 billion arms sale to Taiwan last week. And falling like it's 1999. Shares of the German software maker SAP plunge more than 20%, wiping out $28 billion in market capitalization. That's following a cut to its revenue forecast and warnings about future lockdowns on business. We bring you the read across for U.S. tech names. All that and so much more coming up. Romaine.
Yeah, and that read across, of course, links back to what's going on with COVID. Of course, we had 2 back-to-back records here in the United States with regards to new COVID infections. You have lockdowns taking place in Europe, and that's bringing concerns to the forefront about the trajectory of this global economic recovery in the short term. This is what you're looking at, 3381 technical levels really being tested here on that 20-day and 50-day. Right now, the S&P 500 below those moving averages, still above the 100 and 200. You're seeing a little bit of buying here in 10-year Treasury yields. With your yield right now.
Horse.
Taylor, I'm hoarse. I am so hoarse, so emotional right now, Taylor.
You know.
With this market, 80 basis points. And look at the dollar. It's going to bring me to tears.
Let's pick up right where you left off on 10-year treasuries. Unbelievable. Take a look at this chart, Romaine. You totally knocked it out of the park. Remember, there was the short trade going on where we were looking at price down, yield up. They were starting to show some cracks of that. And certainly today that has unwound as you are now seeing yields fall about 5 basis points. We are below 80 basis points on the 10-year, bringing us right back to that range bound that we have been in for so many months, Caroline. I want to flip up the board because the headlines seem really scary. Red on the screen seems really scary. Earnings, though, the fundamentals doing a lot better than we expected. 18% drop in earnings year over year. That is much better than what we thought, Caroline, which was supposed to be a 30% drop year over year. And the story looks to be improving by 2021. But the markets, at least today, shrugging off this fundamental data.
Yeah, shrugging it off in Europe, shrugging it off here in the United States. Let's get you more analysis. Bring in Ben Amons, he's Managing Director and Global Macro Strategy at Medley Global Advisors. You always put out the right kind of commentary at the right kind of moment, Ben, and I was reading through your one of today. Tell us about the COVID reality. Is the market getting it overblown here in terms of the impact we could see lockdowns have upon certain businesses? Because SAP, it looked ugly.
Hi, Caroline. Great to be back. Yeah, that lockdown narrative is back in the market. And I think it was triggered really by the comments in Europe from both SAP as well as one of the regional governors in Italy suggesting that we should just shut down the entire country. And I think that does hit a snare with markets because, you know, the remembrance of that is in March, then you really shut off economies and activity, then you get this negative reaction in absence of any stimulus at the moment because we still don't have it agreed on it, even though presumably Mnuchin and Pelosi are meeting as we speak right now, maybe to hammer out a deal after all. So the lockdown narrative is back. I think this is a risk-on-off theme that will stay with us for a little bit into this week. But I would agree with Taylor on the earnings front, and particularly if you look at data later this week in GDP data, that will come back to people's mind that the economy actually is very strong and earnings are strong too. So risk-off maybe temporarily here.
When you start to sort of prioritize, Ben, some of the risk that are out there, assuming that we do see this increase in COVID cases, assume that we do see a move to create some sort of lockdowns around the world here, does a stimulus bill actually change that equation anymore if those lockdowns do happen?
It may not be the case in Europe because there the stimulus has been, let's say, approved, but it's not going to hit the economy until much later next year. So that time lag, while you're shutting off the economy, that's a negative for the Eurozone recovery. In the US, however, it probably will be a positive because we already have a strong economy, and the so-called, what I call the arm of the CARES Act, the act that was approved in March that was so large, continues to be going through the economy. If we're adding more stimulus to it, let's say at the end of the year or in the first quarter of next year, then the momentum the economy has not necessarily be derailed that way. So I think if you look at it, it probably is more like a divergence here. You know, interestingly that the euro stayed this strong, but overall I think this is where it ultimately will play out. The euro would have to start weakening, reflecting this divergence between the US and Europe in terms of economic strength.
Ben, do Treasury bonds remain range-bound as they have been?
They could stay somewhat range-bound because, now let's face it, we cannot really normalize rates like we have in the past. The pandemic, there's too much uncertainty still priced into the Treasury market, and we would have to be really out of the pandemic to truly see normalized rates, like you see, for example, in China. And there's a commitment to keep rates unchanged until we do see inflation. But I think this latest move that we had in rates last week is a reflection, again, of that growth path that we're in. If it does strengthen further, I would expect that eventually we do normalize back to 1%, 1.25%, as this interim phase is just risk off like it is classically works. So treasuries are then bid. I don't think this bid will last.
Risk off as it generally works, we are seeing that bid for US Treasuries. We are seeing yields lower there, but we're not seeing much of a bid for gold, for example. Dollar seems to be the haven of choice instead. Ben, does that signal that actually the market isn't as worried as perhaps it has been in the past, or does it mean that everyone just wants to go long the dollar whenever you're a bit nervous?
It's an interesting play on the gold price, Caroline, because the way I've looked at it is that we peaked in gold in the summer of this year, and we have been on a steady decline. And gold has been this, asset of safe haven, basically reflecting all the uncertainty about the COVID crisis, whether it's political, economic, or financial. So I do feel that the gold price declining signals that the market is looking at this crisis ebbing away over time. And therefore, I think on days like this, even though we're getting a reminder that COVID is by far not over, gold doesn't get that bid. In addition, the real yield in the US stays very negative, and that too leans against the gold price. So I think gold may not, for those reasons, be this real safe haven, unlike what you're seeing in the treasury market today. I think, again, that's a reflection of liquidity in the market that will seek out opportunities in treasuries temporarily. And therefore, gold is more of a signal that market still thinks we're heading towards the end of this crisis at some point. Also, considering the vaccine news that's out today was rather positive from Pfizer and Johnson & Johnson.
Ben, always great to get your thoughts. Ben Amons, Managing Director for Global Macro Strategy over at Medley Global Advisors. Now, coming up here on The Big Show, we're going to talk about the plan for China, how a new administration here in the U.S. could affect the trade relationship between the two nations. That's coming up next. Plus, a final farewell. UBS CEO Sergio Armati preparing to step down. He discusses what he's enjoyed the most over the past 9 years on the job. And if you've been looking for those Lysol and Clorox wipes, don't worry. There's a new hand sanitizer in town, Caroline. Easy for you to say. The next product flying off the shelves during the pandemic. We're going to talk about that and a whole lot more. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. We're going to start with Lululemon. The price target there being raised to $415 from $387 at JP Morgan. The analyst citing untapped international presence and outsized growth in the men's segment, which should augment growth in the core North American business. Shares here down fractionally on the day. Next up, Facebook. The price target there being raised to $340 over at KeyBank ahead of third quarter earnings on Thursday. The analyst saying advertising, the second derivative to e-commerce with robust ad spending in the second half of this year. Nevertheless, shares of Facebook down 3%. And finally, take a look at First Solar, as well as its energy peer SunPower, getting a downgrade today to underperform from neutral over at Credit Suisse. The analyst citing valuation following recent gains and expects solar manufacturing will be a cyclical industry with limited tailwinds. Shares of First Solar are being peeled back today, down almost 3%. And those are some of your top calls.
Thank you, Romain. We're also going to look at three other companies, all three falling this morning. It's companies like Boeing, Raytheon, Lockheed Martin. Take a look at this. All really, Caroline, on rising U.S.-China trade tensions. China overnight coming out and saying that they will impose sanctions on Boeing, Raytheon, Lockheed, et cetera, after the U.S. State Department approved a $1.8 billion arms sale to Taiwan last week. Caroline, this is just one piece of this complicated puzzle that we're continuing to follow.
One piece that continues to always be more intertwined. Let's get a focus on these particular sanctions. CSIS, China Power Project Director and Senior Advisor for Asia, Bonnie Glaser, joins us now. Bonnie, your read on this move, was it anticipated, the tit for tat continuing?
Yes, well, this isn't the first time that China has threatened to impose sanctions on U.S. companies selling arms to Taiwan. In fact, it dates to 2015. But it's really only this year that the Chinese have started to name companies. And the most interesting thing about this particular announcement is that China has not said that it will sanction Boeing overall, but just its defense unit. So, of course, Boeing's exposure to the China market is really its commercial aircraft, and it sounds like that won't be affected.
Talk to me, Bonnie, a little bit more about this, the sort of one China policy that I guess had existed in, at least in name, for quite some time now. And with the way that the U.S. handled the sale of weaponry and other sensitive goods to places like Taiwan, this idea here is, can we read into this that that policy has at least for now been abandoned?
No, I don't think so. The one China policy has always been flexible. It's not really written down anywhere in its very specific provisions. But essentially, the core is that the United States recognizes the PRC, the People's Republic of China, as the main representative of China in the international community. But we've had the Taiwan Relations Act since 1979, and we have a very strong unofficial relationship with Taiwan. And that Taiwan Relations Act mandates that the U.S. provide defensive weapons to Taiwan. And so the U.S. has always sold weapons to Taiwan.
Bonnie, I'm curious, in your study of U.S.-China tensions and security issues, are we at peak mistrust at this moment? Is this what we are seeing play out?
I do think that we are at a new level of mistrust in the U.S.-China relationship. It's just been building over the last 3 years under President Trump, and it went from trade to issues like Taiwan and the South China Sea. And PRC disinformation in the United States. So, yes, it has certainly grown. And it's uncertain whether it would continue. We'll certainly have to see the outcome of our elections. But I do think that there's so many sources of friction in the relationship that regardless of who is president, that we are going to see a very contentious U.S.-China relationship going forward.
That's so interesting, Bonnie, as we, of course, are but a week or so away from the U.S. election. Did the announcement of these sanctions this week mean anything to you in that respect, or was it purely because we had that announcement of the actual deal last week? Is China treading sensitively ahead of the election or not?
I think that this was expected. China has responded in a sort of tit-for-tat way, reciprocating many U.S. actions. When we tried to impose restrictions on certain individuals and their visas in the United States, journalists, the Chinese, did the same. And so I just see this as just demonstrating mostly to the Chinese people that the Communist Party will defend their interests and defend Chinese sovereignty, because that's what the Chinese care most about, their own people and their potential reaction that the Communist Party is not defending the interests of the country.
And so, Bonnie, when we look at sort of the reaction here in markets, I mean, this idea that you have, the Raytheons, the Boeings, the Lockheed Martins, a lot of these companies selling off on this news, investors a little worried about that relationship. But there's also, I guess, underlying this, the idea here that all of those companies sell things that we know China needs, and they sell things that, to a large extent, China can't get anywhere else. Is there an idea here that these sanctions, as China laid them out today, might pretty much be more symbolic than actually substantive?
Well, that's exactly the word that I would use. I think it is primarily symbolic. I think it is primarily for domestic purposes, though it is laying out a marker and a warning for some companies who might be very exposed to the Chinese market that they shouldn't take actions that would damage Chinese interests. But if you take a company like Lockheed Martin, I think it's only about 1% of their sales, if that go to the Chinese market. Raytheon, a little bit more vulnerable because they've been they had a merger with UTC, which I think is far more exposed to the Chinese market. And with Boeing, once again, it's just the defense unit. I think that China really needs planes from Boeing. I don't think that they can get all of their domestic needs met by Airbus. And even if they did buy less from Boeing today, they'd buy more from Boeing tomorrow. So I see this as, yes, primarily symbolic.
All right, Bonnie, always great to get your thoughts. Of course, that's Bonnie Glaser, Senior Advisor for Asia over at the Center for Strategic and International Studies. Now, coming up here next on the program, we're going to talk about SAP, the big German software company, cutting its revenue forecast for the full year. That also expects a new wave of coronavirus-related lockdowns to hurt demand through the first half of 2021. Is this a problem for SAP, or is it a problem for the rest of the sector as well? We're going to talk about that coming up next. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
We have to talk about one of the bigger stories of the day, that is shares of SAP at one point down 22%, looking at their biggest one-day drop ever that we had seen in European trading. The story, of course, they're cutting their revenue forecast for the year, saying lockdowns are hurting demand. That is, of course, affecting their business travel unit. For more on SAP, I want to bring in Bloomberg's Sarah Said. Sarah, besides the revenue forecast, there are also some big questions, of course, about the cloud demand. What stood out to you?
Well, I mean, firstly, it's been a very tumultuous or kind of turbulent 12 months for SAP since Bill McDermott's departure almost a year ago. But, in this set of results, it's a real test for the company who reported that they'll delay, that the pandemic is basically delaying SAP's goals for cloud revenue, overall sales, and operating profit by 1 or 2 years. So investors will have to keep waiting for fatter margins. But SAP has basically blamed, the hard-hit industries such as business travel, which has had an effect on its cloud business, Concur.
How idiosyncratic, therefore, is this, Sarah, do you think? How bespoke to SAP and its own issues is this? Or is there a read across, given the market reaction we saw from Oracle, from Salesforce here in the US?
Yeah, I mean, we've seen some kind of positive numbers from other kind of US businesses. But, I mean, SAP is a giant in software provider. And, their stock is, almost a bellwether stock for European technology and global software as well. If you think about it, they have insight into the Fortune 500 companies. And, if SAP tells you that they're a headwind, there's going to be some truth to that. And that there are some customers that are challenged and don't have the money to spend. I mean, there are companies, IT software providers, that opened also with a lower down stock today as a result of SAP's results, like Capgemini, for example.
I'm curious about the legacy, though, here of what Bill McDermott built. And this idea here that you have a company that is effectively more a conglomerate of companies to a certain extent, and how much that plays into this general idea here of them not necessarily being able to transition people over to the new cloud services in a more seamless manner.
So this has been one of SAP's biggest challenges, and something that they have tried to address, or that they have mentioned and talked to investors about, is integrating this giant that they have. As you mentioned, this number of different companies they have, like Ariba and like Concur, and they've struggled with that, and that kind of has shown a little bit. But Christian Klein, the new CEO who became sole chief executive officer in April, has certainly wants to double down on his initiatives with regards to cloud. He wants to double down on investment and their own offerings inside the business, and that is going to have an impact on the company's profitability while it makes that transition.
All right, Sarah Said, giving us the breakdown here. SAP, pretty much the biggest story out of Europe right now. It might be the biggest story in the software space around the world. Definitely something to keep an eye on going forward. Taylor, pick it up with the Business Flash headlines.
Let's do it. Let's start with this story. Apple, they want to capitalize on the success of a product that's become an important source of growth. It's planning updates to its earbuds next year. Bloomberg has learned that there will be 2 new models. One is the 3rd generation entry-level AirPod. The other is the 2nd version of the AirPod Pro earbuds. And buyers agreed to buy U.S. biotech company Ask Biopharmaceutical. The price, as much as $4 billion. Ask Bio is developing gene therapies for diseases including Parkinson's and congestive heart failure. And Procter & Gamble's new sanitizing spray got perhaps its biggest vote of confidence yet today. Microban 24. It's been approved by the EPA as effective in killing the virus that causes COVID-19. Microban was designed to be P&G's answer to Lysol and Clorox. It was introduced last February. This is unbelievable, right? This is a story that has now become I think a $200 million story, Romaine, as we are all looking at this massive change in consumer habit when it comes to cleaning and sanitizing.
Yeah, I always thought probably one of the biggest failures of the coronavirus response was just the inability to find a lot of these cleaning products and other sort of, personal household products that a lot of folks need. There just really wasn't the ability for some of these companies to ramp up production. And then, of course, we've now learned some companies, Caroline, actually chose not to ramp up production because they didn't think this was going to last as long.
The question is, where can you find it now? Even I can't buy it online. In terms of like when I try and go and get anyone else to do an Instacart, they can't pick it up. On Amazon, I tell you that this new product currently costs $30 to $40 if you want to be purchasing Microban. Wow. But a snip. I ain't buying it on Amazon for that amount, but hopefully you can get it in a shop near you. This is Bloomberg.
I'm Mark Crumpton with Bloomberg's First Word News. President Trump plans to intensify an already packed travel schedule in the final full week of the presidential campaign. He's expected to hit nearly a dozen states in his effort to recover ground from Democrat Joe Biden, who is leading in most national polls. The president is scheduled to hold 11 rallies in the final 48 hours of the campaign. Melbourne, Australia's former coronavirus hotspot, will largely emerge from a lockdown after the nation's second largest city today recorded its first day without a new coronavirus case in more than 4 months.
We are able to say that now is the time to open up. Now is the time to congratulate every single Victorian for staying the course. Now is the time to thank every single Victorian family for being guided by the data, the science and the doctors. Not letting our frustration get the better of us, but instead proving equal to this wicked enemy.
And Mr. Andrews added that at midnight on November 8th, Melbourne residents will no longer be restricted to traveling within 16 miles of their homes. Melbourne has been under strict lockdown measures since early July, and the state government has been accused of inflicting unnecessary economic damage by not relaxing restrictions sooner. The last time Victoria recorded a 24-hour period without a single case was June 9th. Turkey is deepening its rift with France. President Recep Erdogan is urging his nation to boycott French goods over what he says is the country's hostile stance toward Muslims. The tension between Turkey and the European Union has been escalating over a number of issues, from the Libyan civil war to Turkey's energy exploration in the eastern Mediterranean, with French President Emmanuel Macron criticizing President Erdogan for his assertion of regional power. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Bloomberg Markets to Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A little after 2:30 here in New York, getting settlement of NYMEX crude futures. Looks like we're setting up here to close below $39 a barrel on WTI crude. This will be the first close below that mark since October 2nd. Obviously, a lot of concerns about the coronavirus, as well as some concerns, too, as well, about supply issues that may be cropping back up in the market. Natural gas prices rebounding back above $3 on the back here of some colder weather moving through, and you take a look at copper there. Copper getting a little bit of a sell-off on concerns here about that economic trajectory. And guys, that economic trajectory, of course, is linked to what we've been seeing with coronavirus and the increase in COVID-19 cases. And I was taking a look at a chart a little bit earlier today that talked about bankruptcies and the number of bankruptcies that we saw during the peak of the coronavirus outbreak. You can see the white line there is the number of bankruptcies, the blue line, the number of coronavirus cases. And when you can see how that pretty much moved lockstep here. This is basically an economic barometer at this point. I'm talking about the blue line, the COVID line. The concern here is bankruptcies started to level off here, and we were getting a lot of people talking about this V-shaped recovery, at least for a certain portion of the economy. The concern is, right now, Caroline, is that blue line starts to tick up in any sort of meaningful manner.
I'm going to pick up your ball and I'm going to run with it, but I'm perhaps going to take it a slightly different direction, because what was interesting to me is, of course, the worry about these lockdowns. We heard it from SAP, how much of an impact that will have on individual companies, how much of an impact that will have on the economy. I bring you this chart, which is University of Oxford's Stringency Index. It basically shows actually only marginal tightening of government restrictions in France and UK and Germany, and indeed, of course, in the US, but that's less surprising. But from the headlines that we're getting out of, say, France, with what was it, something like 52,000 new cases, with talks of bars being closed, with talks of more lockdowns, actually this is showing that the lockdowns aren't nearly as bad as they were back in the spring. So perhaps the knock to the economy won't be quite as bad as we think, particularly as countries focus on trying to keep schools open and perhaps doing more targeted approach rather than a wide sweeping lockdown, Taylor.
And Caroline, you wonder if that is sort of what's playing into more heightened volatility at this moment on those fears and those headlines, of course, that we're getting, but lower volatility further out. I want to take a look at spot VIX relative to the November and the December contract. For the first time since June, spot VIX, today's quote volatility and fear gauge, is higher than the November contract. So perhaps some of these election fears shares are a little bit less than we think, given that today's volatility higher, of course, than November and December further going out. But that volatility curve is something that we will keep in mind, of course, as Election Day just around the corner. And stay with us, because coming up, hopes are fading on a stimulus vote. House Democrats continuing to demand aid to cash-strapped state and local governments. More ahead with Muni Moment. We have Mayor Andrew Ginther of Columbus, Ohio. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
Seeing advanced economies doing better than emerging and developing economies, excluding China. Within countries, it's uneven. You're seeing low-skilled workers, youth, women doing worse in labor markets.
All right, the changing of the era is over at UBS. UBS, of course, made that pivot from volatile investment banking to wealth management, and that, of course, can be credited to CEO Sergio Armati, who is stepping down, turning UBS into a world leader that oversees $2.5 trillion in assets. Now, ahead of his departure at the end of the month, he touches on the differences in Wall Street versus European lenders and what changes he anticipates in the U.S. post-election.
Look, as you said, it's very difficult to predict, but what we see and what clients are telling us for Wall. I mean, you're going to see changes. You're going to see asset allocation shifts. You're going to see new policies being implemented. Even if the current administration is confirmed, probably they will need to make changes.
Do you think that could level? You always kept saying to me in quarterly interviews, "Oh, Manus, it's an uneven playing field. I'm comparing the wrong things." So could that be a constructive thing, where maybe the playing field gets a bit more level for Europe versus the US?
We'll see. No, I think that Europe, is it Europe improving or is the U.S. Basically losing ground? We'll see. I think that it's difficult to see how Europe can gain grounds from where it is today without, a significant shake-up of its, system, and the U.S. is still not to be underestimated because it's always been able to come out somehow stronger from any changes in administrations or politics. So but of course, maybe at the beginning you may see some dislocations when changes come through.
9 years, long tenancy. What did you enjoy the most in the past 9 years on the job, Sergio?
Well, I would say that I enjoyed most of the days, and the fact that it was always something new. I think that the early days was managing, the aftermath of yet another crisis for UBS, and then and starting to reposition the strategy and working on the execution and getting tractions with employees and clients was the first focus. But then, over time things have changed a lot. I have to say that. I'm not so sure I enjoyed that a lot, but I spent a lot of time in resolving legacy matters, so that was probably less of an interesting part, but still, at the end of the day, a necessary part of my job.
Well, if we look back at the strategy, I mean, you're probably going to be remembered most for downsizing the IB. I look at your trading background in your career. Did that give you additional insight when it came to downsizing the IB?
I think so. Not necessarily the trading background, but the fact that I've been working for many years for a very large investment bank, and also later on I was still involved in doing investment banking businesses before joining UBS, reinforced my belief that you will need to be a one-stop shop in order to be successful in the investment banking world. And in that sense, I knew that UBS had excellent capabilities in equities, in FX, in equity capital markets, in M&A, and strong franchises in Europe and in Asia, and they were good and enough to sustain a business model that would serve well clients and shareholders.
Oh, how we'll miss the Manus Cranney and Sergio Ermotti interviews, the outgoing UBS CEO there. Now, let's head over to Taylor for this week's Muni Moment.
Thank you, Caroline. And in this week's episode, we're focusing, of course, on the ever failure of Congress to strike a stimulus deal that has all but extinguished prospects of a real bill. 8 days to go now until Election Day, and the Senate scheduled to leave town. Without additional aid, where does this leave state and local governments? Joining me to discuss, Mayor Andrew Ginther of Columbus, Ohio. Mayor, curious what specifics you need in that stimulus bill.
Well, it's absolutely critical that Congress provides states and local governments the resources they need to fight back this pandemic and support critical essential services in our community. We cut our budget this year already by $41 million. Better than most how critically important income tax revenue is to Ohio local governments. And the critical importance for Ohio's cities to drive Ohio's recovery. That 85% of the state's economy comes from Ohio City. So if there's going to be any kind of recovery for Ohio and states across this country, it's going to come through our cities.
Some of the complaints have been the Federal Reserve's Municipal Liquidity Facility program still has about $500 billion in untapped resources. Is that program too cumbersome? The rates not attractive enough for you to borrow?
Well, obviously, we need to do everything we can to make all of these resources more flexible and accessible, particularly to small minority female-owned companies. That's where a big part of our focus has been with accessing PPP, as well as working with CARES dollars that we've gotten additional flexibility on to support those businesses, those smaller companies that have been hardest hit.
Mayor, I'm curious if those companies are telling you what the good and the bad of PPP has been, and if they really need grants and loan forgiveness and not just more debt at low borrowing rates.
Absolutely. 80% of the jobs here in Central Ohio are companies with 50 employees or less. Small business is absolutely critical to Ohio's economy and Columbus's economy in particular. And this is the time we need Congress to step up. You've got Republican and Democratic mayors through the U.S. Conference of Mayors who have been proposing, another round of stimulus directly to states and cities so that we can fight the pandemic and grow our economy. But it's going to require action and leadership from Congress. Speaker Pelosi and Secretary Mnuchin have been working hard. We're calling on Leader McConnell to join them and get this done for our country.
Would something that we can all agree on be better than an all or nothing approach at this point?
I know that resources need to be for cities and states to deal with and continue to fight this pandemic. It doesn't go away at the end of the year. There are going to be additional needs that we have, but we also have to basic city services so that we can continue to grow economies in these countries. So that direct aid to cities and states is absolutely critical to make sure that the benefit of this stimulus.
Mayor, I'm looking at your last tweets, and you talk about the safety in voting, of course, that you are doing, making it safe within a socially distanced place. I'm curious about how you think about voting this election season and, of course, the mail-in ballots. What are you seeing on the ground?
Well, we're seeing incredible turnout here at our early vote center. To vote last week, and thousands of people there. We've seen well over record numbers and a number of folks that are working to vote by mail. Great procedures put in place at our earlier and the state. So we're encouraging people to make a plan. They can get a safe and secure way to make sure they're balloted and they are able to protect their health at the same way. Either those absentee ballots, go vote early in person or at their polling locale on November 3rd.
Mayor, what is the issue for Ohio voters? Is it manufacturing? Is it COVID? Is it the economy? What is it?
Yes, yes, and yes. I do believe that COVID is top of mind. The president's mishandling. I think it's also a lot of broken promises that the president has made to people there in Lordstown, in Mansfield, here in Columbus, or in Dayton and Cincinnati. The president has not followed through on his commitments. He's failed miserably at fighting the COVID pandemic, and that you see him being women and seniors just here, but around the country. And they're ready to turn the They can unify the country and bring our economy back while keeping us safe. And that's why I think Ohio is going to go for Joe Biden.
Well, working on the technology there, and we're getting most of what you said, so really appreciate that. Mayor Andrew Ginther of Columbus, Ohio. Caroline, ever reminded, of course, about election 1 week away.
Yeah, as if we need a reminding. A great interview there, Taylor. Thank you. Now, coming up, well, female medical researchers are publishing less as the pandemic leaves women scaling back their careers. We'll discuss the impact with Dr. Nancy Spector of Drexel University College of Medicine. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Time now for Bloomberg Equality, where we examine the bottom line impact of diversity. And our focus this week, well, how the pandemic is widening the gender gap in medical research. Let's bring in Scarlett Fu for more.
Thanks, Caroline. According to McKinsey, a quarter of women are thinking of scaling back their careers or leaving the workforce because of extra demands created by the pandemic. And when you turn the spotlight on medical research, this shows up in a decline in research papers with female authors. So to discuss the ramifications of this, I want to welcome Dr. Nancy Spector. She's a professor at Drexel University College of Medicine. Dr. Spector, set the scene for us, because men historically outnumber women in medical research, so there's long been a gender gap. But how much bigger is that gap now versus before the pandemic?
So thank you for the question. That's an amazing question. So to set context, ideally, our medical workforce should mirror our patient population in the United States. And our leadership should mirror the patient population in the United States. And we are far away from that. In fact, right now, 18% of the deans of medical colleges in the United States are women. The number of women with other diverse backgrounds with intersectionality are even smaller. And we were just making really great strides before the pandemic, and now we are all of a sudden sliding backwards. So already we have seen an effect since March and April of the number of women who are publishing papers. Author papers in particular are decreasing. And why that's so important is not only is it that we need to have researchers working in diverse groups, but we also, if we cannot advance in leadership as women, unless we publish.
Now, medical research is just like academia in that your prospects are just tied to how prolific an author you really are, especially if you're early on in your career. What is the difference between, say, being the first authorship position or the last authorship position on any given research? Why does that matter?
Oh, that's a great question. So the first authorship is usually the person who's really more junior, leading the charge of the academic thrust of the research. The senior person is somebody who is more advanced in their career, like an associate or full professor, who is well established, who's sort of guiding the way. So ideally, both positions, first and last, are really important for academia, but for younger women, it's first.
Dr. Spector, how are institutions responding to this reality of female academics who have families that they need to take care of and therefore cannot devote as much time to authoring these papers?
So it's a little bit slow. People are starting to pay attention to it. There are a couple things that people are doing. We need to evolve our policies and procedures to support younger women. Some institutions are extending what's called the tenure clock, which means the amount of time we are asked to spend in a certain rank to advance. So extending that. I think what we need to do, though, is expand how we support childcare and other caretaking roles. Women tend to do a lot of the.
Yeah, and that's something that's a bigger issue than just in the medical research field. One thing I did notice is there is a lag effect because research papers can take years to produce. So the gap may actually be more pronounced now than we realize, than the numbers show us. What does this mean for the relevance of and utility of research that's currently being conducted on, say, COVID-19?
Well, I worry if we're not representing all of the patients out there. So women and underrepresented in medicine, if we're the patient population, we should be represented by the scientists who are doing the work. The work will be more robust, more forward-thinking, more well-rounded. So I worry about that. In the long term, I do worry about this extended gap in disparities across women and men, and underrepresented in medicine, in leadership and advancement of our science.
Do you think there will be some things that will get better? For instance, there will be fewer actual physical conferences that people have to attend, and there will be more virtual conferences that will suit women better?
Well, that's a great question, but I have a women underinvest in social capital to begin with, meaning we don't spend as much time networking to advance our own professional advancement. I worry if we go more and more to online, that gap will also continue to build. So I think, yes, there are advantages to online, but we still need that in-person connection to make relationships and to build social capital to move forward.
Well said. Dr. Nancy Spector, thank you so much for joining us. Dr. Nancy Spector is with Drexel University College of Medicine. She is a professor there. Romaine, I'll send it back to you.
All right, a lot of great questions there from Scarlet Fu. Let's take a look at where we stand in the broader markets here. The good news is the S&P 500 off the lows of the day. The bad news is still down 2%. Take a look at your 10-year yield there, where the dollar's going, and the sell-off in emerging markets. We'll talk about it all coming up next. This is Bloomberg.
Jacinda Ardern's Labour Party holding 64 seats in the 120-seat parliament. Now, that is interesting because it's the first time since the introduction of proportional representation in 1996 that any party has won enough seats to govern on its own. Now, this is by turns rather luxurious and also slightly terrifying for the new Labour government because there are no checks and balances on power. There is no upper house. Jacinda Ardern can pretty much rule as she sees fit. So she did rule out, heading into this election, any capital gains tax, but as revenue collapses, it must be very tempting to give that policy another look. She's also contemplating going into coalition with the Greens Party, even though she doesn't actually need them to govern. Now, the Greens Party did take forward a more comprehensive package of tax reforms to this election. So were she to govern in concert with the Greens, they could do much of the heavy lifting on tax reform, which may also prove to be a little unpopular with some portions of the electorate. So it's going to be very interesting to watch this new term. There's going to be a lot of new and untested MPs in the caucus. So a second Jacinda Ardern term is going to be full of all sorts of different challenges to the ones that characterized the first.
Have to think about all the other offsets to
I'm Mark Crumpton with Bloomberg's First Word News. America's top infectious disease expert continues to stress the importance of mask wearing and avoiding crowds. In a Journal of the American Medical Association article today, Dr. Anthony Fauci said that's what is needed in our country in order to return to normalcy. Dr. Fauci has said he favors a mask mandate. The United States had more than 60,000 new cases of COVID-19 in the past 24 hours. Amy Coney Barrett could be a Supreme Court justice before the end of the day. The White House says a swearing-in ceremony is planned for tonight if she is confirmed by the full Senate. That would put Barrett on the court a week before the presidential election and create a 6-3 conservative majority. She is expected to easily win confirmation. President Trump's son-in-law and senior advisor Jared Kushner is drawing criticism on Twitter after saying black people must, quote, want to be successful in order for his father-in-law's policies to help them. Kushner made the remarks on Fox and Friends today. Mr. Trump lost among black voters by about 82 percentage points in 2016, but has closed the gap in support to about 71 points this year, according to polling data 538.com. 7 stowaways seized when British Naval Special Forces stormed an oil tanker in the English Channel have been arrested on suspicion of hijacking. Hampshire police said the men, believed to be from Nigeria, were being held at several police stations on suspicion of seizing or exercising control of a ship by use of threats or force. They have not been charged. Police said the 22 crew members of the oil tanker were safe and well after the raid, which took place under cover of darkness on Sunday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
We're counting you down to the close. There is just 1 hour left in the trading day. I'm Caroline Hyde.
And you're taking a look at the S&P 500, deep in the red, 10 of the 11 sectors now down on the day. I'm Romaine Bostic.
And I'm Taylor Riggs, all about volatility. That bid for Treasuries, Caroline, markets gearing up for the election.
They certainly are. Volatility's where it out. If a picture paints 1,000 words, the words are sell. Sell, particularly Royal Caribbean, for example. Cruise liners on the lower side, but remain every single industry group in the red as we see it.
Yeah, pretty much nothing spared here. I mean, you only really have about 10 stocks in the S&P 500 that are even positive on the day. Not only is it the cruise lines, but you got the big FANG names, the metals companies, pretty much everything across the board now being sold off.
So look, you guys, just an hour left here in trading, one of the most important hours. Here is, of course, what we are watching as we head towards the close. All of my eyes are on VIX. We're up 5 points to almost a 33 handle on the VIX. We haven't seen these types of moves really now since September 3rd. So the VIX, the highest, as we know now, since September 3rd. What moves to the upside all moves to the downside. Romaine, that is what we're seeing in the equity markets today.
Yeah, and I mean, of course, when we talk about what's going on with that volatility, you have to take a look at what's been happening with the technicals, too, because a lot of folks are keeping an eye on that 20-day moving average, that 50-day moving average on the S&P 500. It had been a line of support for quite some time. And you take a look at that yellow line, that's your 50-day moving average. That had not only been a line of support, but you see it had been trending higher, which was always a good sign. That's sort of flattened out the last few days. And right now we are trading below that 20-day and the 50-day, still a far ways off from that 100-day and 200-day moving average. So not necessarily panicking, but you get a sense here right now, Taylor and Caroline, that the market is a little bit on pause until they get some clarity on what's going on with COVID and, of course, fiscal stimulus.
And clarity as well. For once, maybe we got a bit of it coming from the White House, but it seemed to be a gloomy picture. Take a listen.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can. And if you look at full context of what I was talking about is we need to make sure that we have therapeutics and vaccines. We need to make sure that when people get sick, that they have the kind of therapies that the President of the United States has.
We're going to defeat the virus. We're not going to control it? Today, for me, it's the lack of control on the virus that really dictates trade. We're looking, what the numbers, 85,000 being added every single day in terms of cases in the United States. We're seeing records being set in France, records over in Germany. This is why we're seeing shivers down investors' spines at the moment, Romain.
Yeah, absolutely. And I remember like several months ago, we joked about this idea how everyone in the market had become sort of an armchair epidemiologist. But if there's any reminder as to just how much the COVID crisis matters to investors and matters to their investment decisions, I think what transpired over the weekend, not only here in the U.S., but really worldwide, was definitely a reminder of that.
And Romain, the lack of stimulus. Where did that whole reflation trade go? It is unwind today, down 4 basis points on the 10-year.
All right, let's bring into this conversation Olivia Engel. She's CIO of Active Quantitative Equity and Senior Managing Director over at State Street Global Advisors, joining us today from Boston. Olivia, let's start off here with the economic picture, the economic backdrop, an economic backdrop that is in recovery, but again, it is without fiscal stimulus right now, at least here in the U.S. And for the moment, it appears to be a backdrop that is going to have to grapple with a rise in COVID-19 infections. What do you make of it?
Yeah, absolutely. This is a significant concern. And a lot of the confidence I think the market has been working on over the recent months has been a confidence that a vaccine will be developed and will be rolled out and everything will be rosy thereafter. But even if the consensus is a fair estimate that in 2021 a vaccine would be found, there are still a number of vulnerabilities in the equity market and in companies that are listed on the equity market that they just don't survive that time. So the time is of the essence, and how the consumer can be protected through that time period, how balance sheets on companies that are in a precarious situation can actually remain solvent through this period, I think will be a key determinant of how deep the economic impact can be and its long-lasting impact.
It was interesting how much Europe almost helped guide the US lower today, particularly what was happening in Germany. The fact that SAP, a key software bellwether, was saying that these lockdowns are really hurting its business, Olivia, and notably also the IFO data, the business climate index coming from Germany, also looking pretty woeful, dropping for the first time in 6 months. Where is your gauge in sentiment at the moment? Because it's been notable that throughout the pandemic, the investor base has been able to shake off the immediate urgency, the immediacy concerns to buy into stocks for the hope that things will get better. Where is immediate sentiment for you?
Yeah, that's right. And we have been concerned about the singular theme that investors have really latched onto in driving some of the most expensive parts of the market that have become increasingly concentrated to concentration levels that we really haven't seen since the dot-com bubble. And so the singular theme of the FANG stocks and the big mega caps outperforming strongly and leaving everything in their wake has created its own risk. So in sentiment, we've actually started to see some signs that investors may be shifting away from this theme in looking at a multidimensional picture of investor sentiment, not just by looking at how the prices have moved, but looking broader to how earnings are being revised, looking at linkages through the supply chain, looking at how hedge funds are positioned and starting to rethink some of the positioning in their portfolios. So we have seen some signs that this singular mega cap theme is maybe starting to get some attention diverted away from it.
What does that then mean for this momentum trades that we see? Big momentum to the upside, and then days like today, big momentum to the downside, as we're reminded.
Well, momentum as a phenomenon is something that you really need to be mindful of. It really has a carry trade distribution associated with its payoff, which means some people can coin the phrase, it's like picking up pennies in front of a steamroller. It feels really easy to capture the value added in incremental ways day after day. That's what momentum looks like. But when it fails in a very big way. And that's another way of saying there's a big negative skew associated with the payoff. So we have to be very careful of the embedded sentiment or momentum exposure that we have in our investment portfolios and seek to balance that with other things that can generate more of a positive positively skewed payoff like quality characteristics and reasonable valuation in stocks.
There seems to be a little bit of a shift there, though, Olivia, where folks are either moving there or at least trying to identify those types of names here. How much of a rotation do you see going on already, and do you think it's going to be sustainable?
Yeah, I do think there are some early signs that we've seen in positive sentiment starting to emerge in a number of companies in the auto sector, in consumer discretionaries beyond the mega caps, in some of the consumer durables, in retailing and consumer services, capital goods. So some of the more cyclical, out of favor segments, we've actually seen some renewed interest in terms of these multidimensional ways that we measure sentiment. So we think that's a really good sign for investors in being able to generate a more diversified source of returns rather than something that's just dominated by one highly correlated theme.
We always love having your voice on the show, Olivia Engel. Thank you so much. CIO of Active Quantitative Equity at State Street Global Advisors. Great thoughts on how sentiment is shaping up and the rotation trade coming up. Signs of optimism. Well, AstraZeneca resumes trials after some previous safety concerns, saying its vaccine candidate produced an immune response in older adults. What this means in the race for a vaccine. Plus, the impossible investigator. We speak to the CFO of Impossible Foods about its new initiative to eliminate animal agriculture and the impact of the pandemic. And not playing around, why the CEO of Mattel thinks that innovation and creativity will help them overcome the pandemic and have a happy holiday season. All that and so much more coming up. This is Bloomberg.
What moves the human spirit, what transcends time, comes from true craft, the artistry of Japanese craftsmanship. Presage Seiko.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Lee Kun-hee, now the driving force behind Samsung's rise, has died at the age of 78. Bloomberg's Manus Cranney took a look at his legacy and the path ahead for one of the world's most powerful electronics players.
Lee Kun-hee was the visionary behind Samsung Electronics. The transformation from a cheap appliances maker to the world's biggest producer of smartphones, televisions, and memory chips. He began relentlessly pushing the company up the technological ladder after taking to the helm in 1987, following the death of his father. Famously telling employees to change everything except your wife and your children during his drive to challenge rivals such as Sony. By the early 90s, Samsung had surpassed its Japanese and American peers to become the industry leader in memory chips, then began dominating flat panel display and high-end mobile markets soon after. The global electronics powerhouse today is South Korea's corporate crown jewel and a cornerstone of the economy. But the rise to the top had its setbacks and controversies. Lee was mired in political scandal in the late 1990s after being convicted of paying bribes to the government in 1996, for which he was pardoned a year later. In 2009, he was found guilty of tax evasion and breach of duty for intentionally causing losses at a Samsung subsidiary. Nevertheless, the reins are now set to pass to his only son, J.Y. Lee, who's been the conglomerate's de facto leader since 2014. The younger Lee is grappling with two simultaneous legal disputes with South Korean prosecutors over allegations of bribery and corruption, which he's repeatedly denied. Still, J.Y. Lee is expected to eventually inherit the $300 billion company that continues to be one of the world's leading electronic players.
All right, our very own Manus Cranny with that report. Now, let's get a quick check of the latest business flash headlines with Taylor.
Thank you, Romain. We're going to start with PetSmart, kicking off a junk bond offering of almost $2.4 billion. It's part of a larger financing package that will separate the company from its online counterpart, Chewy. A group led by private equity firm BC Partners is betting the companies will be better off on their own. 3 years ago, the group loaded up PetSmart with debt to acquire Chewy. Uber is being sued over the way it uses customer ratings. According to a suit filed in San Francisco federal court, the ride-hailing service violates the U.S. Civil Rights Act by firing minority drivers based on how they're rated by customers. Uber insists its drivers are independent contractors who are not covered by workplace protections of the civil rights legislation. And the parent of coffee and donuts chain Dunkin' is in talks to be acquired by private equity-backed Inspire Brands. According to the New York Times, the deal is valued at $8.8 billion, could be announced as soon as today. Shares of Dunkin' Brands have more than doubled since March. Inspire Brands owns Buffalo Wild Wings and Jimmy John's. Romain, it's all about that mobile app, ordering of your coffee on your way to go.
All right, Dunkin', my third favorite donut out there. All right, let's get over now for Options Insight with Abigail Doolittle, where Abigail, you're looking at the sell-off today.
And I'm curious to know what your first and second favorite donuts are, Romain. Yes, we are going to take a look at today's stock sell-off. And to do just that, Scott Bauer of Prosper Trading Academy, the CEO over there. Happy Monday to you, Scott. Not so happy for stock investors, or at least those who are long. We're looking at the worst day for stocks since the beginning of September. A variety of factors here, the virus. We also, of course, have no stimulus. China slapping sanctions on some of the defense contractors here in the U.S. What really stands out to you, and do you think it's going to last?
Yeah, there's certainly no lack of news here. The one you didn't mention was the possible extension of a decision on the election. A few months ago, and even as recently as a few weeks ago, we saw a big divergence in the VIX, Abigail, because a lot of people thought that this was going to go on. We weren't going to get a decision. It was not going to drag on. But then we saw the VIX futures really come back into line, and we're still seeing that. So, I'm hearing a lot about that maybe is the part of the big sell-off today. I don't see that. I do think it's really the news coming out of Europe, out of SAP, that maybe this is a precursor for some of the big companies here.
Yes, that's sort of definitely an interesting potential tell on the tech IT spend, unless perhaps SAP is using the cover of this macro, let's hope not, to take the opportunity to guide down. But you were just mentioning the VIX, Scott, and if we go into the Bloomberg terminal, the VIX has really been in a range, and it's clear that this range is either going to break to the upside, back toward the highs of the year, or we could be going right back down toward below 20, toward 15 or so, which would represent, a move that would be positive for stocks. Which way do you think that it's going to go? It seems as though this break is probably going to come pretty fast, pretty soon.
If you can give me about 6 weeks' time, it'll be to the downside. Would be my prognostication that the VIX will start normalizing lower as the market gets settled in a little bit.
Super quick, Scott, before we go to your trade, do you think that you could see a spike higher, very fast spike up to 50 and then back down, or do you think that just down?
I don't see a spike that high. I really don't, Abigail.
Okay, so that's the answer.
Yep.
Yeah, no, that would be the answer around the range, because it really looks like it's going to make a big move one way or the other in probably a week or two. Talking about your trade, though, you are relatively bullish here on Overstock.com into earnings.
I am, and I'm going out to next week's option, November 6th, so we have about 2 weeks here. I'm buying the 80-85 call spread to the upside. I can do that for about $1, $1.10 or so. Right now, the option market to next week is pricing in a move of about $15. If we get that to the upside, that takes us to that level, which is also some pretty decent resistance in the stock. So I really like the reward to risk on that trade.
Well, it's certainly going to be interesting to see what comes with that earnings report. And then later this week, of course, on Thursday, I think it is, Apple, Amazon, Alphabet, Facebook, Twitter. It's going to be an earnings bonanza. We'll be here and looking forward to the next time that you join us for Options Insight. Scott Bauer, CEO of Prosper Trading Academy. Thank you. From New York, this is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The race for a vaccine for COVID-19 continues. Take a look at this chart. Really, it's been the therapies, and some of these vaccine makers have been the big outperformers. Moderna, Regeneron, they're up 250 and 55% year to date. Other vaccine makers like AstraZeneca, they're still up about 9% year to date. News today, of course, that vaccine is producing an immune response in older adults. I now want to bring in Drew Armstrong, who leads up Bloomberg's healthcare coverage for us. Drew, your take on this AstraZeneca news?
Yeah, listen, this is good news. It's not the kind of final answer that you need on any of these vaccine studies. But when we think about who is at most risk of this disease and most needs protection, and also the reason that a lot of us are taking, measures like wearing masks and social distancing, the folks that need protection are this group of older and elderly people. And so you have, seeing these kind of surrogate markers of immunity is very, very good news. That said, it's not the out in the real world trial of tens of thousands of people that we're going to see if this thing really does work when it comes to actually stopping infections from the virus.
And so where do we stand, though, with regards to some of the other competing vaccines and treatments out there right now, Drew?
Well, the front runner in when we think we're going to see results is probably still Pfizer. Moderna Inc., who you all just mentioned, is obviously in the race, too. And AstraZeneca, despite being having their trial halted for a safety concern and then restarted in the U.S., I believe, just recently. Those are kind of the three that we're looking at. But I think we've moved from a, end of October timeline until sometime in November, in part because the U.S. FDA has said that they want to see 2 months worth of safety data. And I think that's really, given companies a moment to pause and say, all right, listen, this is probably going to slow things down a little bit. So we're probably at least several weeks out from getting a real answer on both the efficacy and safety of the earliest of these vaccines.
Drew, of course, the numbers, the infection rates are alarming. 85,000 cases a day here in the US. But then you drill down and look, 800 deaths a day is 800 too many, of course. But can you link to us about what the rates are looking like at the moment? Because when I look at France's hospital use jumping the most in almost 7 months, that worries me. Should we be worried?
Yeah, I think that there's when we try to do these comparisons to earlier in the spring versus now, there's a couple of really important things that you need to keep in mind. One, we are testing a ton more now. So we are finding more cases. There's not exactly an apples to apples comparison of cases in the spring versus cases now. What you can and really should be watching are hospitalizations and deaths. And even that's not perfect because we have gotten better at treating this disease. When this disease hit New York, for example, we did not have a great idea what we were doing. The hospitals there were very, very quickly inundated with patients, which hurts care as well. And in addition to that, we were in a situation where we weren't exactly sure if everyone was going to be able to get the care they needed just because of a resource level. Now we have a better idea of how to treat patients. We have some better therapies that are available. And so you're going to see the rates of death go down from this. That said, we're at a point in this epidemic right now, in the United States at least, where the whole country is getting hit at once. In the early part of the spring, really it was just kind of a couple of major travel centers and then scatterings of cases around the country. Now we have a real bed of infection to infect other people just about everywhere, and that is not good news. Even if the rates are coming down, this is a disease where denominators matter, and the denominator has gotten much, 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 much bigger than it was earlier this year.
Drew, you always put it into such great perspective. We thank you for the context. Drew Armstrong there for us. Now, let's put it into the context of the markets right now, because coronavirus is what's hitting us. Certainly, Taylor, we're seeing a reaction off by 2% on the NASDAQ.
And this is a different reaction than we saw last week when you had mini sell-offs and then the 10-year didn't budge. This time, bonds catching a bid. You're down 4 or 5 basis points alone on the 10-year and the 30-year. This is Bloomberg.
There isn't anything about trading that is more central to your success than accepting the risk. So wrote Mark Douglas in Trading in the Zone. But how do traders accept the risk? They apply good risk management. They never lose more than a very small percentage of their capital on a single trade. They protect what they have, concentrate on capital preservation and don't get hung up on making money. And they never let their ego, emotions, fear or greed get the better of them.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our biggest initiative yet is coming up. On October 29th, we'll start a $20 billion Rural Digital Opportunity Fund auction, essentially targeting that money to unserved parts of the country where there is no broadband at the FCC's definition of 25 megabits per second.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I'm Mark Crumpton with Bloomberg's First Word News. With 8 days to go until Election Day, more people already have cast ballots in this year's presidential election than voted early or absentee in the 2016 race. More than 59 million people have voted in person at early voting centers or by mail. The surge comes as voters try to avoid crowded places on November 3rd during the coronavirus pandemic. CNN reports that for the first time in 100 years, the conservative newspaper, the New Hampshire Union Leader, has endorsed a Democratic presidential candidate. The paper's editorial board wrote, quote, "Building this country up sits squarely within the skill set of Joseph Biden. We have found Mr. Biden to be a caring, compassionate, and professional public servant. Joe Biden may not be the president we want, but in 2020, he is the president we desperately need," end quote. And the editorial board continued, again quoting, "He will be a president to bring people together and right the ship of state." Americans are rushing to pharmacies in record numbers for seasonal flu shots as the pandemic brings new urgency to this year's flu season. CVS says it has already surpassed the 9 million flu shots it gave during the entire previous season and expects to double that number by the end of the season. Walgreens has given 60% more doses in its U.S. stores than at this point last year. Japan is setting an ambitious pledge for becoming carbon neutral by 2050. Officials didn't say exactly how they will do that, but promised to detail concrete goals by the end of the year. The pledge was announced by Prime Minister Yoshihide Suga during his first policy speech to Parliament since taking office last month. His predecessor, Shinzo Abe, was not known for prioritizing environmental policies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostic. A little less than half an hour to go here in the trading day today.
Let's check out every single industry has been in the red. There's a little chink of green in its utilities, but look, barely up 0.1%. Energy is your worst performer. Industrials, materials. It is the woeful COVID cases that we look to, whether it's 85,000 more that we're adding in the US, whether it's record numbers in Europe. That's really set the sentiment for today, Romaine.
Yeah, and setting the sentiment, you flip up the board here, you take a look at the NASDAQ 100, because it was backsliding as well. Remember, we're down about 5% or so over the past 10 sessions, basically going back to that October 12th date where the market seemed to have peaked in this latest round of the cycle. However, as we're speaking now, we are seeing a lot of those large cap tech names start to actually try to flirt with the green territory. Apple right now only down 0.1% after being down about 1%. Amazon, pretty much a similar situation, as well as Netflix and Tesla. So something to keep an eye on as we count you down to the close to see if we can get a rebound in some of those heavyweight names enough to actually pull up the rest of the indices here. Carolina Taylor, you could take a look at where the Russell 2000 is right now. Remember, we had that rotation into cyclicals last week. That's being sort of rotated back into the barn today. A pretty big underperformance there for some of the small cap names.
Great deep dive across the sectors. Let's bring you some bespoke corporate news for you right now, though, because as supply chains for traditional meat buckled amid the COVID crisis, consumers filled their carts with plant-based alternatives. Instead, Impossible Foods, Beyond Meat, you know the names, but with growth coming, so too comes responsibility. Impossible Foods is doubling the size of its R&D team over the next year, seeking the world's best scientists to help eliminate animal agriculture and its detrimental impact on the climate, they say. Joining us, we're very pleased to welcome back CFO David Lee, of course, in San Mateo, California. David, it's always great to have you here with us. What do you want to achieve? Doubling the size of the R&D team, that means adding about 150, but I'm really taken by the 10 additional scientists you call Impossible Investigator Program. What will they do?
Well, our scientists aren't like scientists you might meet at a typical food company. Impossible Investigators really have the option to pursue anything in science. These are folks who have distinguished careers